Dear all, a very warm welcome to the inaugural edition of VC World Convergence, the Global Real Estate Investment Summit presented by Realty Plus in association with BW Business World. Friends, BW VC World is a new media and networking platform that we are launching for the investment community. As with our overall focus, so too with VC World, we are building on our three key pillars: content, community, and commerce. In Sync Convergence, the Global Real Estate Investment Summit today is focused event that will bring together leading investors, policymakers, advisors, and industry professionals to discuss, create, and leverage investment opportunities in the real estate market. The summit today promises a deep dive into the current landscape, marketplace, and strategies, the challenges and opportunities for the industry, insights into the investment opportunities, exciting projects being executed by the industry players, and the functional roadmap for the year ahead. I'm Sapna Srivastava, editor Realty Plus, and let's begin the proceedings of the day with the auspicious Ganesh Mantra. So, friends, let's begin with a brief introduction of Realty Plus and BW Business World. Can we have the AVs, please?
वक्रतुण्ड महाकाय सूर्यकोटि समप्रभ निर्विघ्नं कुरु मे देव सर्वकार्येषु सर्वदा.
So that was the auspicious Ganesh mantra we were waiting for. So on that positive note and auspicious beginning, let's go on to the brief introduction of Realty Plus and BW Business World. Can we have the AVs now?
Which path to choose in a crisis? Some brands are born to do the same. And during the times of challenge, the stalwarts of Indian real estate industry have chosen to do just that by showing others the way to finding opportunities even amidst a crisis. By showing the world how to go about delivering on promises even amidst adversity. Success doesn't just happen, it happens by design, by pushing the boundaries, by raising the bar. It's days of creating a vision and nights of bringing it to life. Knowing that pictures are worth 1,000 words and every word makes a difference. It's doing the research, trusting your instinct and finishing what you started. For the past 17 years, Realty Plus has been turning obstacles into opportunities, keeping the industry informed on the latest developments. Innovating to inspire debate and discussion. Bringing forth the perspectives of industry leaders. honoring hard work and achievement. Keeping the industry connected. This is what we are built on. This is what we are building. We are Realty Plus, and we lead the way.
So this was some introduction of what Realty Plus is doing in its domain, its products, its latest initiatives. Now we will get some idea of what BW Business World is doing. Let's have an AV of BW Business World and the product portfolio of BW Business World.
Rich legacy of curated events that enable conversations on policy issues in India.
Because of the state of our cities, we have no option but to build smart and resilient cities.
Digital India is more for the poor, underprivileged and the deprived.
Covering a range of topics, BW Business World events look to create a strong narrative around smart cities, digital India, healthcare, Swachh Bharat, human resource issues, education, banking and finance, among others.
The world is fast changing. Best practices are available now on the net.
विकास डेवलपमेंट पूरी राजनीति में ये फोकस बन गया है.
BW Business World events provide a speaking platform to the voices that matter.
स्मार्ट से ताल्लुक यह है कि हम जो बेसिक एमिनिटीज हैं उसको हम चुस्त दुरुस्त करें.
You don't have to be a technologist. You need to understand how technology influences the world.
Mahatma Gandhi was a great man. He was the leader of the freedom struggle.
We believe that e-governance and IoT will play a very, very important role.
BW Business World is an excellent exhibition platform that helps you showcase your services to the right audience.
BW Business World's digital transformation went on the fast track in 2020, marrying its legacy of credibility and robust business journalism to a technology-first world. Hosting over 250 virtual summits and webinars across its 17 niche business communities, with millions engaging with the power-packed content like BW Dialogue Series, Festival of Life web series, and custom-created webinars and hosting 20+ virtual summits. $33 million page views on an average, 21 special issues in 2020 hit the stands, and multiple IPs scheduled in the coming months, BW has taken a leadership position in the business news segment. To become a part of our legacy, write to us at partner@businessworld.in.
So this was a brief snippet of Realty Plus and BW Business World initiatives. Let me also inform you all that the event is being live streamed on Realty Plus website, www.realtyplusmag.com. BW Business World websites, www.businessworld.in, www.bwdisrupt.com, and vcworld.in, as well as social media pages of both Realty Plus and BW Business World. So friends, now move on to the program of the day, and I welcome Dr. Annurag Batra to present the inaugural address of the day. Known as Media Mughal, Dr. Annurag Batra is the editor-in-chief and chairman of Exchange for Media Group and Business World. Dr. Batra, I hand it over to you now. I guess it's taking some time for Mr. Batra to join. He'll be here in just a few minutes. Dr. Batra, over to you.
Good morning. Thank you so much, Sapna. It's a beautiful day today on 17 July morning, and welcome to this inaugural edition of the Realty Plus and VC World Real Estate Investment Summit. Over the last 17 months, one of the sectors that has really changed is the real estate sector, and it has changed in many ways. And one of the questions that are on everyone's mind is, will the real estate sector continue to be an attractive investment asset for investors, for institutional investors? Will it be the right investment vehicle for individuals and for people who make real estate an investment so that it multiplies? So today, throughout the day, we'll be looking at these aspects of what do large institutional investors think about where real estate is headed. We'll talk about the real estate investment outlook in 2021 and beyond. We'll define the trends that define growth of real estate in India. We'll talk about how alternate real estate investment models are emerging. We'll talk about real estate debt. We'll talk about distressed real estate assets. We'll talk about investing in residential property. We'll talk about how technology is transforming the real estate sector. We'll talk about how are the new business models in real estate making sure that the acquisition cost for customers is coming down. We'll talk about prop tech ventures or real estate tech. We'll talk about REITs in India. We'll talk about commercial real estate investing. We'll talk about how warehousing is growing as a real estate investment destination. We'll talk about how real estate will drive us getting to the 5 trillion economy. We look at the nuances of the housing market. We look at how is the real estate recovery really happening. So it is a comprehensive real estate investment summit. We're bringing India's top 20 real estate investors together. We have about 45 speakers today at the conference. We look at every aspect of real estate. And if I had to outline 3-4 trends, one is the way we work has changed. It has changed in the way that we are doing more and more remote working. Even this conference is contactless or remote. So clearly what happens to the office space? The meaning of the office space is redefined. But my view is when we have the opportunity to return back to office, we all will. We may not go there all 5 days or 6 days a week. We go there 2-3 days a week. It'll be flexible, work from anywhere. How does it impact the attractiveness of office spaces? Will corporates have office spaces? We will also talk about co-working spaces. Also, what is happening is residential is getting a new boost from actual first-time buyers or users. Millennials who in the last 17 months have for the first time spent time in their homes are looking forward to really buying assets and utilizing them for their own use. So real estate is at crossroads. E-commerce is growing. The growth of e-commerce is leading to growth in warehousing. So really warehousing as an investment vehicle is growing leaps and bounds. I also want to talk about the fact that for the first time in at least 10 years, the buyers are actual users of property. They're not just investors. I think that's a big change. That means the cash flows of developers will be better. And you know, the charm and lure to own a real estate asset will always stay. It is not going to go away, whether it's in residential or in commercial. Also, I believe the pricing of real estate has become more and more realistic, whether it's for residential or is it for commercial. So combined with all these factors, real estate as an investment is only going to get more attractive. And we will see that more and more money will be poured into Indian real estate. As far as retail is concerned, even the technology players that were pure play retail are today doing a hybrid model. Hybrid is a word that is being used in retail also. One MG is now setting up physical stores. Thyrocare was acquired by a digital healthcare player because it had physical distribution and physical testing capabilities. So the word in real estate will also be hybrid. So retail may have seen a beating over the last 16, 17 months, but retail will come back. Look at the malls in Delhi. The numbers in the last 4 weeks are very encouraging. So clearly, whether it's the commercial real estate asset, which because of the office being redefined, it will not just be a place to work, it will be a lounge, it will be a place to meet colleagues. But the charm of collaboration through physical interface will continue, and hence the attractiveness of the office real estate will continue. I already talked about how residential real estate will continue to be more attractive as millennials become first-time home buyers. Third is warehousing and industrial. With the rise of e-commerce, warehousing and industrial real estate will get even more attractive. Retail, as I said, it may have seen a beating in the last 16 months, but the word is phygital, the word is hybrid. So you'll see retail and online coming together to create a certain experience, which will then take over, majority of retail operations. So clearly the real estate sector is poised for growth. Yes, the last 17 months have separated the boys from the men from boys. Clearly, as I said, the real estate developers whose balance sheets are strong will stay on. Real estate developers who are able to provide an offering which is world-class at a price point that is attractive will attract buyers and hence will attract investors. I think we must take a little long-term view of real estate, which is at least 5 years, if not 10 years. I think the golden years of Indian real estate are ahead of it. I'll say this, and I look forward to this day-long conference. I'll be talking to Vipul Roongta of HDFC Capital in a while, and in the evening, I'll be talking to Khushro Jeetna on how the real estate sector will contribute to the 5 trillion economy that we are hoping that we will be in a couple of years from now. I'll leave that. I'll hand over to the MC. We have a very senior industry professional, Sapna, who will join us and talk to us about where is the Indian real estate headed and how are the investments in Indian real estate looking like. So I'm sure you'll invite Mr. Arpit Singh, but I'll hand it back to you, Sapna. So that,
Thanks, Dr. Batra. Thank you, Dr. Batra, for sharing those positive sentiments. And yes, we will be hearing more of your thoughts later in the day with your sessions. And thanks for setting the tone of the day for for our investment summit. I now welcome Mr. Arpit Singh, Managing Director, Xander Investment Management, to deliver the opening keynote address of the Real Estate Investment Summit, and he will be addressing the audience on the Real Estate Investment Outlook 2021 and beyond. But before I hand it over to Mr. Arpit Singh, let me give a brief introduction of Arpit. Arpit leads the office investment platform at Xander with a focus on core value add develop to core strategies across key Indian gateway cities. Through his more than 12-year direct investing experience in Indian real estate, Arpit has developed strong relationships with investors, sponsors, developers, sellers, intermediaries, and leads sourcing of proprietary off-market grade A office acquisitions for the platform. He also leads the post-acquisition portfolio management team and has established an integrated property management vertical over the last 5 years. So a very diversified career span and expertise. Arpit Singh, I hand it over to you now.
Thank you, Sapna. Thanks for the kind words and thanks for the introduction. And thanks to Annurag. I think he laid the platform for the day quite well. I wish the Realty Plus team and the VC World team all the best for this conference, which they are putting together. A very interesting set of speakers and industry experts are lined up, definitely for everybody to kind of take their insights and take their inputs. And also, I think it's an opportune time for this discussion today, given that after the second wave, the country is starting to open up now, and the impact will be more and more visible in the next few months as things go along. Just a quick introduction about our group before I get into the topic and the agenda. I'm part of Xander Investment Management. This is the private equity real estate arm of the Xander Group. We are an emerging market focused investment firm. India is a key focus market for us and has always been since we started the firm in 2005. Currently, we manage about $2.5 billion US in Indian real estate space in our strategies, which are focused across office, commercial, retail, industrial, credit, flexible working, venture capital, and a number of other investments that we kind of run. So at this point of time where we stand, we've all kind of been through the last 18 months. Annurag also referred to it, 17 months. And it's been an extremely volatile period for the real estate industry in general. And it's been kind of a roller coaster ride for investors, sponsors, operators in the space. And I think that's going to continue at least for the next 12 to 24 months, depending on, because I think that this whole situation that we are all in and the whole world is in is not going to go away so easily. I think there'll be ups and downs, which will continue to kind of happen in the industry and in the space, but that also provides opportunity as we see as investors from our side. So now let's start from a bit macro understanding of the sentiment right now. So historically, even since the late 2000s, top down, if you look at it, you analyze Indian real estate market as an investor, as global investors do, the market continues to remain attractive because the macro themes which are on India's side here, including the demographic profile with a young population, expanding and more affluent middle class, growing urbanization, etc. All of that, looks really good. And for all of this, as India starts to, as one of the largest emerging countries in the world and starts to move up the development curve, one asset class which will play a big role in that entire movement is going to be real estate. So because the requirement of quality infrastructure, quality real estate also drives a lot of development and growth for any economy. And that's been seen historically across countries. But the problem happens when you start looking at things bottom up, which is where India starts becoming a bit challenging. I'm talking about investment into Indian real estate now, because there are a lot of execution challenges which were there when the sector started opening up early 2000s, and they still continue to remain. Whether it's be the changing regulations, land title issues, lack of transparency in the processes, governance challenges, delays in entitlements, development delays, etc. So that's what basically is the real challenge. Top down, if you analyze Indian real estate market, looks really attractive, looks great. Everything kind of checks out on presentation slides, Excel files, Excel models. But when you start to execute an investment plan, an investment strategy, that is where the challenges start coming up. And that's, I think, if we can solve the bottom up and the execution challenges that the industry has, then I'm with Anurag on the fact that sky is the limit and there's a lot of potential in the market as the international investors are going to see. But a mix of these two things, attractive top down and difficult bottom up, is also what makes India an interesting market to evaluate for international investors. Because it's a bit behind the curve compared to other developed economies in the world. And that's why it also throws up interesting opportunities. Now, let's move to the fact that what type of themes do we expect to play out over the next, Anurag said 5 years. 5 years is too long in, right now to predict, given how volatile things are. But in the next, let's say 2 to 3 years for real estate investments in India. So first one is going to be there is a thirst for yield generally, globally. And the reason for that is that interest rates and yields which are available for competing asset classes have been going down globally with the large amount of liquidity which is at play in the global investment markets. So that has pushed the available options for investors in which they can invest into an yielding, income generating, stable asset class. And this is going beyond real estate, it's going into debt, credit, bonds, and those other investment asset classes, investment classes as well. So hence, I think this thirst for yield is going to continue. And even for India, I expect that a lot of majority of the private equity investments and in the real estate space are going to continue to be focused around this income generating / yielding assets. Number two, there's going to be a flight towards quality, which has already been seen over the last few years, whether it be for assets, whether it be for quality platforms, quality operators, teams who are able to manage their operations more efficiently, and across all of these aspects. Because the general market is going to shift and the attention of investors is also going to shift towards people and teams and companies and projects who are able to differentiate themselves on quality. Third part, which I think is again something which is evolving over the last few years, is a customer-centric approach across all real estate verticals. Generally, real estate, I think, has lagged other industries in terms of taking the customer requirements on board and then executing them with the customer in mind. But I think that's changing. I think we're in the middle of that change right now. And I think that is also something which is going to continue. And investors' focus is also going to be on operators and sponsors who are able to connect directly with the customers in the maximum and the most efficient way possible. Fourth theme, which I think is going to be also playing out, is that the deal sizes in India will continue to be large, but the deal volumes will continue to be low. The reason for that, again, is to tie that back to what we talked about in terms of the bottom up, where execution challenges continue. Now, because of that, a lot of investors who've been investing into the Indian real estate space have now also had a long runway of operating in the country. Hence, they understand what type of partners, what type of platforms do they want to go with. And even though the sector has grown considerably over the last 10 to 15 years, but still the number of quality operators are still a handful. And I think they will continue to get the attention, and these larger deal sizes will continue to be mostly in the income generating operating space, like the way we saw in the last year as well. Generally India has been tracking about 4 to 5 billion of private equity investments a year. But in the last year, I think just the large size deals, which is above 150 to $200 million, took up 80% of that volume, whereas the smaller ones, volume was low and value of deal sizes was high. I think that's going to continue. Now, REITs is also another very interesting addition that we've kind of been able to bring to the market, and that's been long time coming. But I think finally it's very good that that's up and running. Very key aspect on that is going to be, again, the focus that we maintain the sanctity and the quality of operators who are there and who have listed REITs in play. Currently, we have 3. I think the potential is significant with the whole market. There is a large potential for it to grow significantly. But if quality is not going to be looked at closely while we grow this REIT and go on this REIT journey as an Indian real estate market, then it can also result in a stop quite soon. It's been seen in previous markets, in other markets globally, whether REITs end up being, either the REIT market will end up being significantly large or it will just fizzle out over time. And the focus on that has happened in India as well in the past. If you see, just before this REIT space has come up in the last couple of years, public listed options for Indian real estate players and operators were pretty much dry for 10 years before that, and which was after the run which happened between 2007 to 2009. So I think again it's a very, very good addition to the market, and I think it opens up a lot of avenues for investors, and it's also looked at positively from an investor standpoint that a country has a operating and spreading and growing REIT space, because it also provides an exit for private equity investors available in the public market. So we need to nurture that part very closely, and hopefully the market will continue to focus on quality and thereafter continue to grow the REIT space as well. Now let's come to asset class investment outlook. Annurag also mentioned his thoughts on a few of these. I'll try and share what I kind of see happening in this space. So let's start with office. A lot of talk around work from home and the downsizing of office space in the last few months. All of us have kind of heard it, read it. I think from that standpoint, it's going to take a bit of time before things do stabilize in the office market. Overall, the market has been resilient over the last 1.5 years as well from an office space. Tenants have continued to kind of and cash flow has continued to come through. But the problem here is that tenants need to come back, and that's going to happen only when occupancies need to go up, which will happen once the vaccination program is expanded and the cities open up more, which will start happening by Q4 of this year. But once that happens, we believe, and we strongly are quite bullish on this sector overall from our side, we believe that the whole technology BFSI segment, which drives the office space in India, is performing really well globally, and there might be actually more inflow of business into India as was witnessed after the last global financial crisis in 2009, when Indian office and Indian businesses got a lot of demand between 2010 and 2013-14, which kick-started this whole cycle about 10 years back. So we think that the fundamentals of the sector will continue to remain strong and it will continue to drive demand. It's actually reached a decent size of its own office with 600-700 million square feet of operating space, decent quality, some of it not, let's say, to institutional grade A quality that we investors will be interested in. But again, the market will pick up and this will continue to drive office. I believe, given the size and the scale, will continue to drive the maximum chunk in the pie of real estate investments in the future as well. But they will be focused on larger platforms, larger operators, because then with their scale and with their size, they will be able to provide better quality service, better quality operations, and better customer focused mindset to their clients and tenants. Overall occupancy experience for tenants here is very important. Operators who are able to focus on that and pick that quality up will stand to gain both from an operational standpoint and also from an investment standpoint. Coming to retail now. So obviously it's been tough for retail over the last 1.5 years, with the shopping centers not operating at all and everybody rightfully staying indoors. But I think as things do open up, which is by Q4 of this year, there will be a strong pullback, which we expect in this sector. We are very long on this sector. We believe that this is a very integral play to the whole consumption story, which is a key evolution which is happening in the Indian demographic space. So we expect a very strong pullback here. Long-term value remains intact, which has also been also seen in across markets wherever things have opened up. I can tell you from example here in Singapore, when things have started to open up a little, retail is back very, very strong and very, very fast, because people need that entertainment and that outing, which is a very key part of how all our Indian cities are structured. Industrial, very strong performance in the last couple of years. This is a sector which was actually lagging behind the other sectors before the last 2 years, I would say. Continues to attract a lot of capital, because this, I would say industrial right now in India is where office was maybe 10 years back. There is a lot of demand, there is a lot of requirement. Whatever stock and whatever projects are available right now are mostly low on quality. That is why there's going to be a lot of development on industrial side. International quality development is already underway. Some platforms and some investment series have already happened, and I see that this will continue to attract both investors and quality operators in the medium to long term. So industrial will remain strong. Coming to residential now. 10 years ago, residential used to be what used to take the largest chunk of the investment from a private equity space in India, maybe 70%, 80% in years. That's gone down considerably. The sector has been slow over the last few years, and I personally felt always that there was a major affordability gap here on this. So a lot of reorganization is underway, whether it be from a regulation standpoint, product standpoint, pricing, as Annurag also mentioned, and even operators. Consolidation is ongoing on this sector and will continue. Customers today have more choice in front of them to choose. The power is back in the hands of the customers. I think this whole investment, residential as an investment market, which used to drive maybe more than half of the sales which used to happen, is reducing, and that's what will continue to be the trend here. End consumers should be the target of sponsors and operators and developers here. And if you're able to find a product which fits in whichever market you're in, which is able to target the end consumer and attract, and also then at the back substantiate that with track record and delivery, I think those operators will find both consumers and investors coming for partnership. We at Xander are continuing to evaluate this sector. We have been approaching this through the credit side, given that we felt that the economics are not so attractive on the equity investment side here for the last few years. But we are tracking this now, and let's see how the space picks up. But I can see maybe in the next, towards the second year from today, if the fundamentals continue to remain strong and operators are able to pivot themselves to focus on the customers here and establish a delivery track record, I can see the equity investment on this space picking up from where it has been over the last few years. Then there are a few alternative asset classes which are picking up pace: data centers, student housing, flexible working, rental housing. Now, all of these are starting from a very low base right now, but they will continue to grow, some of them more strongly than the others, and continue to find their niche in the Indian real estate investment space. And growing as we move forward, I do see that maybe 10 to 20% of investment which happens from a private equity investment standpoint into Indian real estate will start happening towards these alternative asset classes, which effectively a couple of years ago was literally close to zero. Now, lastly, I'll just try and spend some time about what should be the focus areas for sponsors and operators in the Indian real estate space from an investor's side. What are the things that we as investors, while evaluating an investment or an opportunity, would like to see for sponsors, operators, developers, and we ourselves are a sponsor and operator. So these are the things that we focus from our side as well. So firstly, I would say that people should find their niche and go deep in it. Diversification is good, but doing too much at a point of time is also not something which has generally been successful, I would say, in the market. So hence, one or two sectors or segments should find your niche and then go deep into that particular investment theme or sector or segment that you want, because real estate in itself is quite wide and vast, right? So that's how we also think about it. We also focus our investments as investors into one or two or three key focus areas at a point of time, and then we try and spread ourselves out with the other portfolio investments that we do. Secondly, I would say focus on quality over quantity. It's not about doing 5, 10, 15, 20 projects at the same time, but whatever is being looked at, quality is what will get you over the line. I would say in general, the quality focus over the last 10 years has improved. That I have to give to the sector, but still it calls out for a lot to be done. I think in general, as real estate professionals, investors, it's for us to effectively set the benchmark, set the standards, and that will in general take the whole quality of the entire segment and the entire sector up a notch, which is what our target should be. So from a sponsor, operator, developer standpoint, focus on doing quality projects, and then that will also earn you a premium on pricing over competition and also attract investors in the future. Number 3, this is something which we've seen a lot over time, is effectively don't hold on for the best deal or the best price. The market is a moving market. You have to understand what is the core of the business model that you are in, what is the target of the business company that you're leading. You can never time the market, right? It keeps on changing, it keeps on moving. Hence, go with efficiency. When somebody wants to go and do a deal, go for efficiency and speed rather than anything else, because in today's market, things can change very quickly. A deal which is on the table right now for somebody to do might not be there 6 months down the line. So if you just delay it, hold on to it too long, market might change, it might go to the other side. Hence, focus on what exactly is the core of your business model. If it's development, if it's land aggregation, then do that and move on. Move on to the next thing so that you can have, again, and try and triangulate all of this so that you can have your niche and go deep into it. Number 4, I think this is something which is very close to us as a group. Non-negotiable governance, compliance, and compliance with applicable laws. I think this is something which is taken, I would say, a little lightly in the Indian market compared to what we see across other markets globally. All our laws are very robust in India, but we all need to, as an industry, as a team, as a group, focus that this has to be non-negotiable. There should be no discussions around this is okay, this is how it happens, and around those things. It's non-negotiable. From an investor standpoint, I can tell you that anything of this nature is a complete red flag for any institutional investor globally. It has been a bit of an issue for investors investing into India over the last few years. So a bit more focus on this with a complete non-negotiable red flag mindset would help in getting the investment focus, investor interest that you are going for. Number 4, and lastly, I would say technology integration. The opportunity that you have as sponsors, operators to differentiate, innovate. Some of these are very wide statements used very often, but in the new age, as we see things for the next 5 years, what will differentiate successful from the have runs, I think technology will play a big part. And real estate as a sector has been lagging in its adoption of technology. I think the last 1.5 years has given a lot of us, and most of us have kind of spent time on that, I'm assuming. We have a lot from our side at Xander. So I think technology integration into whatever it is, technology can be there in almost everything that is done in the teams that we have, right? So I think this is going to continue to drive focus. Along with this, the last thing I would say, sustainability. It is something that again is coming to become a focus for investors globally, and also operators and sponsors within India. I can see that a little bit. I think if this can also be integrated into the development strategy that somebody is executing, or a plan that somebody is executing, then all these 5-6 things will help in getting investor interest, and also in delivering successful projects, which will end up adding to the bottom line, and also helping through sustainability, through community, through environment, helping the next generation to keep the balance in terms of what is available. So with that, I will just, these are just some thoughts from my side. It's very difficult, as you would assume at this point of time, to predict anything, but I think some of these things, if they are kept in focus in the investment and the development strategies that people are executing, I think they would help the market in general, and hopefully help in creating better quality infrastructure, better quality in real estate, better quality projects over time. So with that, I'll just hand it over to Sapna. Sapna, I don't know if we have any time for any questions, and then we can sign off.
Yeah, that was some very informative address and thought-provoking points that you mentioned, not only the challenges and potential of Indian real estate, but your advice that, the focus should be on specialization, quality of product, execution of product, compliances, as well as integration of technology and sustainability in projects. In short, how has pandemic, impacted investors' sentiments overall, and with reference to Indian real estate? What would you say?
I would say that the answer to this question, first of all, would have been completely different if it was 1 year back, let's say July of 2020, right? August of 2020. So, but now I think 1 year later, I think there is a lot more comfort around the fact that this is a disruption. We will all get over it, and we will move beyond it. From a real estate investment standpoint, I don't think that generally people have not changed their outlook, because real estate is a 5 to 10 year horizon investment outlook, and all the fundamentals still continue to be attractive. People will get over this. Hopefully this whole COVID-19 pandemic situation will get behind us in the next, we don't know when, but it will at some point of time. But after that happens, I think the investment outlook from an investor standpoint is continuing to be positive. So I think that focus will remain, because the fundamentals are still strong, and that is not changing. So even from our standpoint, we took a 6-month pause when this pandemic situation started in March or April of last year. We said for 6 months, let's just see how to react, because at that point you're in value preservation and capital preservation mode, which I think is true for mostly individuals as well, not only investment firms. But after that, I think once people got a little more comfortable, I think by Q4 or Q1 of 2021, Q4 2020, Q1, actually sentiment had improved significantly. But obviously this second wave has now come and hit the country very hard. But I think overall sentiment, long-term sentiment is positive. Till the time this disruption is going to continue, activity is going to be very muted. But that will also come up with pent-up demand at that point of time. Okay. I think globally we've seen wherever things have opened up, investment activity has picked up fast as well. And even the whole movement of people, usage of infrastructure, people coming to offices, people going to retail shopping centers, as even Annurag referred to it in Delhi in the last 4 weeks, numbers are very encouraging. So I think because there is pent up demand, and there is, this whole thing about people to kind of put this behind us. I think that's how our mentality is. We are all optimists at some point of time. So I think once that happens, I see the investment outlook to improve as well.
Okay.
I don't
So
think
we are
any long-term dent in the investment outlook for India. Don't think so.
okay, fantastic. So fundamentals are strong, investors are optimistic, and it's just a short roadblock probably, and we'll definitely be back to where we were, the positive markets. So thank you so much, Arpit, for sharing your time, sharing your views, and I'm sure our audience had some very valuable takeaways from your reviews. Thank you
Thank
so
you
much.
very much, and wish you and the team all the best and all the success.
Thank you so much. Thanks, Arpit. So friends, on that very stimulating note, we had some very, great advice from our keynote address speaker, Mr. Arpit Singh. So let's move on to the first fireside chat session of the day. And the topic is trends defining the growth of real estate in India. The eminent speakers joining us for this session are Mr. Vipul Roongta, Managing Director and CEO of HDFC Capital Advisors Limited, and our very own Dr. Annurag Batra, Editor-in-Chief and Chairman of Exchange for Media Group and BusinessWorld. Before I hand it over to Dr. Batra, let me give a brief introduction of both our eminent speakers. Mr. Roongta has a cumulative experience of more than 24 years in the real estate sector across mortgages, real estate investments, equity, credit, and asset management. He currently manages one of the largest residential financial platforms in India, focused on funding development and real estate technology businesses across the affordable and mid-income housing ecosystem. Mr. Roongta is a member of the Alternative Investment Policy Advisory Committee of SEBI and co-chair real estate of the Indian Private Equity and Venture Capital Association. I now introduce our other speaker, Dr. Annurag Batra. He is a serial entrepreneur, media mogul, a journalist, and an eternal optimist rolled into one. He is a first-generation entrepreneur, and after acquiring the iconic business media and magazine brand BusinessWorld, Mr. Batra has expanded BW BusinessWorld into digital, events, and BW communities. So this was a brief introduction of both our astute thought leaders. Dr. Batra, I hand it over to you now.
Thank you so much, Sapna. We welcome Mr. Roongta. Thank you for talking to VC World and Realty Plus. You've been a veteran of this domain. You started your career with SSBC, worked for almost 5 years there, and then joined HDFC. And in the last, I would say 17 years, almost 17 years with HDFC, and the last almost 5.5 years as the Managing Director and CEO of the HDFC Capital Advisors Limited. You've seen many seasons of Indian real estate. First of all, I'd like you to make a comment on, in your view, how has the real estate investment scenario changed in the last 16, 17 months? So I would like you to start with that, Mr. Roongta.
Thanks, Annurag. May I come to your question, but one small thing. I started my career with HDFC only. So to that extent, started with HDFC
and then joined HSBC
and then came back. Yeah. So, but that's
okay. In your professional profile publicly, the start with HDFC is not mentioned.
That's
right. That's why. So apologies for that. No. What has changed about the real estate sector in the last 17 months? And then we'll come to the investment side. What has changed in your view, Mr. Roongta?
See, we basically look at the residential part of it. So if I maybe talk about residential and or in general in real estate, I think from a supply perspective, obviously a lot of things have changed. So the entire industry is having an unprecedented crisis. The lockdowns and everything had their own series of things. But from a demand perspective, I have in my career not seen more exciting times as I have seen in residential real estate in the last 12 months. And it is extremely exciting in multiple formats. It's extremely exciting because on one hand, there is tremendous amount of interest, domestic investors, international investors, institutions, all kinds of people who are trying to look at real estate. Because what happens at a global level, generally, see, any crisis means that there is a natural tendency for everybody to move into real assets. Real assets is real estate and gold or any metal. And there's a tendency to move away from financial assets. And if you see, the direct consequence of pandemic has been that everybody has realized that I don't know of too many, of probably anybody in scores and scores of people we meet who does not want to upgrade their house. A person living in a very big house says, I want to live in a farm place. A person living in a farm place says, I want to live in a managed place. A 2-bedroom guy wants to shift to 3, 3 wants to 4, or they just want to have a small office nearby. And there are multiple factors for it. Work from home is one factor. There are a lot of other factors related to perceived wealth, because stock market is done so well in India. And most importantly, because the general size of units available has gone down. So there are multiple factors, but net 17 months, I think things have become much more exciting than they were 17 months back.
You're right, in the residential sector, in my view, 4 things are driving real demand. It's not an investor-led demand. It is end-user demand. First is the fact that homes have become offices, so you need additional rooms. So if you have 2 children and 2 working professionals who are parents, then you need 4 rooms at least, which may have been 3 or 2 bedrooms earlier, but you need now a separate office space for each of the working parent, and you need a separate school space, or if schooling is happening from home. So really you need that. Second is millennials for the first time have moved from a sharing economy where they were traveling by Ola, Uber, and working out of co-working spaces and working out of lounges, to actually working out of home. So they spend actually a lot of time at their home. So, and they have savings. The third point is because in the last 17 months, people have saved money. Indians like to save money for the rainy day. So they want to channelize that money into a house, which is a real investment. And possibly, Vipul, you can comment. This is for you talk about metals and gold. This is the first time that the stock market is booming. Property market is looking to bloom, and gold prices are up. Right. So, everything seems to be, while there is COVID and there is concerns about the growth of economy and concerns about the third wave, everything seems to be booming. Look at the IPOs. So now coming specifically to residential real estate, and you wanted to make a comment, Vipul, on everything booming. I said the stock market is exuberant, the gold prices are high, and the real estate demand is very high, especially amongst end users. If you look at markets like Bangalore, markets like Bombay, actually the number of property transactions is growing steadily.
See, Annurag, I don't have a very exciting, while the market is exciting, I don't have a very exciting job as yours, because if the background is an indication, you have a much more colorful work. Our background is that we just like to keep it simple. I personally am a big advocate of just keeping it very simple. I think the boom is primarily because there is so much money here. So much money is being printed, so much money is there because of savings or whatever it is. If more money is chasing the same set of things, obviously prices will go up. Rationally, irrationally is a function of cycle. But that, in a nutshell, market obviously never remains at mean. Either it's over exuberant or under exuberant. So that's fine. That's part of the cycle. But that, in my opinion, explains, and it's not in India. I think real estate is booming across the world. Any place which is politically decent and there is no major action happening on the ground, the real estate is booming. So India is no exception. And you add to that the young population and the growth and so on and so forth. A lot of these presentations and factors are known to everyone. It makes a very heady cocktail. So that's the reason.
Vipul, as an investor, as a very large investor, as a seasoned investor, who's put almost 20,000 crores in the Indian residential real estate market, worked with some of the best developers. In some cases, I would say that your investments have made sure that those developers became who they became. So give a sense, how has things change. The more things remain the same, the more things change. What has changed?
Okay, so coming from a developer perspective, a lot of things have changed. Obviously, I think Arpit mentioned it earlier, that just the equity that a developer was putting into a project would be as low as 5 to 10%. Today, that equity is significantly more, 2 to 3 times in new projects. Earlier, the large part of financial closure was customer receivables, pre-sales, or whatever it is. That has pretty much gone out of the window. A big factor of that is what you, Annurag, just mentioned. The entire 2008 to 2000, maybe 2006 to 2010, 11, 12, barring the 8 to 9 period, if everybody that used to have any surplus income was punting on buying under construction apartments and real estate investments. 2015 to 2019, 20, I don't know of too many people who have not got a stuck project if they have invested in residential, where they have punted on some residential project somewhere and it has not done well, or they've been paying interest and so on and so forth. There are scores and scores of cases like that. What it is indicating and what has changed is that the investor is pretty much out of the market. And that has resulted in more equity in the system, whether it's a developer or it is private equity funds or it is just doing things. That's one. Second, if you, it's funny, but if you drive from the airport of any big city 5 years back to say your office or wherever you're going half an hour away, whether it's Delhi, Bombay, Bangalore, Chennai, Hyderabad, 5 years back, the advertising hoarding will be giving you aspirational homes, $1 million homes, $500,000 home, depending on where you are, where you have very jazzy, it's basically sky is the limit kind of a aspirational home that is being sold. Today, if you go in the last 1.5 years, it is only value. They'll say 20 lakh rupee home, 60 lakh rupee home, 90 lakh rupee home, 2-bedroom for so and so. Why? And that is because you were earlier selling to investors. Today you are selling to the end user, and end user is value conscious. End user will ask relatively stupid questions like, when will I get my possession? He'll come and visit the property 3 times. He will ask what is the EMI and all those things. And the way the selling happens, the customer, everything has changed. And that has resulted in a complete change in mindset as to how people are looking at things and how business is done. So from a developer perspective, a lot of things have changed. We just talked about, we track something called unit price by annual income. Unit price, average unit price of a home by annual income is the lowest ever. It is not that much money chasing. It is not anything else, but just that the unit prices have gone down and the incomes are what they are, or they have increased to that extent. And that is at an all-time low, which is creating this entire optimism around residential.
Just to ask, see, when you're investing new money, apart from investing in your existing investees, existing portfolio, because they may do new projects, you believe in them, you have an ongoing relationship. When you're looking at new investment opportunities, what are you looking at? And give us a sense of some of the new investments that you are making, if at all you're making.
So we are doing a lot of things. I think we are at probably the start of what would be a very, very decent size cycle in real estate, because a lot of stuck projects which were stuck are getting resolved. I don't know if it's still not public knowledge, but the first set of residential projects or projects have got through the NCLT ecosystem. The first 2 or 3 projects have just got released in the last 3 months, which is tremendous, because I think it's a great thing. Once, it has taken its 2 years of NCLT and courts and so on and so forth to get it done. But now that the first set of projects are out, more and more projects will get resolved. When we look at any investment, our focus is counterparty. Our focus is, I think Arpit mentioned, obviously governance, but more importantly, when one factor that we look at very, very keenly is whether this person has the passion to develop something which is very, very different and is listening to the market. See, it's a very unfortunately, most of the developers have a land up approach. They say, I have access to a particular land parcel or I have access to a particular area and I'll get an approval in a certain format and I'll make X amount of money from it. I need funding. That is not business. That is asset making. What we are focusing on as an organization in HDFC Capital and the group is to support developers who say, I want to do a series of such assets. I am looking at where the customer is going. And in that, keeping that factor in mind, we have invested in about 8 or 9 platforms, 9 platforms on with marquee guys doing, can you make say a 30 lakh rupee home 30 minutes from the city center of a major city, top of the line. So it is something which everybody used to live in, probably a bulk of the middle class of India used to live in 10 years back. And then the sizes kept going up and the affordability went out of the window. That affordability is coming back, as I'm telling you, vis-a-vis the ratio of unit price by income. But it's a supply driven issue. It's a completely a supply side problem as far as the industry is concerned. If we can plug the supply play, which is happening, then there is no demand problem. Now the issue comes is, can the developer make money? Because ultimately I'm a fund, ultimately the entire banking industry is saying what is the margin? The traditional logic is if it's affordable housing or if it's mid-income housing, the margin is low. That low margin with high volume works beautifully. And that is something that we are looking at, that is the developer looking at making it a business or is he looking at doing it as an asset? And that is what is actually the big driver as far as I'm concerned for looking any investment.
Now, this is a real estate investment summit, so I'm digressing, but it is what do you think of prop tech and real estate tech and startups that can work around the ecosystem of property, whether it's residential property, commercial property, retail, warehousing, and in some way be strategic value drivers for it? What's your view on it, and what are you doing to be able to nurture this ecosystem?
See, Annurag, I'll quote a friend of mine, not directly, but I quote a friend of mine. They said that out of the 28 industries across the world, when they did a survey on what has been the impact of technology, and real estate was second from last, just above animal husbandry. And that I think kind of sums up what is the kind of potential as far as the industry is concerned. I think prop tech per se is an overhyped term because it's pretty much like AI. So everything which is common sense is now dubbed as AI. Anything which is slightly tech is considered prop tech. I think the big thing in India is going to be, as a developer, is this particular technology or whatever service thing that is being done, is it adding value to me? Is it is it creating a difference to maybe make the same thing faster, cheaper, or whatever it is? And the very simple answer to that is yes. The problem is that the startup ecosystem still, it's a chicken and egg thing. The startup ecosystem is saying, I want the developers or banks or so and so forth to adopt these new innovations. The developer community and the banks are saying, listen, that's fine, but plus prove yourself. The first question we run a program called HEART, which is on HDFC Affordable Technology Program. We have about 19 companies under that, and we add about 10 or 15 a year now. The single biggest problem today in a hyper bull market is not to, it is not actually not raising angel funding and pre-series A and series A. It is getting business. Because ultimately all these valuations are only assuming one thing, that the person will just scale up. How will the scale up happen? Scale up will happen by adoption from the industry. But the industry guy says, listen, first you prove yourself. First question that he's asked is, who are your other clients? Now, as a startup, if you're asking me who are my other clients, then he says, listen, I want to move in. And I think it's a confidence issue. The industry says, I want greater confidence so that I can put this in my ecosystem, because as a developer, I have enough problems. I have a RERA issue. I cannot afford that a particular thing is not done in a particular manner. And obviously the startup has that problem. And I think what it requires is confidence drivers. There are 2 or 3 organizations which I think are doing a very good job in terms of bridging that confidence gap. And that is what I think the role of a venture fund or industry bodies is, or say maybe organizations like yours, Annurag, to bridge that confidence gap, highlight what is the right set of things and take them to the right level. And that is going to define in the next 1 to 2 years how real estate is being done, because the top line is fixed. The only way I can increase my margin is by higher efficiency. Higher efficiency can come from scale, but it also has to come by process related efficiencies. And that is where PropTech will come in.
Questions for you. One is in terms of quantum of real estate investments. Over the next 12 to 18 months, what kind of money from institutional investors you see going into real estate, and in what pockets? And for simplification, I'd say, I know you're a residential player, primarily residential, commercial, retail, and warehousing. Warehousing also as a sector is seeing, because e-commerce is growing, a huge demand. So give us a sense, if 100 rupees was invested in the last 3 years, or the next 12 to 18 months, what kind of money are we looking at? I mean, if you could give your example. And second question was, which is a larger question, is clearly there is value in all new age consumer tech startups, but the valuations seem to be high, and what is your view? There's no question that there is value in those startups. It is the quantum of that value, right? So the first, in the next 12 to 18 months, what is the kind of money you're looking at investing in the Indian real estate sector, and what do you think overall will happen? And second is the valuation of startups in India. What is your view on that?
Okay, so I'll go for the first one first. X amount of money has been invested in the last 3 years. Okay, generally it is always taken as what is the money that is coming from private equity funds or what has been raised in the public markets. That number will be 3 times in the next 18 months. And the reason it will be 3 times of what it has happened. So it's, in a half the term, it will be 3 times. So we are talking about 6 times the amount of money that is coming that year. The reason for that is, one, the pandemic again has changed the view of a lot of sellers. On the commercial space, you see maximum amount of money that is coming, whether it's commercial or it's warehousing. I think retail, the game has not yet started. It is beginning. While I said that we are doing residential, but we have very strong linkages with all these things. And in fact, we are just doing a very big platform on the logistics side. But the money is coming because there is today a willing seller who is ready to climb down on the price, because he has seen the pain that last 18 months of pandemic has done. And that is why, because there is a willing seller who is willing to come down, there is enough capital. That is because the cost of capital globally has gone down. So anything that is income accruing will come up. I think there is a lot of scope. There is enough number of assets that are there today. Only on the residential side, if we say, there is a lot of last mile thing, but that is at very high rates of interest. On the commercial side of things, most of the ready stock is pretty much owned. So now the entire thing is related to build to core. On the warehousing, there are about 11 platforms that I know of that are already there, trying to build more warehouses and so on and so forth. But the scope is definitely there. Commercial side, the new plays, obviously the data center thing. yesterday also one big deal happened, and a lot of action is there because you just need so much tech, you need more servers, and you need more efficiently run ecosystems. So retail, I think, will bounce back. It can be in multiple formats, but it can be in more street formats and low-rise formats and so on and so forth. But because the prices and the general value has gone down, it will come back. I still feel I think you somewhere asked as to what we are looking at. We are looking at, we are about $1.5 billion today. We are looking at deploying an additional $2 billion over the next 2 to 3 years. Only in the residential space, we are looking at a whole series of things in the commercial space, in rental housing, logistics, but more on the rental housing and logistics space rather than pure play commercial. That's as far as what we are looking at. On your second question,
that's a big confidence in the Indian real estate sector, especially the residential sector. And I know you are very bullish, but you're at the same time very calibrated and I would say conservative. You want to go for good quality assets. You had a good run in terms of where you invested. So clearly, if it comes from you, that means a big thumbs up to the Indian real estate sector, and especially the residential sector.
Thanks. Coming to your second question, Anurag, related to valuation of the consumer tech. See, while I'm no expert in terms of commenting on whether it is overvalued or not, I am a little bit of a old market guy, but I can assure you that we haven't seen the last of these valuations, or there is so much stuff. If I bring this consumer tech again in the context of real estate, if I own a real estate customer, if I am selling as a developer, I'm selling a home to a person. It is actually the mother of all sales, and it is a mother of all buys that the person is making. It's the highest investment that generally that person is making in their lives. The kind of consumer-centric businesses that can be created out of simply the sale that I'm making, the industry is not using at all. And today I am selling the home and I'm just looking at the margin that I'm making on the home. Actually, I've sold home loans for 7 years in my life, and I'm still in touch with at least 50 people, 15 years, 17 years later, whom I had sold home loans. Because they remember that, listen, when we bought the home, you helped us get a loan. Whereas, I was probably just a front office guy processing a loan application. And I can relate to that sentiment because home is still a fairly emotional buy. And that is something that is not being leveraged on the consumer tech side. While I know I'm not talking about the valuation part, but just imagine if the largest or the big developer today is talking about the fact that, listen, I'm selling X number of homes, but more importantly, I am plugging in thing for selling services to all my buyers. The value that the same developer can make on that is significantly different and more than what he's making by making the margin on selling that flat. And that possibility, in my opinion, is driving the valuation. The same logic applies to whether it's ordering food or it is doing micro financing things or anything of that matter. But I think like everything has its cycle. I hope it is not that much a cycle. But the moment I can, on an Excel sheet, justify the drag and compound it by 50% and do it over 10 years and then discount it at 15%. So if I'm compounding at 50 and discounting at 15, the net present value of everything is at least 5x of what we are talking. And that is what is, I think, driving the value, right or wrong, coming from traditional thought process, more wrong than right. But, I've been proved wrong a lot of times on this issue. So I will not say, but I think the potential to make money by doing this consumer tech, by cross-selling different things, is significantly more. It doesn't matter what the value is. What matters is what value I am making on my P&L. Value of my company doesn't matter. How much money am I making as my PBTs or PAT is concerned? That is more important, I think, in the long term.
I think because these are early days of consumer tech, I don't think investors are looking at it. They're looking at the future potential. They're looking at data. They're looking at consumer acquisition, and they're looking at there is a scarcity premium also, I would say. And clearly the markets are exuberant. So combined, you get what you get. I'd let you go by asking you if you had to make one prediction about the real estate market in India, what would that be?
I think real estate has lost its so-called sheen in the last 5 years as an investment class from an individual perspective. And the one thing that is going to happen, and is already happening, I think the tide is turning. It will become a major investment class because it is anyway the big portion of the net worth. It will become an attractive investment class in that 12 to 18 month period that you mentioned. And that, I think, will change a lot of things.
Thank you so much, Mr. Vipul Roongta. That was Mr. Vipul Roongta, Managing Director and CEO of HDFC Capital Limited, who's invested about $1.5 billion in the Indian real estate sector as an institution, and primarily in the Indian residential sector, saying that Indian real estate investments will become attractive for individual investors. That augurs well. He also talked about the fact that the price for end consumers is the lowest in a long time, and that will drive actual demand and continue to drive the uptake. These are significant trends, and I'm sure as we talk to him more and again, we'll be able to decode some of these trends. Thank you, Mr. Roongta, for talking to us. We look forward to more interactions with you. I'll hand it back to Sapna Srivastava, who's the editor of Realty Plus, and I'm sure we'll engage with you soon. All the best. Happy investing.
Thank you, Annurag. Thank you, everyone.
Thanks, Mr. Vipul Roongta. Thanks, Dr. Batra, for that very interesting conversation and some very pertinent points that were raised in this conversation. Thank you so much for your time and for your viewpoints. Let's quickly now move on to our next session of the day, which is the panel discussion on alternative real estate debt, risk, and prospects. And let me introduce our panel for this session. The session will be chaired by Shobhit Agarwal, MD and CEO, ANAROCK Capital. Shobhit is a visionary entrepreneur with professional excellence and experience of over 20 years in real estate investments. And at ANAROCK Capital, Shobhit steers the strategic direction through the various investment verticals. Let me now introduce our eminent speakers in an alphabetical order. I welcome Mr. Amit Diwan, Managing Director and Country Head, Hines India. Amit is responsible for all activities of Hines in India, including fundraising and deployment, joint ventures, project development, asset management, partner relations, and exits. Hines India currently has a portfolio of more than 2.5 billion AUM across 10 projects, totaling 14 million square feet in 4 cities. So a huge investment fund that Amit is taking care of. Our next eminent speaker is Mr. Chetan Shah, Executive Director, Kotak Realty Fund. And Chetan oversees investments across all realty segments with special focus on commercial as well as residential, mid-income, and affordable housing. He has more than 2 decades of work experience in real estate, fund management, debt, and private equity. Our next speaker, I introduce Gaurav Karnik, Partner, Tax and Regulatory Services, Ernst & Young LLP. Gaurav is the national leader for EY's real estate sector in India and is partner with the tax practice. Gaurav is actively involved with the central government on policy matters related to the sector and also serves on real estate committees of various industry associations. Our next very eminent panel member, I welcome Mr. Ritesh Vohra, Partner and Head, Real Estate, Investcorp India Asset Managers Private Limited. Ritesh has been a financier, advisor, and entrepreneur over the course of his real estate career and has been associated with a number of property developments across India. So, Shobhit, I hand it over to you now. That was our very eminent set of panel members.
Thank you, Sapna, for the kind introduction to me and to the fellow panelists. Thank you, Realty Plus, for having all of us over. It's a very interesting subject, alternative real estate debt, risk and perspective. Before I start the panel, and we have a very eminent panel and I'm looking forward to their viewpoints on this. I just want to give a little background, saying, look, back then in 2005, which is where you start looking at what's happening at real estate, the banking or the lending was all done through traditional banks, private sector banks and public sector banks. Public sector banks held the most amount of loans, the likes of SBI, Union Bank, Bank of Baroda, etc. Then came in private equity in 2005. It fast-tracked construction activity in India. Lots and lots of new projects were announced, all different kinds of projects. And I guess it complicated life for PSU banks. They couldn't understand. And by 2012, they started to shy away from Indian real estate. Because they couldn't underwrite the risk, they couldn't underwrite the time. RBI was coming down heavily on them. So the whole music slowly started to shift towards NBFCs. And for the next 7-8 years, it was the NBFC era. It continued till 2018. When we look back, almost 2/3 of all loans extended to Indian real estate were by NBFCs till the music stopped when the IL&FS crisis started in 2018. After that, it became extremely difficult for NBFCs to raise money, and therefore, consequently, they couldn't do onward lending. And my view is that has triggered the era for AIFs. So from 2018 to now, there have been over 60 AIFs. A lot of AIFs were set last year to take advantage of this situation and leading to what we would classify as alternate debt that they're taking up, right? Anyways, as I mentioned, the market on the lending side was shrinking. We already are reeling under acute shortage on housing. We have a lot of mile to cover if we have to provide housing for all by 2030. I know the interim target was 2020, but 2030 is a realistic target. 25 million dwelling home units we have to build by then. And most of this is at the bottom of the pyramid, which is affordable and real affordable sector. Now, real lenders, PSUs, who have the largest pie of deposits, are still shying away. Then there's private sector, then there's NBFC, which has no money. So I'm going to straight come to a point and I'm going to start with Ritesh. Ritesh, with wafer thin margins, highest volumes, how and what way this alternative debt is going to solve the problem for construction finance for affordable housing, right? You can't charge 18, 19, 20%, which is what the current clearing rates are for debt for real estate. How does that work? Ritesh, over to you.
Sure. Thanks, Shobhit. Morning, everyone. So, Shobhit, hopefully you've given me the answer to the question in the question itself. My short answer to you is that I don't think alternative debt is the solution for the kind of housing that we're talking about over here. See, of the 25 million homes that you spoke about just now, over 90% would fall under the category of what we call social housing, which is, we're talking about homes which are 5 lakhs, 7 lakhs, certainly sub 10 lakhs in terms of in pricing. This kind of housing, in any case has to have, and it does have infrastructure status. And, it can't be made possible, certainly in most of urban India, without some kind of government support. So my sense is, alternative debt, which is priced at a certain level, which is looking at a certain risk profile, is not
like this most suitable capital solution for this. It's also, Shobhit, you would agree that there aren't too many bankable developers who are actually active in this segment. And again, that's for a reason. You buy land commercially, you try and develop it for social housing. It's simply not possible. The numbers don't work. There has to be some kind of government incentive, a scheme, some land, some grants, etc., for the numbers to work. So my sense is, this is not a segment where alternative debt can come in. This is a segment where,
social,
fairly long-term, low-risk kind of debt can come in, because, this is something where you literally have no sales risk. If we can build houses in Bombay reasonably located at 10 lakhs, 12 lakhs, they'll get sold out, right? You'll have to do a lottery to sell. No sales risk, but there is a lot of execution risk in terms of getting your pricing right and so on. So I think I would repeat, alternative debt, not for this, but probably for the segment above this. If you're talking about the lower mid-market kind of housing, we're talking about, homes which are, let's say, between 15, 20 lakhs to going up to 30, 35 lakhs. There, I think, there's been enough activity already where you're talking about commercial developers, commercial projects. By commercial, I mean for-profit projects. Alternative debt has a role to play over there for sure. On the social affordable housing, I think what is probably needed is maybe more equity type investments and setting up platforms with larger developers who can then demonstrate that credibility for the government to support such projects, and for people to sort of participate actively in terms of developing such kind of product. That would be my view.
Thanks, Ritesh. But just challenging you on that a little bit, saying if debt can't be afforded by this segment, how will equity come in? Equity is typically the most expensive form of finance, and how will equity go into affordable, and therefore the bottom of the pyramid? I'd love to hear your views on this.
Sure. So by equity, what I mean is really longer term capital, which will, like I said, right, this is a relatively low risk proposition in terms of development activity and sales activity, providing you've got your numbers right. I think if there is a credible equity player, there is a credible development partner, you have the ability to go out, seek the right sort of set of incentives from any local government, state government, and go on and build this product. This is also a product where you really need to be able to demonstrate execution because volumes are high. Your customer will not have the patience, to wait an extra 1-2 years for delivery. So I think, and maybe, Shobhit, maybe, just to backtrack a little bit, maybe it's not pure equity. Maybe we're talking about
equity,
impact funds. Maybe we're talking about those kind of, sources of capital, which can come and take a longer term view. I think it can be made profitable for equity because, there is value in this space. But I think it's a longer term game. It cannot sustain on, debt at 18% or 17% and so on.
So yeah, you're saying there are margins, but you have to play scale, you have to take government support and government intervention, and maybe perhaps the impact funds are the right target audience. I'm going to bring in Chetan at this point. I mean, you have done a lot of debt. You guys were the first to do NCDs and debentures way back in 2008, I suppose, or 8 or 9. And you guys have been innovating structures for lending in real estate. So what's the newest? What are you guys up to? How you are playing this market between senior secured, last mile, and yet being able to deploy successfully? What's the mantra, risk versus returns?
Sure. Yeah, thanks, Shobhit. So I'll just, give a brief background about what Kotak has been looking at from a RE fund business perspective. So we started our business somewhere in 2005-06 when the FDI opened up, and till date, I think we have raised about $2.2 billion over 10 different funds. In February, we raised another fund with a $380 million corpus where we are looking at investing in credit strategies across all the real estate classes. See, I think the idea is where these investors come from is more from the fact that as a fund manager, they are looking at, one is what is your specific strategy of deployment in terms of the asset class, in terms of the stage of investment, in terms of the returns targeting, and most importantly, in terms of how are you planning the exit. A lot of these fund managers are having strategies around deployment opportunities, but they are not able to convince investors across this life cycle of the investment, holding the investment as well as the exit, which is a crucial part of any deal returns. So these investors, the way they are looking at us in specific is because given the experience across these years as well as the strategies across all the asset classes. So we will have a pool of assets or pool of funds available for deployment in equity, in debt, in commercial, in residential, in retail. So we are, if you ask me today, we are catering across all the asset classes through different strategies of funds. So each of the investor who is coming in is very clear where my money is going and what is the kind of return I should be expecting. Having said that, I'll take Ritesh's view also that we have also had investors who are, impact investors and want to invest specifically in an affordable housing asset class. So we have a fund catering to that also. So it is always better to have specific strategy focused funds rather than just one pool of capital which is going everywhere, be it debt or equity or different asset classes. So strategy specific is one key word or the key mantra which I would say. Other is also, if you look at the the kind of opportunities which are there in the coming years, right? I read somewhere that Oxford Economics is saying that the INR depreciation, which is a key factor for all these global institutional investors, is targeting the INR dollar is targeted to be around 74, 75 levels till 2030. So there is not too much of depreciation expected in INR. So that is another key factor when an investor is looking at, is apart from the opportunity and the returns per se, is my value of the dollar getting impacted when I exit or not. So that's something which will also give confidence in the next 2-3 years is what we see. So these kind of things is somewhere we have to focus on. Shobhit, just to cut the long story short, is somewhere have a specific strategy-driven investment focus, as well as looking at what the investor is also needed. For example, if you see, just taking up one step forward here, we also have a different type of investor catering to managed accounts. So we say that if there's a single investor who wants to put a large sum of money, we'll have a single pool of capital and we'll manage that. So where the investor will also participate in a decision-making process remotely in terms of saying that this is the strategy, this is the kind of investment we are looking at. And the managed account also works well for us.
So Kartik, if I have to, Chetan, if I have to sum this up, you are saying that you have different pools of capital for different asset classes within real estate and catering to very different risk return profiles. So all the strategy is very different to Resi and so on and so forth. And that's how you are able to manage and deploy sufficient money. Talking about offices, just moving on from Resi to office, Amit, can I bring you in on this? I think it's widely known that in the office sector, in the near and short term, there seems to be some risk owing to work from home, work near home, and new concepts that are emerging. But if India has to grow at even 5% or 6%, growth in office sector is inevitable. So long term seems like it is intact. But how do you think this is going to impact fundraising, especially debt, for commercial real estate? I'm assuming you are the best in this group to talk about offices.
Wonderful. Now, thank you, Shobhit, Sapna, Realty Plus, Business World, and good morning, everyone. Shobhit, my response on this is going to be from a combination of my experiences in various roles in the real estate sector. So, as a management consultant, I was advising, Temasek on their investments in Capital and Mapletree Capital Corporation. So, I've seen those companies borrowing in Singapore for real estate. And then at GE, I was a lender in Singapore for real estate. At Piramal, I was a lender in India. And now at Hines, I've been a borrower for the last 6 years. So I've seen both sides and in multiple geographies. And let me just start off by saying there are no new challenges. Shobhit, capital is always available. The requirements of the lenders have been exactly the same since time immemorial. You need a logical project and business plan. You need a high quality operator that you can trust, and you need to have confidence on the execution. You've got those three places, three things in place. Money is always available. Now, from time to time, there will be slight new differences. And if anything, I think the challenges are actually fewer today because the lenders are flushed with liquidity at the lowest ever interest rates that I have seen in my time. So, there is capital ready and available, but the borrowers and the lenders have a very interesting dynamic. Both need each other a lot. Obviously the borrowers need capital to get financial closure, but the lenders are always looking for good quality opportunities to put their money and deploy the money. I think, as you rightly said, the office sector is in the middle of a shakeup, and this will continue, I think, for an extended period of time, multiple years is my sense. And I completely agree. Long term, the strength of the economy, the growth will take over. But one thing that will happen in these 2 or 3 years is a unquestionable flight to quality. So the occupier who's ultimately driving the value in the office sector is going to choose better partners, better landlords, and better projects. And as a result, the developers who are kind of manufacturing or owning, or the capital that is owning better projects, will get funding more easily. But yes, in the interim, next couple of years, as long as the uncertainty prevails, liquidity will be available more for lower risk situations. And that lower risk is a perception of the lender themselves, what risk they want to take and what they don't want.
Thanks, Amit. But I want to ask on this note, when you're saying lowering the risk as a perception, would you say doing DMs with firms like yourselves for office developers, does the perception have an impact on the lending side? Because the lender continues to be the current borrower, current developer. However, you're managing his project, you're doing the right things, right? So you come in as an expert on the asset. Does it lower the risk? Does it become more bankable?
Yeah, I certainly hope so. Experience so far has been very positive.
Okay.
Most of the DMs, if you see, we've done with credible counterparties, but who are also facing increased competition from institutional owners of product today and very high quality pan-India, well-funded, internationally funded developers. So the competition has definitely become stiffer in the marketplace. And what we're trying to do is contribute the 2 cents that we know, which is more on the operating side. Risk is generated, obviously, bad location or a incorrect concept or bad contracting, incorrect financial closure, monthly, cash balances, and then, not having network with the tenants or credibility with the tenants. And, there are some of these parts where we can add value. And, so far we've been blessed, lenders have looked at us quite favorably. And I certainly hope that continues in future.
Thanks. So you are saying you are managing the risk as far as bankers are concerned. So it's to be viewed a little bit differently. It's not just about putting the Hines brand, but basically what that brings in is the credibility for the lender, and therefore lowers the risk on the project. And
yes, and absolutely, Shobhit. And let me add just 2 quick comments on that. In fact, Hines does not add the brand. In the 1,700 projects that we've done around the world, there is no one Hines tower. There is just, everything is neutrally branded. So the brand is not on offer, it's the expertise. But the second and more important thing is, lenders, when they were sometimes, in competition were lending on the basis of, comfort from the parent group or the, guarantees. Uh, is it really enforceable? I think that's where the realization is. The money is going to come back from the project fundamentals. And what we are trying to do is help the project fundamentals, not really change the positioning or the naming of the borrower.
Super. So I'm going to take that language of profit is common everywhere. So you increase the profitability and therefore make it more bankable. Gaurav, I'm going to come to you. We've been living in troubled times, COVID-1, COVID-2. And most of my developer friends at this point are collectively looking to raise money. I see very few people who don't want to raise money, but they all have cash flow challenges, more in residential, but equally in office is becoming difficult to convince about leasability, when the lease is going to happen. Are the markets going to open in September this year or December next year? So all these questions, what according to you, and you're sitting in a very unique position, are some of the challenges that the developers are facing in raising this capital, and what's the work around, if I may ask? How are you advising your clients?
Yeah, thanks a lot, Shobhit, for having me on this panel as well, and to Business World. I think a couple of things here. Track record of the developer is very important. A number of investors, lenders have either put money as equity or debt, or banks have lent, and a number of them have burned their fingers quite badly. So when they look at any of the projects, I think it's the track record of the developer, and that how well has he executed on projects. And when you're bringing projects to a particular lender, I think the point is that what is the way you're going to go execute it, how you're going to make sure cash flows happen, what is your marketing strategy, how good are your completion strategies in the past and going forward, things like that, which show them a path to cash. Like Amit said, in the past people gave money based on parent guarantees, promoter guarantees, etc. But it's not that it has worked. We have so many cases which have landed up in IBC because the way the money has been circulated amongst projects, buying new land, not completing projects, has created a whole sense of discomfort. So when lenders now look at projects, they've learned a lot, so they want to be very clear that they're just lending to this project, and they may want to make sure that the cash flows are pretty visible, and how fast are they going to come out. So I think developers have to get that house in order, and I think to that extent, what Amit said on you were saying also on DMs, and or some consultant, whoever can manage the project and manage the project cash flows, that becomes a very important factor. The second part is, I think a number of the distressed foreign funds who are looking at like distressed projects, they don't really have people on the ground, and although they have pool of capital dedicated to India. So when they are going back to IC, they are competing with various projects in the region. So the projects which they lend to in India have to give them that definite return, and therefore all this comes into perspective as to how good the project, how good the reputation of developer is. Otherwise, there can be a pretty significant challenge in lending or putting money in such projects. So I think these are the 2-3 things that we need to look at when we are going to look for more money from various funds.
So you're essentially saying that banks have moved away from name lending to really evaluating the projects on merit, looking at partnership risk, looking at execution risk, marketing risk, and then pricing it, rather than saying, okay, because I have corporate and personal guarantee, I don't really care about the project. I'll get the money from the corporate or from the personal. So I think that's changing. And clearly, I agree with you that that's kind of going away. You also spoke about hedge funds that are quite active on the distress side. And I'm going to go back to Ritesh. Ritesh, you've done a lot of last mile financing for stuck projects or stalled projects. And government has also set up an AIF in form of Swami. But that's quite straight-jacketed. There are 20 criterias, and you meet those 20 criterias, you qualify, and you can get that money reasonably priced. It's super senior, even in case of IBC. So there is a certain risk that has been removed. But for rest of the India, right, that risk remains. And by the own admission of, if Swami is to be believed, they are funding 1 in 10 proposals that they're getting. So what happens to other 9? How do they arrange money, and what's the risk return profile of these developers? How did you tackle it?
Sure. Thanks, Shobhit. So, it's like every market, right? There's a whole spectrum of developers, there's a whole spectrum of projects, there's a whole spectrum of risk that you're dealing with. There is a certain profile, a certain checklist that meets the requirement for, let's say, someone like Swami. And then there is a certain profile and a certain checklist that meets the requirement of the hedge funds or the distress funds that Gaurav just mentioned. I think, and of course, Shobhit, we all know there are a vast majority of projects that don't fit anywhere on this spectrum.
Yes, absolutely.
Right? Which are, these are like abandoned projects or orphaned projects, if I can use that terminology. The developer does not have the capability to finish. No lender has the confidence. The buyers have lost the confidence, and largely talking about residential over here because that's what the problem is largely. And I think any lender who's looking at coming into this space obviously needs to have a very clear-cut idea of what they're looking for and what risk versus return threshold are they sort of solving for. It should be obvious that a last mile financing should be lower risk because you're coming into a project with a fairly high degree of visibility. Probably it's half built, half sold. Usually land approvals are in place, obviously, because it's already reached that last mile scenario. But Shobhit, you'll be surprised that there are so many challenges that come in such projects as well. Forget about half built or last mile projects. We've seen it, and I can quote from personal experience of funding projects with occupancy certificates. Okay, now it can't get safer than that in terms of a textbook requirement. Projects with occupancy certificates can also face issues, and we are dealing with one such issue right now, where because what happens in these projects is there's a lot of history. So, what was promised, what was delivered, landowner, developer, JDA, all kinds of things can sometimes open up when a new party sort of comes into the picture. So, I would say to you, Shobhit, there will be many, many projects which will not get funded. People will have to find solutions around it, and these solutions in India take their own time, more than anything else. Again, we've seen scenarios where projects which were totally non-fundable by any institution have been resolved by, existing lenders stepping up a little bit, finding someone else to come on and do the execution, just, infusing that confidence capital in the project to just get it going, where, existing buyers then start to support through cash flows. So I think it's a mixed bag. I don't think that every project which is in distress will get funded, and there will be many which will probably never get developed. And I think will just be a sad story.
So you're saying it's a little bit of an illusion in terms of approvals and sales and construction. And I'm going to bring in Chetan from Kotak. Quick question, like Amit mentioned that perhaps doing a DM in offices eliminates a few risks. He brings in the expertise, the solutions on the office. How necessary is it to change the developer to be able to fund some of these tough projects? Unlike Swami, which is saying, I will complete the project under the same brand and then sell it on completion. Will you do this, or have you done it? How critical is it for you that we bring in a new partner as DM?
So, Shobhit, I think the crux of the matter, which Ritesh also touched, is when an incoming lender or investor is investing on a last mile or a stuck project, one thing I want to kind of highlight here is the kind of allowances. So every stuck project will have maybe an existing lender there, which may or may not be completely refinanced. So the idea here is the kind of protection which is available to Swami Fund today under the IBC and other statutes is not available to other alternate debt providers. So I think that is one crucial thing which money is available for these stuck projects, but because of these limitations in the regulations, not many are able to deploy. Having said that, I think the opportunity is there. We have seen a lot of these. Our main source of deal flow is coming from these NBFC refinancing, where the pressure is to get out of stuck projects, where we can bring in some capital to give the existing lender and the balance to complete the project. Having said that, it is crucial today, like there are these DMs which are happening on the commercial side, similar kind of DM structure we are also evaluating on the residential side as well. Bring in our partner who has an established track record of execution and most importantly, sales. So there have been lot of these players in the market today, especially in Mumbai and these metro cities, who have been focused in rescuing or kind of taking up stuck projects. So here the developer in that sense who has been, not successful or has, created this kind of a mess needs to sit back. He need not exit completely, but he needs to sit back and allow the incoming investor as well as the DM partner to complete the project. See, end of the day, all developers, they understand that they will not make any money going forward. It's more of their reputation being intact, that at least they completed the project and handed it over, is where they come from. And they are quite happy if there is capital provider plus somebody who's willing to execute and complete the project and deliver it, because there will be RERA implications, litigations, which will anyway be ongoing. So at least there will be some respite to the developers also from that aspect. So that's something we are actively involving and doing it.
Gaurav, I'll come to you on this. We've heard this, and I've been on the deal making side for long. If we have to bring in DM, which is clearly sort of, let's say 10% of the top line, give or take, if I have to generalize it, then you have GST, which is going to impact you. And then, of course, the last mile providers, solution capital, rescue financing, whether it's by hedges or by the likes of any AIFs, is, in my view, north of 15% clearly. How does this all sit together from your perspective, right? In tax, is there enough meat on the bone for all of these guys to be satisfied? Then the junior lender, then the developer behind, and there are so many vendors who've been unpaid. How does this whole story unfold? And what challenges do we have in doing DMs alone? I think it's easy to say, but it's very difficult to execute it from a tax perspective.
No, I agree. So, on the tax side, all this DM point, when you're talking about GST, I think one of the issues which comes up with commercial real estate, for example, is that the GST that you would pay the DM, you don't get the credit till you see. So that, adds that cost into the whole project, or into the, the project's costs and cash flows, etc. And I think many representations have been made to government that, this needs to change. It's been 3 years. I think we've been banging every door possible. That you're talking about GST, you need to have a complete credit inflow outflow. Otherwise, what's the point of introducing GST? So I think that's one point with challenge which remains. Tax rates, we can't say much because income tax rates have come down. So it's not that much of a challenge from that perspective, and that anyway depends on sales. So if income tax will only come if there is income, but I think GST is definitely a blocker there. I think the other point, beyond just the DM, is also the rate of interest that we are asking for. If you're looking for so many things that to be absolutely clean, absolutely perfect, then you're basically getting to a situation that, you want equity type returns with debt, which is kind of difficult and makes it even, unviable really to service this amounts. So I think one solution, or one point for that is that, we really have to look at a lowering of the rates, or at the rates at which money is coming into such projects. Otherwise, we will not really be able to do much with it. And also, I think when it comes to last mile funding or distressed projects, in some cases, the customers already paid 90% of the money. So really, what is this money chasing? It's just to complete the project. So where is the money going to come in? So maybe, government policy has to be there to say that, in these projects, we'll give you some additional FSI or an additional parcel of land, so that, there is some money being, made back by the lender or the equity provider to this sort of things.
And to add all of this, and I missed talking about, is this withholding tax. because a lot of the hedge fund money is all dollar denominated. So not only do I pay interest, but they're saying it's interest net of withholding tax, which means I have another 15% markup. So really it becomes extremely heavy, and I'm with you saying there may not be enough projects even to service that money, and then you need some support from the government. You spoke about equity. I'm going to go to Amit, saying, Amit, we are seeing a huge pressure. The people who can afford to delever, right, and listed companies are a representation of that. The top 10 listed developers have reduced their debt 27% in the last 1 year, right? They're getting debt averse. They're bringing down their debt levels. People who want to borrow are not able to borrow, right? Is there a play for equity, right? When do you think equity funds are going to step up? Because we can keep talking about alternate debt, but we do need equity capital as well. And what's your view on that? I don't want to let go of this conversation without knowing where the equity is.
Certainly, Shobhit, but I couldn't resist, putting a couple of comments in on the previous dialogue between you and Gaurav. So here is my, weekend offer. If there is anybody who fulfills the criteria for our development projects, forget about 10 or 12%. We're ready to do DM at much more economical rates, 30 to 40% discount from the levels that you're talking about. So it really is not that expensive. But to Gaurav's point, and as you followed up on the withholding tax is a really big issue, and it is a huge issue, for equity. So that ties into my next comment. The feasibility of projects in India are significantly drained, not only from the very high tax levels, but also the risk of tax cases opening up and scrutiny for completely ridiculous reasons. And thankfully we have the big four helping us on situations that come around from time to time, and they've got excellent understanding of this. But really, if one thing that I can request the government or the regulators is, with hands folded, a request that we keep our tax laws simple, business friendly, and just very transparent and straight and easy to do business. The short answer to your question on equity, yes, equity is 100% coming back, and equities never stopped, Shobhit. So the equity has been coming into different asset classes or different stages in the project. But even post 2000, 5 to 8, we all know there was a big gold rush in India. 2009 is probably the only time equity didn't come back. 10 onwards, you've seen equity coming back to acquire assets, i.e. there was no interest in taking, buyouts. And equity since then has not stopped. It's come into different sectors, etc. So on the listed developers, firstly, I don't understand the rationale for listing. At least Hines is a private developer, and we think that in an industry which is highly cyclical, has a long gestation period for each project, and is very transactional in nature, listing the pressures that you have from daily stock price changes and the quarterly reporting is pretty intense. But hats off to the developers who do it successfully. And the reason they do it successfully is they are able to counter and offer to their investors and analysts exactly what they are investing for. And is the developer really in the business of developing, or is the developer in the interest of a long-term hold of completed assets? I think that's where the difference of opinion is pretty strongly. So I believe that a lot of the debt reduction that's occurred is because of getting or passing on the completed assets to a long-term investor, as opposed to you as a development company, for which this is not the core business. And now that the balance sheet has been lightened and capital is freed up, I absolutely think that that capital will get redeployed. It will get redeployed. I personally predict that there'll be a significant shift in the product mix in favor of the residential business in the next 5 years compared to office. And within the office, I think there will be many more private equity joint venture partnerships, because I don't think the developers and the listed developers essentially want to do it all alone using public money and have quarterly, reporting to do.
Thanks, Amit, for those strong and very convincing answers. I must say I endorse your views, so pretty much on the same boat. But I can't let this panel go without talking about one different subject. We have 5 minutes to go, and I thought I'll bring that up. We are talking about alternate debt. We've spoken a lot about what goes in and what can be done. What about alternate asset classes, right? I think we've spoken too much on resi and commercial, and somebody touched on retail. But let me start with you, Ritesh. You are looking at funding schools K-12, which is KG to 12. How real is that? And when you're buying these, how easy or difficult it is for you to raise debt on, let's say, operating school assets that you're buying? And I'll come to you after this, Chetan, on talking about B&C developers, because Gaurav and Ritesh both talked about partnership risk. So obviously, let's assume grade A will be taken care of. How do you handle grade B and C, which are catering to the lower end of the market on resi? So one, starting with you, Ritesh, and then moving to Chetan.
Sure. Thanks, Shobhit, again. So I think, see, there is, as the market matures, and we've all been part of this market for a very long time now, there will be new asset classes, there will be new sectors which will open up as industry evolves, businesses evolve, the overall economy evolves, and so on. And we've seen that play out, right? It was earlier just resi, and then resi in office, and then retail came along. I'm not talking about hotels over here, because it's a totally different business altogether. And then we've seen, warehousing in the last few years. And similarly, we feel, there are going to be a few new sectors which will keep getting added up. And, we don't have to reinvent the wheel. You have to see what's happening in some of the other markets, US and Europe and so on, to see what kind of depth and scale they've been able to achieve, even within, let's say, alternative asset classes within real estate, which itself is an alternative, right? So my view is, all of these newer asset classes, whether it's education, whether it's data centers, whether it's, warehousing, not anymore, I think, and, a couple of other sectors as well. They have their issues. You're usually amongst the first few people going in. So, there are no set patterns, who's the right player, who's not. I think you need to figure that out. The depth is not there. It's not like suddenly, you'll find if it's student housing or it's co-living or it's K-12, that you will find, 50 deals to sort of choose from, because, it's just that much more nascent. So that brings its own risk, Shobhit, obviously, because you need to see how it performs. You need to give it a few years. You need to figure out who the right people are. So I think the opportunity is there. It will take a few years to sort of figure out exactly what works and what doesn't. But I think, the fact is that it also throws up slightly differentiated returns, which then makes it sort of worth taking a calibrated risk on some of these newer asset classes.
Just a quick question, Ritesh. Are you getting LRD on school assets, which is lease rental discounting?
Yeah.
Is that happening?
Yeah.
Banks are stepping up to it?
Correct. So again, it's not so straightforward, right? If we had an office asset, or a warehousing asset, LRDs would be much more straightforward. Here, there is a element of, working with the banks or the lenders to, give them comfort around the key risks that they see, which is, it's an operating asset. What happens if the operator, sort of falls foul? What happens if enrollments don't come in? What happens if, High Court, Supreme Court say that this year charge only 50% of the fees? How does the loan get serviced? So, there are some of these issues which you have to deal with. But once again, I would say it's not like debt is not available. We've had reasonable success in talking to banks and, securing the kind of financing that we need on reasonable terms, but slightly more hard work compared to, let's say, a straightforward asset.
Super. Thanks for that. Chetan, quickly, we spoke about good quality developers, great partners, unwinding their positions in case they got stuck. What happens to B and C grade? that are catering to the lower segment, suburban markets of, let's say, big cities? How do you unbind that position?
So I think the space we are in, we understand that the returns we chase, we are not gonna get all the deals from grade A developers only. We have to look at grade B, grade C. But our criteria of evaluating a partner is slightly different. What we look at is primarily the intent of the partner to be in this business. So we have seen in the last 4-5 years, a lot of these new set of developers who have come in the business with a proper intent, proper processes and proper systems around it where they want to grow. So our target segment, if I would call that, is these people who have decent amount of business experience in this business and are capacitated and willing to go to the next level. So it's like those B or C grade developers who want to move to the A grade. So that's where we are looking at investing and growing along with them. We have strategies around partnering with developers for not just 1 or 2 projects. We look at their entire portfolio and see if we can partner with them across the portfolio. So that saves times for us, and also the understanding is very clear between us partners that what is expected from each other. We also clearly see the kind of adaptability the partner brings in. Is he willing to look at the kind of experience sharing we do? Because as an investor, we are not just financial investor. We also bring in a lot of our experience from the past projects as well as past development experiences in terms of how things went bad and what we can do to avoid today. So those kind of adaptability, if the partner shows, is where we are willing to partner with them. I think that is crucial, rather than just classifying them, saying that you are a downgrade developer, we will not fund you. We have to look at obviously the project economics first, project numbers stack up and all that, and secondly, the belly fire in the belly in terms of does he want to go to the level up.
So you're saying you look at the promising developers in the sports, in a sports term. You need not be 1, 2, and 3, but the most promising sports person. Great. Quickly, 2 last questions, one to Gaurav and one to Amit. Gaurav, what's your view on data centers, their growth, and how does that get funded? Because I think it's a hybrid between infra and real estate. So what are you seeing and what are you advising your clients on domestic funds being arranged for putting up these data centers? Because this is a new animal, 30-year leases. We are selling racks, we're not selling real estate. We are selling megawatts, we're not selling square foot. So what's the adaptability of banks on this?
So I think on the data centers, clearly, the pandemic has resulted in a huge increase in use of data. So clearly you need the data centers to support such data use, whether it's for e-commerce or even for doing normal business, just like what we are doing today as a virtual conference. We're using as data. So data centers definitely pick up, and we've seen a number of platforms being set up to invest in data centers. So you have foreign capital providers who are setting up platforms for deploying money straight into data centers with local investment managers. So that's a trend we are seeing, and which I think going to continue in the near future for sure. That along with warehousing, I think is another sector where we see a lot of money deployed. And I would see the alternate debt or other funds also looking to put money into this sector. And I think it's we're quite bullish on this, and I think most of the capital providers also seem to be quite bullish on this.
Thank you. Last not the least, Amit, we're just in time for our session. I want to bring you in on co-shared economies, so it's co-living, co-working, and what's your view? Are you guys bullish in this sector? You're working across countries. What's the trends?
Yeah, I think the trend is very clear in my mind. Real estate is fast becoming a service rather than a product. And therefore, whether it's in the working space or the living space, I think there's great future. From an India perspective, it's very nascent. At least for my firm, we would like somebody else to make the early profits and show us also the early mistakes, and then we will follow.
So you want to be a follower, not the leader, on setting up co-living, co-working?
We absolutely don't mind starting later than others, and we're
Good
not
strategy.
in competition for speed or volume. It's high quality, lower risk.
Yeah, super. Sapna, if there's an award for finishing on time, it's .12.
Well done, Shobhit.
I just want to thank all my panelists who are there. Just a quick summary is what I've understood is there is enough debt for the right risk and right reward. Equity is coming in. Alternatives are available both on asset class as well as debt. So, thumbs up. I think there are challenges around deal making, but well, that's market making, so it will take its own time. Thank you very much, all of you, for being on the panel, and of course Sapna, BusinessWorld, and
Shobhit, can we have your last comment? You have listened to all our speakers, what they had to say. What would be your last wrap up?
I think from where I'm seeing the market and just being in the middle of all of this, I think it pains me to arrange high cost loans. It's like serving a bitter pill in a hospital, so I have to serve it. But in my view, it's unreal and it's unwarranted. I think government should keep an eye. If Swami can do it at 11, 12, why should people, and especially Indian developers, pay hedge fund 18, 19, 20? In fact, I've done deals at 22%. Super senior. So we are not only eating up the margin of the developer, let's assume nobody cares a lot about them, but we are now starting to eat into the banks, the senior banks that were there, and they have to take a hit on their balance sheet, which ultimately is nothing but the depositors' money, right? So this is the Indian savings bank account that's getting eroded, right? I just think that government should be more mindful and lower the risk by allowing them the same privilege as Swami Fund, so that more people can access this money at a much more reasonable cost. I mean, that's my real sort of request, saying this is absolutely criminal what I'm doing, but it's fine. I mean, this is the market, I can't control it. But high cost is super high cost. I mean, it's beyond junk bond pricing, right? Even junk bonds world over don't trade at over 18%. So I think it's just criminally expensive, this alternate debt funding that we are talking about. That's my two bit on
completely. I think that was one very enlightening session, and as our speaker said, both borrowers and lenders, they need each other, and tax regime has to become more investor friendly, as so thank you so much for all us, for sharing your views, your time, to all our speakers for being here with us today. Amit, thank you for being here on this panel. Mr. Ritesh, Vohra, for being here, and sharing your views. Chetan, again, thanks for expressing your opinion, and Shobhit, for that wonderful moderation of the panel, and Gaurav giving us the overall perspective of the sector. Thank you so much, everyone.
Thank you.
Thanks,
Take care.
everyone.
Enjoy the weekend, guys. Take care. Bye.
So friends, that was one exciting session of the day, and let's move on to another very exciting topic, which is investing in distressed residential properties, concerns and opportunities. So let me bring in our speakers and introduce them. The moderator of the session, I introduce Mr. Ramesh Nair, real estate expert and former CEO, JLL India. Ramesh Nair is a real estate industry veteran and former CEO of JLL India, and has been with JLL India for more than 21 years now. And he has hands-on professional expertise in most facets of the real estate business across asset classes, advising many domestic and multinational owners, occupiers, and investors across cities. So a warm welcome to our moderator, Ramesh Nair. And let me now introduce our speakers of the session in an alphabetical order. Our first speaker I introduce, Mr. Amit Bhagat, Managing Director and CEO, ASK Group. Amit Bhagat co-founded the real estate fund practice of ASK Group, and he manages and advises over INR 50 billion of real estate investments. He was the national credit head for the mortgage division of ICICI Bank and also headed ICICI Property Services. He's a chartered accountant with over 27 years of experience. Our next very eminent panel member is Mr. Amit Goenka, MD and CEO, Nisus Finance Services. Amit brings nearly 16 years of top-tier multinational experience in investment banking, direct investments, and strategy, and he specializes in structured finance, valuations and mergers, and acquisitions within real estate. Our next panel member is Mr. Ashwinder R. Singh, CEO, Residential Bhartiya City. With a career traversed over 23 years, Ashwinder is an acclaimed thought leader and a sought-after top executive in the real estate capital markets and property sales industry. He brings his skills to Bhartiya City and is now, Ashwinder is now determined to set new benchmarks in customer centricity and quality in Bhartiya City. So now I move on to our next panel member and I introduce Mr. Irfan A. Kazi, Chief Investment Officer, Swami Investment Fund, SBI Cap Ventures Limited. Irfan is a finance professional with 25 plus years of international work experience in alternative investments, and he has held senior investment responsibilities in 8 funds, including as CIO in 4 funds, a hedge fund of funds, a hospitality fund, industrial fund, and now in Swami, a stressed residential assets. Our next eminent speaker of the session is Mr. Sharad Mittal, CEO, Motilal Oswal Real Estate. With over 20 years of experience in the real estate industry, Sharad has been instrumental in building Motilal Oswal Real Estate's investment focus around a sustainable long-term strategy. So this was our eminent panel. Mr. Ramesh Nair, I hand it over to you to take forward the conversation.
Thanks, Sapna. Am I audible and visible?
Absolutely.
Yes. So thanks for that lovely introduction, Sapna. Good afternoon, friends. My name is Ramesh Nair, and I'll be serving as your moderator today. It's my pleasure and privilege to be moderating this session. Thank you, Sapna, again for welcoming all our expert panelists, all superstars, all hotshots of the industry. Always manage to get the best panelists whenever I've moderated any session with you, Sapna and team. So fantastic, great job. I'd like to welcome the audience to this panel. The topic is investing in distressed residential properties. Before I actually begin, Sapna, how many people have actually registered for this panel? It'd be good to know that.
We have had registrations on BW and on Realty Plus. So I think more than last we checked was more than 1,600 or something.
Oh, that's quite good. So the subject, obviously, on distressed residential real estate is quite timely. And it's the effort of Realty Plus to make sure the topics are timely and there are interesting speakers. So let's go ahead and get some thoughts from our opinion leaders from this panel. I'll start with you, Irfan. What's the current state of the residential market post the second wave? We saw some green shoots coming. Everyone was talking about things happening between around September and Jan, Feb, and again things went wrong. What's the real state today when we are in July of the residential market? And my question, all my questions are towards across the country, what's happening. So over to you, Irfan.
Hi, Ramesh. Pleasure being on this show, and especially nice talking to you. I think the pandemic and the after effects are seen most in contrasting the differences within the industry. So you have the headline items which have improved considerably, and you have the the devil in the detail which has led to a greater misery amongst the developers. So without being poetic, I think it has increased the delight of the larger developers and has increased the plight of the smaller developers at the same time. Right? The market is even more segmented than before, and at the same time you have cost increases. At the same time you have difficulty in getting labor at the site, all of which is something that a larger developer, a branded developer can take in his stride. But these are the straws that are breaking the bones of the backbones of some of the smaller developers. So I think the situation has worsened for a lot of the small developers. And I say this from not from stats publicly available. I don't say this from perceptions. I'm talking of it from the reality as we see in our portfolio.
Thanks, Irfan. Amit, Bhagat, you want to add to that?
I think Irfan has summarized it very well. I must say that he has categorized the developers who is a beneficiary and who is suffering. But let us look at the recovery is also, as he rightly mentioned, the headline details are something, but the ground level realities are different. If you look at the start of the pandemic, Bangalore was the least impacted. Then because of stamp duty benefit, Maharashtra got the benefit between October to March. NCR, which was suffering for last 2 years, started recovering, and then the second wave came in. The industry needs a breather. The compounding of the debt and the interest is continuing and at a higher pace because every lender wants to exit a project, especially the non-bank finance companies, and they are pressurizing the developers to exit, sweeping most of the money through the escrows, and there is not adequate money left for execution. Collections are impacted. If you look even the top 11 listed developers collection details, you will notice that in the year of pandemic, they were they've not surpassed the previous year, most of them. Collections are impacted, lenders are sweeping, cost has increased, steel, cement, labor after the second wave. They have kept the labor on the site in the wave 1, wave 2. There is no relief to any developer. The larger developers, because they had the listed developer, because they had access to QIPs and bonds, they have been able to manage it. But sooner or later, if this continues and there is a third wave, and then I think the pressure will be felt everywhere. And I have seen some listed developers also not giving the desired results in the last 2 quarters. So I think it's a very tough time. Industry needs a breather and a relief.
Thanks, Amit. Sharad, you want to add to that?
Yeah, hi Ramesh, hi everyone. So I would agree in parts with both Irfan and Amit. I think I would look at this way that when the pandemic started last year or the lockdown started, people were people didn't know how the things will play out. There was a uncertainty of unknown, the fear of unknown. And I think the headlines that we are reading around the green shoots and turnaround is in the context of what people were expecting that it might turn out to be. And the home sales and the kind of footfalls that we see in our site has really surprised us. I think what the expectation that it's going to turn around overnight or in a year's time, it's not going to happen. I believe the some bit of green shoot that we are seeing is if we are able to sustain it, maybe over a period of next 2 to 4 years, there could be some meaningful recovery. 2 things one has to be very careful while announcing any kind of turnaround on green shoot. One of the biggest driver for this turnaround is interest rate. If I have to look at very closely, I would put it almost 50% weightage on the mortgage rates. And that brings in affordability. That also brings in a lot of consumer interest in buying properties. The second is there's this large part of these sales are getting cornered by top 30 developers of each of these markets. We may not like to say it, but I think for bottom 70% or bottom 80% developer, everything is challenging. Forget about capital. Capital is the biggest ingredient. I know of vendors who don't want to do business with some of these developers. Of course, the customers are making choices. So I think consolidation is going to accelerate. But I would say what has surprised me how quickly we have been able to reach to pre-COVID numbers. And I remain optimistic that things will it'll take time, but I think we are seeing recovery in pockets.
Thanks, Sharad. Ashwin, your opening thoughts?
Yeah, hi Ramesh, wonderful to talk to you, and hi everyone. See, I would like to break it up in 2 parts. From a demand side, what has happened is, and something that Sharad mentioned, mortgage rates are at all-time low. Savings have gone up because of the pandemic, especially the people who are on the salaried side. And there has been stamp duty, etc., that has happened from the government. So there are markets like Bangalore, Maharashtra, which is Bombay and Pune, which have done well. Now, my view is very different because even if you're a large developer or a small developer, financiers who have funded developers, not at the land stage, are doing very well because those developers intrinsically carry very good credit. Now, when you look at it from a financial standpoint and you start lending at 18 to 20%, and you're trying to inbuild risk of 4 to 5% just because it is a high risk funding, I have seen with my experience on the mortgage and developer finance side that the moment of financial in the last 4 or 5 years also, who has been taking funding on land has not been able to recover because the margins have gone down. Obviously, there has been a pressure on the pricing. So it is not that the developers are not doing well. I know a lot of small developers who are doing extremely well in Pune, Bangalore, Mumbai, and these are not big developers. I would not like to take names, but they have been doing very well. They take construction finance at a rate anything between 11 to 13%, deliver on milestones. Consumers know these are the developers who have delivered earlier. Reference sales have increased a lot. Direct sales have increased a lot because the consumer has started evaluating the developer themselves by visiting the sites and understanding it, especially the second time buyer. So I think demand is good. There is a set of developers which have understood how to go about it and not boil the ocean, who are doing pretty well. And yes, there are developers who were struggling 5 years back. They are struggling more now because suddenly the consumer choice has become the differentiator. The consumer doesn't, this latest thing by RERA where they are not allowing a developer from Noida to do new launches is a shocker to many. But that's how it is all being driven from consumer insights, from consumer activism. So that's my brief on this, Ramesh.
Thanks, Ashwin. Amit, Goenka, your views on where the residential market is right now?
So certainly, thank you, Ramesh, and pleasure to be on this esteemed panel. What we were certainly seeing is that in the first wave, what happened really was that it was a new black swan event for the entire global community, and therefore.
Amit, if you could come a little closer to the mic because it's a little, the voice is a little.
Is this better now, Ramesh?
Much better, much better.
Okay. So just to reiterate, the first wave effectively being an unknown black swan event really provided a lot of cushioning for the economy as a whole through various interventions, both by the RBI, by the finance ministry, by various regulators, and so on and so forth, where a lot of SOPs, one-time restructuring, TLTRO, and a lot of mechanism and cash was infused into the economy, providing a lot of cushion, and therefore even covering some of the possibilities of mishap, failure, and stress that could have precipitated in the first wave. No such intervention really was seen in a wide scale during the second wave, which really led to a lot of exposure of the weak links within the system, which were otherwise not being exposed to that measure in the first wave. So those who showed the deftness, the resolve, and the fundamentals to actually continue to weather the second wave, and also showed some amount of green shoots because there was a lot of euphoria, as was mentioned earlier, between October to March on various counts post the unlock in the first wave. And those who actually made money or showed cash flows and resilience during that green shoot period were really the right candidates for receiving new capital. So, Ramesh, in the current times, I'm seeing that a lot of new capital is being pumped into the residential sector, both at greenfield, distress, and brownfield levels. We're seeing new capital formations happening, new funds being raised, both global and domestic capital making a beeline for the India real estate again, basis the fundamentals that are now visible, seen in the past few quarters. And I do believe that is clearly intended for those boys. Whether large-scale players, of course, there is no doubt that they will only continue to grow, and consolidation, which started effectively from 2016-17 onwards, which has now got accelerated in 2021, will certainly continue its journey. But even for those who are not part of that and are possibly the tier 2, tier 3 players, will still continue to benefit from this new capital and the newfound resilience and demand from the marketplace. So I do believe there's a story also for them, and that's really where we participate, and that's where our capital is continue to find its money.
Thanks, thanks, Amit. Amit Bhagat, I'll come back to you again. What are some of the challenges today when capital providers like you? What are the kind of things you evaluate before looking at top up or refinancing, or when you're looking at a typically stressed residential projects? Now, how do you look at it? You're one of the big capital providers in the country today. So how do you evaluate those challenges? You're on mute, Amit.
Thank you for terming us as big players, but I'll make an attempt. See, I think what we are looking at is the developer's credibility, intent, customer centricity, product delivery, track record of delivery, and eventually what is his capability to execute. These are the 5 things which I think when you partner with someone, you will look at this. And how has he rewarded other stakeholders? Once we are through with that, we look at whether this asset is in a growth corridor in the mid-segment space or affordable. Then you look at numbers. And then you look at whether it has to be refinanced. What we attempt to do is a financial closure of a project. Unless until there's a financial closure by refinancing and providing adequate working capital, and then the negative working capital cycle should play with the brand and customer receipts. I think that is the endeavor. The challenge comes if there are delays in the project, partly because of pandemic and also because the market was not very conducive from 17 to 19, actually, if you look at it. 17 to 19, 17 when the negative arbitrage was withdrawn in the income tax, the investors withdrew. And then the buyers also said, what is the urgency to buy because the prices are either stable or going down. So while evaluating, RERA timelines are the most critical. Litigation, customer complaints is another point. And then because of insolvency, you have to look at it, whether the asset is in a separate SPV or not. Otherwise, if you are joining hands, we don't do mezzanine, or second charge, but if you are at the holdco level, then the challenge is we don't know what skeleton will come out of the cupboard. And so RERA, structure, asset in a separate SPV, everything matters today. It's a kind of a checklist. 10. All tick boxes have to be there if you want to go. Unless until you have a privilege like Irfan and Swami Fund, which has been a debate in the previous panel also, that yes, do we need that kind of a protection? We need. If we want to be senior, we should be treated as a senior and not in the IBC treated as pari passu with others. So I think these are challenges: RERA timelines, litigations, vendors payments in the past. Everything has to be looked into. I think I can't put say these 3 things are a priority. Everything is critical today.
Got it. Sharad, your thoughts on that?
Yeah, Ramesh. So continuing from what Amit is saying, now we invest across the life cycle of the project. Till 2 years back, we were focusing largely on land acquisition, but with our new fund that we have raised and that we have raised in last 6 months, we now do construction finance and last mile funding as well. I think when you say distressed real estate, one thing is very clear in our mind that we are not the one who is going to turn around a project. If the large part of the challenge that we see lies with the NBFCs who have given disproportionate money to some of the projects, and some of those projects are not viable with the kind of debt that's been currently run on them. There are challenges also that the existing lender is not able to do the subsequent disbursement for various ecosystem challenges. And some of those transactions we have evaluated very closely. And Ramesh, I have to be very frank here. The kind of effort and the time involved for the number of people involved in the trade, the reward is very limited. If you look at 20-25 transactions, you'll probably end up doing 1 or 2. Just because there are so many people involved and it takes time. And our experience is that when you start looking at some of these transactions, I'm specifically referring to the transaction where there is an existing lender sitting who is not able to give subsequent money and is reluctant on certain terms. And by that time you reach a middle ground, which takes anything between 4 to 6 months, there are changes in the thought process of various stakeholders. So in our experience, we don't want to be seen as somebody who's coming out bailing out a distressed real estate developer or NBFCs. There are requirements of last mile, which are very large opportunity. But for us, we are looking at standard projects, and that's why we have changed our return expectations as well. We have come off significantly with our new fund, which is mid-teens kind of a return expectation, because we believe the opportunity here is to do regular construction finance. The ecosystem, if you look at the players in the market, you look at banks, NBFCs, PSUs bank, the pie has shrunk. And we like to play more on regular construction finance opportunity rather than turnaround opportunities.
Thanks, Sharad Irfan. I know your preamble is very different from what Sharad just mentioned. What are your thoughts on that?
So let me tell you the kind of difficulties that we faced, right? And I believe that those difficulties will be similar to that any new entrant in this sector will face in the distressed residential sector. So the first is lenders, right? We insist on getting a senior charge, and lenders are reluctant to cede a senior charge, right? Lenders look at an account and look at a project as a loan account, which is all right as long as the interest is being serviced, as long as the principal is being serviced, and it doesn't matter if there is no construction going on at the site itself, right? We look at it very differently. We look at progress at the site as an indicator of whether the project is stressed or not its loan performance or its account, its performance on the account with the NBFC. Lenders are reluctant to cede charge. Lenders are extremely enthusiastic in getting so many things turned right before they give a NOC to the Swami Fund to do a deal. Lenders are exuberant in their demands for repayments, prepayments, some deposits before they will cede charge. So that's one big difficulty. The other big difficulty we have, and like I said, any other player in this sector will face, is the fact that approvals in a lot of these distressed projects have lapsed. Some of these approvals take a long time to get, right? So even if the intent is to fund, even if the approvals are to fund, you cannot fund these projects for some time, because unless those some very basic approvals, and we are not talking of approvals that are only a mere hygiene, which we help the developer achieve after we invest in the project, right? So those related to maybe governance and all that, but those related to, let's say, environmental, for example, right? If it has expired, there's nothing we can do about it. We have to wait till the developer gets it. So that's the second biggest. And I think the third biggest is, the people we partner with, the home buyers. They can be a big challenge to a project as well, right? Home buyer activism sometimes turns into home buyer vengeance. If the developer is, if there's action taken against the developer, it is very difficult to keep the project remote from the effects of the action taken on the developer. We come in to complete the project, and we need the developer to complete the project. Home buyers, in spite of their enthusiasm and their passion and the fact that their savings are invested, do not have the expertise to complete a residential project. So, taking care of impatient home buyers, forming a partnership with them, talking to them, restraining them, demonstrating progress at the site is something that has taken a significant amount of our time and effort. So, we have to work along with not just lenders and get approvals, but with home buyers as well.
Thanks, Irfan, on that. Ashwinder, your views on that?
Ramesh, your question was regarding, sorry, I got logged out. Your question was regarding the market for distressed residential properties, right?
My question was regarding the challenges today which capital providers face. In your last role, Ashwinder, you are heading Bajaj. And what are the typical challenges which you're facing today as a lender?
See, I would kind of agree partially with Irfan. The issue is a lender is looking at the deal in a silo. And the lender is, see, a private lender is bothered about lending something where he gets the money back. And to be honest, I see a lot of players who are now saying that we want to be in a standard construction finance industry, because when you are in a standard construction finance industry, coming back, you are taking lesser risk. And obviously, when you're taking lesser risk, your margins have to be lesser. And that's what Sharad kind of was alluding to. But I feel the challenges are because we have a mismatch in the kind of lender who needs to get into the distressed residential market. You need lazy capital for that. You can't expect an NBFC or a HFC to come in the distressed asset world, because either you are a fund or you have a debt already on your books and you are taking a debt at a higher cost, because the Indian debt market is very fragile. So you definitely need lazy capital, you need government backing to get the distressed residential market up and about. I feel, Ramesh, distressed residential properties, especially in metros, have to be looked as an investment opportunity by patient institutional investors. I'll give you an example. This can be thought on the lines of what Innovation Homes did in US, bought large number of properties, improved them, and then rented them out. And with the new rental model code coming in, if you get a lazy capital, a large fund for the next 10 years who can build these properties, take over these properties, convert them into yield assets, because see, in residential India doesn't have a yielding asset. So the moment you are able to bring about some structural innovation in the market and get in foreign capital, which is a long-term capital, and completely change the fundamental of that asset class by not selling it outright and making it a yielding asset, many things can be done, because there is a huge demand for homes. Let us understand, there is a huge demand for homes, but one Swami fund, one is not enough. You need multiple Swami funds, and you need a Swami fund, in every city. That's because every city is like a country in if you compare it with Europe. Or you completely look at it from a different perspective, and you get government to get into it from a long-term perspective and do a PPP, a public-private partnership, get on to those assets from a longer-term perspectives, build them, and then rent it out, and maybe over a period of time get into an LRD kind of a situation. But I think the opportunity is there. It has been done in the US by Innovation Homes very successfully.
Thanks, Ashwin Amit. Goenka, let me start the next question with you. Swami's done a fantastic job. You've seen Irfan's post, so many developments they've funded now, stuck projects. What is the ask of typical capital providers today from the government? If you were to advise the government today, so that there are so many people on this panel itself, Amit, Bhagat, Sharad, all of them have capital. What is required from the government side so that we have more Swamis and Sharath and Amit behaving like a Swami in the future?
I think that's a wonderful question, Ramesh, and something which we have been trying to address for the last couple of years, amongst various AI funds for sure. First is, let's look at the supply of stressed assets. That itself is where the bottleneck lies. For example, AI funds, which is really what most of us are not allowed to buy bank loans because we can only issue security. So we've been saying, well, why do we need to be an ARC when if you can allow AIFs to also effectively act like securitization trusts and be able to acquire assets from banks? I think that's therefore one of the constraints, that we're not able to take over a large part of the stuck and stressed assets from the financial services and from the banking industry only because of regulatory reasons. The second, when it comes to the regulatory and protective regime, now clearly Swami has been given a sovereign protection when it comes to insolvency and bankruptcy code and resolving assets under that, wherein if they have invested, they will clearly have the ability to continue to act as senior lenders throughout the life of the investment, a protection that is not available to everybody. That obviously sort of tilts the scales against everybody else. Of course, it's a very, very important legislation, and it must be mandatorily be applicable to all for looking at stressed assets, that once you have invested, you must have regulatory protection so that your capital then cannot be at risk, because it is intended to rescue these stressed assets and to be able to provide homes for those who have been stuck for several years, and effectively, resolve the economy as a whole. So I think that's the second ask. Third, there are several costs, charges, and dues which suddenly start precipitating from various statutory bodies, whether it was land-related rents, premiums, taxes, and what have you. Something which has been in abeyance for so long suddenly starts to precipitate. So there has to be a backending or a mega relief provided, as far as, because clearly statutory dues are on the top of the table. Government dues sit above all of us. So they have to be backended. They have to be reduced. There has to be relief provided, and there must be a certain amount of impetus to ensure that the money is used in the nature of a social impact to be able to first complete it and then a waterfall decided. Otherwise, again, that start-stop nature or finding new money to fund old money becomes a constant problem. Of course, Irfan has already described the problem that one faces with home buyers, from being enthusiastic to being litigant to actually being very, very volatile. And so, while the IBC has allowed home buyers to become a significant part of the committee of creditors by making them financial creditors, there is no modus operandi in place as to how this business has to be run. So while we have seen IBC included, we have not seen too many successes come out of that regime in terms of resolving of assets. Some have gone to liquidation, some have gone to a resolution plan. Those resolution plans have not been implemented. Supreme Court has had to step in. Very, very erratic. So I think we need to smoothen out and again maybe step back and rethink as to how stressed assets are going to be resolved, because SARFAESI has failed to resolve it. IBC, which was expected to resolve it, is not doing necessarily a great job on the housing side. It may be doing a great job on many, many other assets, but because of the nature and the type of stakeholders, it's more challenging on the IBC regime. Maybe the new ARC or the bad bank, the National Asset Reconstruction, may be an answer, where it can then pull in and then start giving away assets to the right capital providers and AIFs. I don't know. We'll have to wait and see, Ramesh. But I think sourcing of assets is a problem, resolving them subsequently is a problem, and all of this requires a more aligned governmental policy. We've seen policies come out for rental housing.
Yeah.
There must be a policy which has to be also instituted for the purpose of stressed assets and impact housing, because capital alone cannot be the solution. There are legal, regulatory, and consumer challenges which also need to be addressed, as there are other challenges at the state and federal level.
Well summarized. Amit, Sharad, what are your thoughts? You want to add something to?
Yeah, so I think Amit has summarized this quite well. I would add two things, because we raise domestic money, and one of the key challenge when I hear from, say, developer on some of the other earlier discussion that I heard, that the cost is very expensive, but that's how the ecosystem is built. One of the things that can help reduce the cost is, and we can look at for a limited period. I'm saying government can look at for a limited period, and we are in a special situation. The kind of benefits which have been given to Swami Fund, some of it is, if they are built into a regular AIF, which are trying to do a similar kind of thing. One is the Amit has highlighted that the protection under IBC, that the structure should not fall off if the project goes to the IBC. I think that something should be done. But two additional things I would suggest, which should be done within the AIF regulations. One, I think the tax is exorbitant. When we raise local money, and if the money goes back in form of, say, a large part goes as interest and some bit goes as capital gain, it is exorbitant. The blended rate is an upward of 30%. So if you look at a gross return and 30-35% get shaved off as tax, is one big limitation. If there's something can be done around that for a limited period with a specific objective of money going into a certain set of projects, to make it attractive. The second is if some bit of financial engineering is allowed in the AIFs, which are doing a specific job. What do I mean by that? Is a leverage. Excessive leverage is bad, but an optimum leverage, say 1:4 is an optimum leverage. It also helps for us to do transactions at a lower cost, and that would eventually help the real estate sector. So I would say these two things. And of course, one thing that we've been pushing for is that the structure should not fall off if I have come in the last, and I should continue to enjoy preference in the cash flow and charge.
Thanks, Sharad. With that, I'll come to the next question. Amit, Bhagat, let me ask you this one. So,
Ramesh, if I could just interrupt you, and my apologies for that.
Please, sir.
Let me also share some thoughts here, specifically on whether Swami kind of benefits should be extended to the rest of the industry. So two things, unlike the general perception, unlike the very, very prevalent general perception, right? The fact that we have IBC protection plays a very, very limited role in our credit analysis. Our credit analysis is limited to what the debt is, what the cash flows are, etc., etc. So it is not like, that IBC protection is a magic wand that takes all the deals through the IC, right? So that's one. We rarely, if ever, discuss it in the IC. Our bigger challenge is to get senior credit status on a contractual basis from the existing lenders. It is not about IBC protection. So that's one. Second, it's also a question of risk versus return, right? If you have the perception that IBC protection dramatically reduces the risk, right? The return is the other side of the coin, right? That should vary according to it, and therefore this government fund that has come in, the Swami Fund, while it does have IBC protection, it also charges 12% completely back-ended after construction. It does, it does lending across cities, across. So we are currently present in 32 locations in the country, which is 24 tier 2 cities and 8 metro cities. So, the mandate is, you have to look at the mandate holistically. It is not just a government fund which has come in with sovereign protection. It's also a government fund which is lending at, compare 11.5% or a 12% IRR, and, willing to lend across the country, willing to look at projects and take the risk, right? So I think the entire picture needs to be considered, not just, one part
you're
of
saying that
one part
because
of
we
it.
charge high cost of capital, we don't deserve any protection?
No, I won't talk about what you deserve or not. I mean, I'm part of the industry as much as you are, right? So, I will not take the high and mighty stand, but I'll tell you the thought process behind the, the return that we expect and the risk protection that we have. That's all.
Got it. Irfan, that is quite an insight that IBC protection is not really a real impact in your credit analysis. Amit, I'll come back to you, Bhagat. We saw a lot of global foreign money coming into office first. Then we saw it even coming into retail. Now there's so much of capital going towards warehousing. And you and me would have sat in like 10 panels discussing when is real good private equity going to come, global money going to come into residential. We've been talking about it forever. Still nothing much has happened. What needs to be done to get more FDI into residential?
So I think the government is doing everything. If you look at Gift City, withholding tax of 10%, no PAN requirement for investor, that is in place. And so instead of going through various other countries where the withholding tax is 15, now you are at 10%. You have all the advantages. They have also allowed a Cat 3 to invest in a Cat 2 now. You can raise a fund there and invest in entire money in, there is no direct requirement of direct investment from that particular fund. I think what we need to look at is that it is like any other industry, and I'm digressing a little bit. As industry, you have to see if somebody was over leveraged, over committed, did not deliver to the customer, he has to move out. What we need is insolvency cases should be resolved in 12 months. So there is a certainty that this guy will move out and the other guy will step in. What we need is an inter-creditor agreement to be honored, not an insolvency protection, but an inter-creditor agreement between two lenders to be honored, where if I have a preference, I have a preference. I think these are the only three things required. Somebody who's coming in, if you look at most of the business funds who are trying to enter into the country and buying some portfolios, their return expectation is obnoxious, 23-25%, because they carry a currency risk. So which will continue unless and until you have supply of capital and there are recipients of capital who are doing justice to that money. The level will not be found actually. So let's not expect too much from the government. Government has done everything. What we need is an inter-creditor agreement and insolvency cases to be resolved in 12 months. And also this delay in resolution of insolvencies because of the pandemic partly. But when large quantum of money comes in with a development risk in the residential space, they will expect these two things. Other than that, I don't think government has to do anything. Somebody is over-leveraged. It happens in every industry, steel industry, consumer durables. Somebody is over-leveraged, over-committed, was not customer-centric. Why do we want to protect the developers? Or so developers have a different demand. They want restructuring. We don't want that. We are saying just ensure 12 months insolvency. That's it.
Ashwin, you want to add to that?
Yeah, I just want to, add a couple of things. Most of it is covered, but I feel the perception of the Indian residential sector is that we are an unorganized sector, unlike office, for example. So it is not about the technical stuff that the government has done, because life is all about marketing and positioning. Because if positioning was not important, it wouldn't have been the most important subject in all our MBA courses. So I think doing technical stuff and not articulating and communicating properly, the residential sector is never going to get the foreign money, because our positioning is very weak. We are considered very unorganized. There are few and far large players who you can count on your fingers, maybe 10, 12 in India, who are established. The rest, according to the foreign definition, are very, very small. And there are a lot of retrospective things that happen in the country which have happened in the past. And that is why when a sector is perceived as unorganized, and it is B2C and not B2B, and the Indian consumer in itself is a very unpredictable species, you are not going to get foreign money coming in, because it's very clear the government, according to me, has not done enough on doing some technical stuff. Doesn't help, because finally it is also the enforcement of the law and not just the law. So India suffers from the law enforcement rather than the law itself, and the positioning of the sector, that the government is really interested in building the residential sector. See, two things that they were not able to do. The smart city has become a dream. We still don't see what was told about the smart city, and it was going to be a great thing in the last 5-6 years. Nothing substantial has happened on the smart city front. If there would have been progress, the foreign players would have jumped to this opportunity, because I think if there are returns expected, returns are always expected higher in a B2C business than a B2B business, because the risk and reward is kind of constructed like that. So the government needs to work a lot on the smart city project, on organizing the residential sector, on making the perception of the Indian residential sector as robust as the commercial sector. And we will see, office has gone completely other way around. The largest owners of office space are foreign players, which is also not that great. But because it was the easiest pick for the foreign players, Ramesh, and you understand that better than anybody else on the panel.
Thanks, Ashwin. Sapna, do we have some time for some audience questions?
Yes, we can take some questions. We have one question here. Let me just. But before that, if you can sum up our, what our speakers have mentioned for our, viewers, and then I can bring in the questions.
So before I kind of sum up, I was looking at some of the global data. And the interesting fact there, when you look at RCA's global capital flows data, is a lot of money is going into what they call beds and sheds, which is residential and warehousing. So globally, when you looked at like last year, hotels, the overall capital flows reduced by nearly 70%, obviously for obvious reasons. Office reduced by around 35%. But in warehousing, the total capital flow last year reduced only by around 7%, and residential by only around 15%. So residential globally is suddenly being seen as a preferred asset class. And across the world, it's picking up. I know there are some funds who are at early stages of looking at residential in the country. So that's something to at least to cheer about from a global point of view. But like what Amit and Ashwinder said, lots to be done. So I asked 3-4 questions. And the first question, in second wave, the panelists felt that increased delight for the larger players, increased plight for the smaller players. Irfan mentioned that market is getting all the more segmented, more consolidation happening. He spoke about how labor cost increase, all this is breaking the back of smaller developers. Amit spoke about how Bangalore was starting to revive, how Mumbai was starting to revive, and then Delhi was starting to revive. But overall, the debt and interest rates have killed that. He also spoke about how steel, cement, labor all have increased. Collections have also kind of increased. He spoke about how to look at the listed players who come out of the data. Again, everyone is struggling on the collections part. Sharad spoke about how an overnight turnaround is just not possible. we all keep saying in many of these panels. I remember once Srini of Kotak joking that every time in a panel we keep saying in 12 months it's going to recover. And he's been seeing that for the last 10 years. This time Sharad said it's going to take at least 2 to 4 years for the recovery to happen. And interest rates, he said, is going to have the biggest weightage for this recovery. That's like a 50% weightage is what he gave. He said large developers, the top 30% of the market is doing reasonably well, and he felt consolidation will accelerate further. Amit felt Bangalore, Mumbai, Pune were doing reasonably well. Ashwindar said this. Financiers who didn't fund at the last stage, the land stage, are still doing well. And reference sales and direct sales have increased, is what Ashwindar again felt. Amit Goenka felt that the second wave, the government didn't intervene. That's definitely having an impact on the market. Something was expected from the government, but the kind of incentives or the intervention they did in the first wave wasn't seen. But he also felt that there's new capital formation which is happening. In terms of challenges which capital providers look at while evaluating projects, I thought Amit BHAGAT summarized it very well. He said credibility, intent, track record, and capability to execute is key. He looks at growth corridors before giving money. Then he starts looking at the numbers. The main focus is on attempting to do the financial closure. RERA and customer complaints is something they've actively started looking at if the asset is kept in a separate SPV. And because you don't want to get into any IBC mess. So those are things Amit looks at. Sharad said time and effort required to rescue a distressed project where an NBFC is funded is just not worth the trouble. He said after looking at 25 projects, maybe he funds 1 or 2 projects. That's not good news for the audience who's kind of watching this. Irfan said he looks at the progress of site more than anything else. Approval lapse is becoming a big challenge with some of these projects getting again into approval stage. Home buyers activism turning to home buyer vengeance. I've seen this across the country. This is something that there are those society office bearers who are listening to this call. Nobody is going to benefit when that home buyer vengeance starts. We again saw this in 2007-8. We saw this in 2096-97. Again, this was there. Whenever there is these cases, nobody benefits. Ashwindar spoke about how patient capital is the need of the hour. He spoke about a company called Innovation Homes. He said it's worth studying there, the case study. What government needs to do, some very good feedback. Amit, you said AIF needs to be allowed to take over loans. Regulatory protection for other funds like the Swami Fund. Statutory charges relief, if the government can do something on a one-time basis. Sharad again spoke of some benefits or schemes to be given to other AIF. He said for at least for a certain period. I thought Sharad didn't say give it forever, give it for a certain period. Domestic money, you need to reduce tax if you need to get in more domestic money. Allow more financial engineering, like the optimum leverage he spoke about 1:4. IBC protection, Irfan said, is not impacting his credit analysis. His credit analysis is more based on what the cash flows of the project are. How do we get in more FDI into residential was my next question. And Amit BHAGAT mentioned that similar incentives to GIFT City. He spoke about how insolvency cases to be resolved in 12 months. If we can get that intercreditory agreement to be honored in time, that can be fixed. And Ashwindar again spoke about how this is overall our residential, thanks to some of the mistakes we ourselves made in 2007-8. The perception is that it's a very unorganized sector. That perception has to change. And many large players are required. Today, there is no depth. Ashwindar said there's like this 10, 12, 15 developers today who are worth kind of for playing that scale game. And he felt smart city, the overall government hype around smart city is overall a wasted opportunity overall. So back to you, Sapna, for some of the audience questions.
One question we have is that they say we are seeing an era of specialization in real estate, players only in co-working or co-living or data centers. Is there something going to happen in residential segment as well, specialization?
Who wants to take it? Amit, you want to take that? BHAGAT?
Yeah, I think I can take it. See, that is already happening. There are players who are in the residential space, and commercial being built to lease, very capital intensive, is no more any domestic players game. It is already dominated by all large buyout and very large funds, and especially sovereign funds also. In warehousing, there are special experts who have come in. That will always be the game.
Right.
But having said that, private equity will also be an opportunistic space. So wherever the large players are not willing to take a construction risk, the other players, if they are opportunistic, can fill in. But it is definitely a game of specialization only. Even if you go to a sector agnostic PE, you have different experts there for consumer durables, for everything. I think that is already happening and will continue to further consolidate in that direction.
Breaking it further down within residential, will it be, developers only in luxury, developers only in mid-income, or only affordable? Is that going to break down even further?
It may happen, but the scale has to pick up for luxury. The scale is so minimalistic that nobody wants to go in that space, and everyone is focused on mid-income and affordable housing.
Sapna, I'll just add a couple of lines here. I think a classic case here is of DLF. There was a time I remember in 2007, 6-7, when DLF was looking at an expansion into 50 cities. They were looking at hotels. They were looking at, I think DRHP said they were looking at 20,000 rooms hotels. They were looking at IT parks, retail malls, all that. But today you look at DLF's strategy. In residential, they want to play only in one market, which is their core market, Gurgaon NCR. Commercial, they've identified like 4 markets. I think that specialization is bound to happen. You look at the best office players in the country today, people like Embassy, RMZ, all of them played just one big asset class and did really, really well in that. So I think it's a matter of time before specialization happens. Look at Godrej Properties. They don't do office. They are fully focused on residential. So I think that specialization is just a matter of time. You just cannot be the best. You look at the big developers who got into trouble in both 97, 98 and 2007 and 8. The biggest reason they got into trouble was they tried venturing out into multiple cities and venturing out into multiple asset classes. Everybody wanted to become the best in 5-star hotels. I want to have 3 5-star hotels. I want to have 3 malls. I want to have 10 residential, 5 office. Those are the people who got into trouble. Look at the names. I don't want to mention those names here, but you look at take the top 5 and look at them. They're exactly what they did, and that's where they fail. So very, very good question.
Yeah. Okay.
If I can just add to
not
that.
only segment but also region-wise also. Yeah, Mr. Chetan.
Just add to that, the feeling among investors is they will do their own diversification, right? They choose a developer or they choose a private equity fund for a particular asset class, and then based on their own risk return profile, they'll allocate assets amongst different asset classes, even within real estate and across real estate. So they would rather keep that decision to themselves rather than leave it to the underlying developer, and that's where the whole story of specialization comes in.
Okay, fantastic. So not only from the developers' point of view, but also investors' point of view, specialization is the way forward. And I think that was one very exciting conversation, because residential is close to everyone's heart. So, thanks, Mr. Ramesh Nair, for wonderfully moderating that. I actually had 2-3 more questions, but, we have to move into the next session. But thank you so much, everyone, for sharing your views and that, your opinions, most importantly, what should be the way forward, how we should work out various challenges that, again, a lot of our speakers mentioned the challenges as well. So thanks, Mr. Amit Batra, Mr. Amit Goenka, Irfan Kazi, and Mr. Sharad Mittal and Ashwinder Singh, and Ramesh Nair, as always, for that wonderful moderation and conducting of that panel. Thank you so much.
Thank you, everyone.
Thank you.
Thank you, everybody.
So friends, that was one very exciting session on one of the most important topics of the day when everyone is looking at buying homes. So from there, let's move on to our curated session of the day, where we have our knowledge partner sharing his views on technology in real estate, how that is coming in play when we are talking about real estate and the way forward. So let me welcome Mr. Sundar Jagannathan, co-founder and head of products Prop VR, to share his views on the topic of technologies transforming real estate. And let me just give a brief introduction of our speaker. Mr. Jagannathan is a serial entrepreneur and an avid learner. He has worked extensively across multiple industries, building products in both hardware and software space, bootstrapping and scaling startups internationally. And he's also an enthusiast about design, technology, and human performance. So, Mr. Jagannath, over to you. A very important, topic that we need to talk about in present times.
Thanks a lot, Sapna. Great day today. So yeah, I'll be taking this session on technologies transforming real estate. So let me just start by sharing my screen once. Sapna, can you just enable screen sharing?
Yeah, can I IT team help with that?
Yeah, 1 second. Yeah, I just got it. Thanks a lot. So 1 second. Yeah. So yeah, I have divided today's session into 3 major parts, and then we'll go into the questionnaire. So the first part, I wanted to take time and educate our audience about 4 key technologies that are transforming the real estate industry. The second part of the session is describing how these technologies are impacting the industry use case. And the third part is I'll be taking them through a live demo of one of the solutions that we have been seeing great success during the entire pandemic time. So let me get started. So hi everyone. To give you a quick background, we are going to talk about technologies transforming the real estate. Before we start, a quick background about who we are. So we are a prop tech company. We started in 2016 to create high quality 3D visualizations using software. So till date, we have filed 5 international patents on real estate 3D creation and remote showcases. And we have also been recognized as one of the top tech companies by CBRE and NASSCOM. Recently, we also partnered with Square Yards Group to kind of expand the network of the entire technology impact that we can create. So till date, we have been working with 40+ top developers across India to kind of provide solutions in various areas where we could improve their aspects of marketing and communication overall to their customers. So something that I keep telling all the developers and the entire industry about is how the world of marketing is moving, right? So we started with the era of audio-based content where the marketing was mostly towards radio-based communications. And we moved from that to a text, images, and video-based communication where it is more of video, social media, and we are trying to generate a lot of content around this. Moving forward, if you look at the next decade and the next evolution that is coming up is how the world is moving from a 2D-based content to a 3D-based content. So you must be reading news about how Facebook, Google, Apple, all these companies are investing heavily into these technologies, and some of which we are going to also see today. And this is the era where we need to be ready about how we can impact, how this can impact real estate and how we can actually take this in advance so that we can take maximum benefit out of it. So let me start with the first part. I'm going to talk about 4 key technologies and how they're revolutionizing the entire 3D world. So if you have been following the entire industry of technology, you must be knowing that the 3D scans are becoming generic. And one of the major reasons of this is the entire concept of 3D scanning is evolved from LiDAR scanners. So this LiDAR scanner previously was a very high-tech component which used to be followed in autonomous cars. So if you look at the industry, when the autonomous cars have evolved so much, now even phones like iPhone recently, if you look at iPhone 12, they launched LiDAR sensor part of their smartphone camera itself. What this means to the industry is that with your smartphone, you would be now able to scan your space around and you can convert that into 3D. Now, if you look at it, this could be entirely disruptive, not just Apple. Once Apple does, you know that the industry kind of follows and Android phones and all these start adopting to it. So imagine what happens if all these phones start having cameras that can scan the space around us completely in 3D. Let me show you the impact in real estate. So imagine you have model houses in real estate, or you have your houses to sell in real estate. So today, to visualize these houses, it is very difficult for a customer to kind of understand this. But imagine instead of taking photo, now you take your phone and you scan your space around, and that gets converted into an experience like this, where the customer can kind of walk through the entire scene without like taking too much effort to kind of create these experiences. So with that impact of putting sensors on the phone, you can now create high quality 3D visualizations at a fraction of cost and fraction of time. The second key technology that is impacting the industry is the entire concept of 3D visualizations. So if you have been seeing all this animation movies, right, you must be noticing that these animation movies are becoming more and more real. As we go about, it's very difficult to kind of differentiate what's actually real and what's animated. So the entire reason for that is because the power of technology and computing hardware has become so much that using AI and using this 3D hardwares, you can now render high quality content at a very, very short span of time. So we have been seeing that in real estate, you can actually use this technology to kind of create high quality visualizations at a very, very short time. And you can generate this very, very quickly. Using this and AI together, we have seen that one of the biggest impact for the industry can be that you can just by uploading, you can recognize your floor plan and convert that into a very high quality 3D visualizations. The impact of this is you don't need to invest too much money on building your model flats, physically staging them when you have the power of 3D. So today in residential, every builder has like 2 BHK, 3 BHK, all these variants. So instead of like creating these variants physically, which takes a lot of time and there's a lot of money involved, you can create this in extremely realistic ways. So there are some customers I could talk about who have used this technology to kind of create multiple variants in the beginning phase and use this as an A/B testing in the market to see which of their variants, what kind of interior styles and what kind of specifications can be best used for the market. The third important technology era that you must be all be knowing, like right now we are on Zoom, right? So the growth of conferencing apps. So if you look at it, the pandemic has actually taken the world around 5 to 10 years ahead. So the entire concept of work from homes, conferencing, all this was kind of expected to happen in 10 years. Because of the pandemic, this has moved quickly. So with this entire concept of video and voice conference, where are we going in the real estate space, right? So people want to like first look at these properties that they are visiting. They want to kind of remotely get stuff. So if you look at overall consumer behavior, today we are so used to things coming to us, like you order something on Amazon, you get it in a day or so. You order something on Dunzo or Swiggy, you can get your food. So why not real estate, right? So with the entire technology of this 3D world and your digitization, you can merge that with video conferencing that can allow you to take real estate to consumers to kind of do an initial shortlisting. So imagine sitting at home, I can communicate my real estate property to my customer in the most immersive way possible. So that is possible today with a lot of collaborative real estate applications that allow you to do that. And the fourth key technology is the rise of GPU cloud computing. So this is powerful technology that is coming up in the entire concept of cloud computing, where Amazon, Google, they are investing heavily on streaming applications on cloud. So previously, if you look at what is GPU cloud computing, just to give you a background, previously, if you look at it, if you needed to play a high level game or a high level application, you needed to invest in a hardware. That hardware used to cost somewhere around 2 to 3 lakhs of rupees. But with the entire concept of GPU cloud computing, now you can have these expensive computers on cloud and you don't need to invest on the hardware. You just get access of this hardware on time, where you can create applications that can be hosted on cloud and can be streamed on mobile and web devices. So the impact of this is, previously when we used to do heavy 3D real estate applications, right? It was always limited to offline experiences. But with the power of GPU cloud computing, you can deploy very high quality applications of real estate, like showing them their properties, their location, their high quality videos, everything you can show them remotely using the GPU cloud computing. So this basically concludes my first part of the presentation, where now moving on to the second part, where I'm going to show you how these technologies actually solve the problems in the real estate industry. So if you look at the current real estate landscape, there are 3 core problem statements which every real estate builder faces. One of the core things that real estate in residential real estate, especially, they do that is that they build physical model flats and they have to physically stage them. So, and post construction sometimes even destroy them. So this is kind of an expensive way to kind of build and physical spaces when you have multiple variants that you want to showcase your customer. Secondly, 2D assets like photos, videos, and floor plans, when you show that to a customer, it is very hard for you to communicate what you need to actually visualize as a customer, right? So for a customer, it becomes like mandatory that after seeing this also, I have to visit multiple times to multiple sites before I can make my final decision. And thirdly, the entire concept of remote showcases with the pandemic. How do you actually show your property in a remote possible way is kind of a difficult problem to solve. Like using Zoom or a WhatsApp call, if you kind of do this, it's very difficult for the customer to kind of get a complete in-depth understanding. So if you look at it, what we understood right now is we kind of created a module and we tested it with a lot of real estate clients to see that how this kind of works with them. So we merged three major technologies to kind of create a holistic experience for customers. Firstly, we kind of created an entire 3D visualization for their project, their surroundings, and their amenities, everything. Then we merged that to the digital transaction, which is your booking process, all your payment gateways, online transaction. And thirdly, connecting that to virtual site visits, that is showcasing this remotely to a customer. So if you look at 3D visualization, the core aspects of what is involved in a consumer decision making is that you look at the project, you look at its orientation, you look at what is in its surroundings, you look in your amenities, then you go into the interiors. So it's like a story flow that a real estate salesperson pitches, right? So you using the high quality 3D visualizations, you can now digitize all of this in one single experience. But today, if you just create 3D, right, it's kind of disconnected if you do not connect it with the digital transaction. So in this case, what we did was we also linked the 3D experiences to the digital transaction part, that is to integrate with live inventory and also the customer application form. So all the offline processes, which takes a lot of time in real estate, we kind of digitized it and linked it to the 3D application that allows you to kind of take the customer through that journey. So it's like inventory management, your online payment gateway, e-sign integration, everything gets linked to your 3D. And once you do all that, you also need to connect your remote showcases part. That is, how do you communicate all this information to your customer in a remote possible way? So in that case, what we did was we kind of created a voice and video application that allows you to kind of showcase your properties in a collaborative aspect to your customers anywhere around the world. So in this case, we also enabled real estate sales teams to operate highly, like in a very efficient manner by scheduling calls, by monitoring their sales performance. So it's like a fully built voice and video conferencing application for real estate sales teams. So now let me take you through a live demo use cases of all these technologies in live action and what are the industry results that we saw from the customers. So one of the first use cases is how do you avoid building model flats and save a lot of money using the 3D technology. So one of the use cases that I'm going to show you is an experience that is built completely for a web and mobile viewing experience. So you can see here as a customer now, without even going to the model flat or as a developer, without even building the model flat, now I can use 3D technology to create experiences like this, which allows me to give the customer a complete overview of my project. So you can see here, these are created using the same 3D technologies that I was mentioning, where you can create high quality visualizations at a fraction of cost and time. So as a customer, now I can walk through the entire experience as if I was walking through the model flat. Here, the best part is instead of building model flat, the customer actually created all this in 3D. So you can create for multiple variants, that is your studio apartment, 1 BHK, 2 BHK, all of them in real time. And you can give a customer an experience as if he was walking around the flat. In some cases, we have also seen that wherever you need to communicate the viewpoint for a customer, we have seen customers also integrate their drone shots with this 3D experience. That allows you to kind of visualize how their entire view from that particular property is. So this allows the customer to get a complete in-depth understanding of how your real estate purchase is going to be. So you're virtually visiting a site just by using this 3D technology. Another use case, this was something very interesting that we saw, that one of the customers actually wanted, they had built their already built property. But you know that if you try to showcase an empty flat, it's kind of not completely visualizing for the customer to understand how my lifestyle would be in that particular flat. So for this particular customer, we kind of documented, we took pictures of his empty flat And just from the empty flat, we were able to do a virtual staging on it. So this saves a huge amount of cost for that particular developer rather than investing in their furniture and kind of giving it on scrap. Now he can do all that virtually using our powerful virtual staging product. So this enables you to kind of give a complete overview of how your entire flat would look like with the furnishings without actually investing in the furnishings. Then coming to the third aspect of how do you kind of showcase your entire project and product experience remotely, right? So in this case, we kind of created a complete model of your project and your surroundings as if you can take the customer through a complete walkthrough. So you can see here in this case, your project is located and we all actually do a location mapping of your project so that your project can be shown in the best possible way. So once you show this, you actually can take the customer through a full project experience. So show him the first exterior view of the project, then take him to the surroundings view. So in the surroundings view, kind of showcase the most important aspects, like what is your major roadways, what is the railway lines, all this information that a customer needs in the decision making. You can also map out the most crucial information like your restaurants, your education centers. So when someone clicks on it, you kind of give an information of what that particular thing is. So this basically gives the customer an understanding of the location and the landmark. Once you go through this, you can switch to the amenities view of the project. The amenities view of the project, again, you can use one of the high quality visualization technology. If it is not yet built, you can use the 3D to kind of showcase them in a realistic way. If it is fully built, you can obviously take photographs and just connect to the platform. So in this case, like for example, the swimming pool, just using the swimming pool plan, we were able to generate like high quality visualization of the entire swimming pool and how this is going to be seen in the future. So once you go through amenities, the next part, you can actually go into the collateral. So you can manage all your collaterals in one place. That is your brochures, your floor plans, your 3D walkthrough videos, so that the customer can take, you can take the customer through the entire project aspects of collaterals. And finally, once you have seen all that, next decision making is go into the inventory and see the flat, right? So in this case, we have mapped the inventory with the 3D. So I can click on any of the particular flat and I can actually click on going inside that flat and seeing that particular variant. So this is basically a powerful full-fledged storyboarding concept where you can tell the customer what your project is about, your landmarks, your amenities, then take him through the interior experiences. So once the customer is convinced, you can take him to the second part of the experience as well, where you can get all his major details and you can get an online booking from him by integrating with payment gateways and automatically generating a PDF document, which is your offline process, completely digitized using just forms. So you can see here that with these three core technologies, once you like take him through the 3D experience, then you take him through the digital transaction. All this can be taken through a Zoom call or using a virtual site visit tool. And you can take the customer through the entire journey and you can do a digital remotely showcase the real estate as well as make a booking. So some of the customer impacts that we have seen across our builders is that we have seen that digital experiences built using these latest technologies actually increase 400% of your customer engagement. And we have also seen that in the last 3 months during a complete lockdown, there are developers who use our platform to kind of create sales of more than 30 to 40% of their units were sold using just a digital platform. So one of the key testimonials and impact that we received was that their major impact was that using these technologies, their sales teams have become more productive in terms of like rather than waiting on the site, they basically now can invite NRI customers on a remote call using these platforms and take them through the virtual site visit. So that's basically it from my side. I think I've covered most of the technology aspects and the industry use case. I'm open for any questions that you guys might have.
Sundar, we have one question where they're talking about that while technologies are there, and they are easily available, there are providers. How is, the real estate or the business leaders from real estate are adopting these technologies? Is there, because real estate, as you know, is known for being traditional in the way it works. So what is the acceptance we are seeing right now?
Yeah, that's a very good question. So to be frank, Sapna, initially we had like before pandemic, I would tell you that story that when we actually approached real estate, right? So it was like always like it is like all these technologies are too futuristic. We are not there yet. We don't want to like kind of invest in all these technologies. But then once we started slowly seeing the entire impact of pandemic, we saw that a lot of real estate developers started understanding that these technologies actually are not expensive to do, but these are actually allowing you to do a lot of cost cutting. And they also saw that with this entire technology, when you can actually pitch it to customers in a remote way, your acceptance rate can become better. So we saw that from developer side, the acceptance rate slowly increased. And with the pandemic, they have now started understanding that this is mostly like a must-have product for them rather than just a nice to have.
Okay.
So yeah, that is evolving as we go about.
Okay, so the start is there. There is a level of acceptance, and I'm sure it will gradually grow. It will continue to grow across cities now. What are the expectations of the prop tech companies? There are companies like you who are doing good with grade A developers and all. What are your expectations going forward?
So to be frank, one of the key things that we expect from developers is that they completely understand the life cycle of all these products and how this can actually add value to them. Their understanding in terms of how this can actually involve in their day-to-day processes, right? So sometimes see some of these technologies that I've shown, like remotely showcasing a property, these involve habit changes in consumers. Like it involves your sales teams to kind of change behavior to a great extent, like showcase customers remotely first before you kind of take them through a physical site visit. So these are all habit driven products where you might need to push some of these products through your system so that your teams can adopt it and get better ROIs from it. Because otherwise, if you just implement technology, you won't get the ROI, then you kind of feel that, okay, this is not working. So there also has to be some kind of push from them to kind of start involving and using this across their teams.
Okay, so educating your customer also, so because that is the end user of course is one of the biggest stakeholder in this entire ecosystem of the developer and the prop tech company and then the customer. So some onus lies on the developers to educate the customer also. But I think we have seen during this pandemic, digital, all consumers, all customers, and especially we have seen millennials have been the buyers. So
Yes.
they are already digital savvy and tech savvy, and they have adopted these new ways of looking for properties and visiting properties, as you mentioned. Any before we let go of you, any last words? How you see beyond 2021 for real estate and for prop tech?
I think it's quite an exciting time. One of the key trends I've seen is that, as you said, like it's a very good point of bringing out millennial experience, right? So India has a population of more than 50% who are young generation. So these are going to be the next phase of home buyers. So for them, we need to kind of market rather than a non-traditional way. We need to market in a more modern way. So we see that the growth of prop tech is just starting. With these technologies adopting, all the millennial generation would be probably adopting in this way rather than a traditional way of marketing.
Okay, fantastic. So the future is bright, and our generation of next home buyers is ready to do the digital journey in real estate. So thank you so much, Mr. Sundar Jagannathan, for that very informative talk and taking those questions. Thank you so much.
Thanks a lot. Thanks a lot, Sapna. Have a nice day.
Thank you. And let's move on to another technology-focused talk and on a very important topic, which is reducing customer acquisition cost for realtors and sales and marketing of automation, how that can do for realtors. So for that, we have speaker Govind. He's the co-founder and CEO Totality. And let me give a brief introduction of our speaker. With over 10 years of experience in real estate consulting to the leading real estate brands across India, Govind has specifically focused on helping realtors focus on efficiency and drive better ROI. He has handled more than 280 project launches and has helped brands optimize their media costs by focusing on digital media. So Mr. Rai, over to you. You're on mute.
Yes, Sapna. Thanks a lot for such a lovely introduction. I need one more help from you. If you could, screen share or give me the,
Yes, please.
rights
Can
for the
I
screen share.
ask the IT team to help on that?
Okay. Somewhere I'm not getting to an option to screen share my screen. It is showing only web URL and photos. Sapna, I've mailed you my deck. If in case you can screen share, that would be really helpful.
Yes. Can I ask the IT team to please share, share the screen or probably, play the presentation?
So meanwhile, Sapna, I will do one thing. I will get started and get going with what I'm here for. So I've been hearing all the talks since morning, and it's very exciting. And I'm really glad that I'm doing this session right after Sundar. Sundar and I have been working together for quite a while with our dream, the ambition, and that we always have shared. I guess it is about reducing the customer acquisition cost. The talk that I believe that it is the most important phenomena that has been introduced to the whole real estate industry since last year. And the biggest thing that we realized that, over a period of 2015 to 2020, when the real estate market has been going down, the customer acquisition cost, which is cost per booking for each and every developer as well as broker, was continuously on a rise. And that is where, we started working and we realized that, okay, is there a need gap here? And that is where we realized that technology is going to come in and play a very important role. And that's when we went into the detail and we felt that there is such too much that's going to change in the coming time. And it was only last year during the pandemic when everything became crystal clear, where we have been seeing all these movements happening in US market, but somewhere because of the adoption that we have, which is very limited in India with regards to the realtors adopting to technologies, we have always seen a little bit of restriction in terms of how the adoption of these technologies is going to happen. So my today's agenda majorly is to take you through a very important journey that we believe that is going to transform the way customers are engaging with the realtors in the coming time, and how they're going to be seeing their homes, how they're going to be transacting with their homes, and what are the problem areas and what are the solutions that we should all aim towards working for. And because of that, I will also be looking forward to cover a phenomena where what are the areas where we still do not have technologies emerging, and those can be the need gap, or the technologies are already there and they are the perfect opportunities as of now for the investors and people like us to partner with to create a holistic solution for the whole real estate landscape. So guys, if I can have an update on the screen share, that would.
Go and just check. You can do it now, I believe.
Just wait. I'm not getting an option for the direct screen share. There's some issue. I'm not. Have you got my presentation?
Yes, I have asked them to play it for you. But in the meantime, can I ask you, one of the questions that we just received is, how has pandemic impacted PropTech investments?
Absolutely, Sapna. I believe it's totally out there right now in the market that, we have seen a trend where food tech companies were getting funded. Then there was a trend when, right now the ed tech companies are the, need of the hour, and they're getting the best amount of attention. And parallelly, there's a huge, velocity that is going on with regards to the D2C brand. I believe this is exactly in the pandemic where people have started realizing that how PropTech can change the dynamics. And there has been a good amount of movement that has definitely started, but I see it as just a tip of an iceberg. And going forward is the next 5 to 10 years where a lot of agent tech companies, which are going to be fueling the sales, and the technologies which are going to be, fueling the growth of developers as well as agents, is going to be shaping the future. And they're going to be multiple $100 million valuation companies that I believe that that is going to exist. So the next 5 to 10 years is something definitely which is there for India to look out for. And I'm very bullish about what's going to happen in the
Not a
next
short-term
10 years.
trend, but it's a long term. It's going to stay.
Absolutely. PropTech, because the biggest problem that we had in India is industry was not very organized. So the investors, the VCs, they have always stayed away because of the the issues that they have seen. But now when the industry is organized, at the same time, the young guys who are coming out with the solution, which are actually shaping the world in the right way. And there's so much inspiration that we can draw from the Western part of the world. So which serves as our POC. With that, putting all these things in context, it's a perfect stage that is already set. We just have to go and perform the best that we can. And I'm pretty sure that, there's going to be great amount of excitement and funds, not from Indian VCs, but globally. There's a huge amount of, attention that is already being paid to the prop tech side, because this industry is just not organized. And now when it is getting organized, the potential is just immense. It just cannot be ignored at all.
Okay, fantastic. We have more questions for you, but we'll come back on that.
Yes.
We have a presentation of this.
Thanks a lot, Prashant, for rolling in the slide. If you could just go to the second slide, and I'll start from there. So, guys, the biggest thing that I was talking about in terms of what is the current problems that are really existing. You can only make solutions and technologies when we are really aware about the problems that each and every people in the strata is facing. My expertise and forte has been the sales and marketing automation. And that's where I believe that, these are the 5 most important, industries which we have to work together, where a customer journey can be made more exciting when they're going towards buying a home. So customer has to interact with the channel partners. The biggest problem in the channel partners that we have really seen is so far not very organized player were really existing. Now a few of them have started coming in and they're doing amazing. But this is just a start. We are not even at the real potential of 2% or 3% of what or where we should have been. So lack of automation and the operations, optimizations of the leads, the most important phenomena that we have still seen, the adoption of technology being low. The brokers are still not focusing a lot more on how they can actually optimize leads in the best way possible, by the lead exchange, by rotating the leads amidst their offerings. Until the time they're not shifting towards technology with regards to whatever CRM that they are using or whatever interface they use, this is not going to be used to the most optimum level. At the same time, one of the largest problems that we have seen from the channel partner side has been about their business operation, where it is dependent upon when the developers pays the brokerage, and there's a delay. We see there's a huge opportunity in this space as well for fintech companies to pitch in and do a kind of an arrangement which is possibly happening in other other verticals in other sectors. But channel partners so far have to depend upon a cycle of 3 to 6 months, and that's where I see a huge innovation opportunity, which I'll be covering in the next slide as well. Moving forward to the customers, the biggest thing, as we say that the biggest problem is the visualization at the search stage itself. I'm glad that Sundar presented just right before me, and the solution that he has been working on from last 2 to 3 years. I believe that's exactly what we need, and we need more of them to come in, because the whole India has to be mapped on the 3D level, and it needs a lot many such companies. And so the opportunity is very huge in that space. The second part is the location data intelligence. Nowadays, the customers are getting more and more aware about, very conscious about the pricing that they're buying the home for. There has been a time where they have felt cheated because the whole industry was not very organized. People have just floated rates, and they have realized later that, oh, they bought the home at a higher price. People are doing much more research. And thankfully, with companies like PropEquity, PropStack, CRE Metrics, PropAMC coming in, these data are getting out to the market for people to really study, take more informed decision. But yes, a lot of Indian landscape with regards to the lands, with regards to the tier 2 and tier 3 cities, these data are still not available. And that's a huge market opportunity that I believe that is still out there for people to grab. The second part and the second lacuna where in the customer's journey, which we really felt, is the lack of understanding on the financial side. So there are loans which are being given by the institutional banks. But the second part where the companies like Home Capital and the bridge loan companies are coming in, the awareness with regards to the interest rates, with regards to when to switch from one loan to the another, there's a huge involvement here and possibility where fintech companies and prop tech companies can work together, create calculators, create algorithms, create solutions on the UI itself, where customers can actually garner an information about what is the right time for them to step out of the current loan that they are doing to the new one, how they can optimize their loans in the best way possible, whether a subvention is better, whether a 1-year subvention is better, what exactly is a preferred possibility for them. So here I see an opportunity and the problem that we have, which can be solved with the help of fintech and proptech together. Similarly, on the developer side, the lack of automation, and glad that till since last 1 year there has been a huge amount of progress in terms of more and more developers who are going out to acquire ERP solution, more CRM solutions, and they are working towards optimizing their own cost, and they're giving their sales mandate to the third party companies. And that's where the cost optimization again in coming in. a developer who is not having a huge slate of project over a period of a year, it's better for them to outsource it to the other company. Now, what happens to the other company, whether it's a mandate company or channel partners coming together, the limitation that the developers have been facing with the lack of automation and technology, the same problem goes to the other side as well. And that's the other space where we believe that, there's a huge amount of improvisation, and, new startups can come in to solve these problems. Now, similarly, in the customer journey, one of the important phenomena that we have seen, and we have seen a few inroads like Zapkey and Prop on Square areas making a backward integration into the interior design. Similarly, No Broker is trying to do the same thing. So the backward and forward integration while buying a home and the possibilities which comes along with it, with regards to the home design, interior designer, contractors, so that customers can engage with them, pretty easy, and they can be very aware about the pedigree of that vendor that they are associating with. All these things and a possibility of a creation of a marketplace with regards to the forward and backward integration. This marketplace opportunity still lies totally open. There's no consolidation that we are seeing in this space as well. And yes, that's where I believe there's another focus area where the investments can come in if the ideas and people are working towards those possibilities. And the allied industries, even the home loan companies, we've been interacting with SBI, HDFC, ICICI, and we have really seen the acquisition cost for them also is pretty high, and there's a huge scope that it can be brought down by having the right synergies at the right places with regards to partnering with brokers, developers, and maybe the allied industries as well. And together, this whole ecosystem coming in together as a marketplace has a great opportunity to solve a lot of problem in the coming time. The similar issue is with the financial institutions, which I have covered. When we engage with SBI Home Loans, we realize that they are relying somewhere about it's about on the number of homes being booked and how much target that they can actually fill with regards to their home loan book being bloated with the right set of customers, and they are continuously in the lookout for engaging with such customers. And that's a space where all these marketplaces can come together and help each other. Prashant, if you could help me with the next slide. So these are the problem statement that I spoke of. The next important thing is, how do you solve this problem? And so somewhere we believe that over a period of time, with the problems are there, solutions are also going to be there. And when these things are going to happen, that's where the PropTech industry in India is going to shape up in a very different manner than how we have seen in Western side. Of course, there will be a streak which will be common to what is happening in the Western side. But in India, there are many indigenous issues, very indigenous solutions that we can come out with, and the problems which are very local, which has to be solved with technology and which can be solved with technologies. And in doing that and in that journey, we will be having a solution which will be standing very differently. So the solution that we believe that is going to have in the coming time is the sales part, which is how a channel partner is conducting a sale, how they're managing their site operations. Are you still putting your data into those papers and Excel sheets, or you are automating that part as well? How are you recording those interactions for the future usage? And the next part is the customer engagement and experience. So a developer, after RERA has come in, we have really seen that when the consolidation is happening, the future markets are going to be about a lot focus on the customer experience. The overall, the customer asset value, what we call in terms of in a lifespan, if a customer is going to buy 3 homes or 2 homes, if it can be with the same brand, something that we have seen with Oberoi, utilizing in the best way possible, where they have really focused a lot on customer experience, and a similar kind of behavioral pattern we have observed for Hiranandani as well. Now, these are the possibilities of the future where the other brands which are operating in this space, they can do a lot more, and the technology companies can come in, fill in this gap, with the help of technology, by engaging customers at the right time, giving them the experiences which really would create a long-lasting bonds with them. That's where a possibility of consolidation really exists, which is followed by the virtual site management. Fortunately, Sundar just covered the same thing, making sure that each and every home is available on online for people to surf. We have really seen a new trend where people who used to go for 15 homes for personal site visits, now they're just going for 5 and 10. 5 and other 5 are getting shortlisted only on the Zoom level, only on the online level. Now, the Zoom as a platform is not providing the developers or realtors any data. And that's where we need to evolve technologies which can give the data of those engagements and interactions as well. So that's one funnel. The second funnel, I believe, is the marketing side of it, where I have a small showcase and case study in the following slide. But the real scope is the media mix that is being created, we literally have seen that each and every time a developer is creating a media mix, they are going about making a gut-driven call. And if the outdoor has to be selected or newspaper ad has to be selected, it's all gut-driven. The data is not really fueling these calls. And if the data is even fueling the call, the way they are going about reading the data is not always apt. Based on our engagement with more than 100 developers, and so far we have managed more than 150 CR of media, for the real estate developers, and we have literally seen it's the lack of data understanding, how the data has to be iterated. There's a huge scope where automation can come in, so that this job can become easy, because we do not expect every marketing guy and the sales guys to be a data analyst or a data scientist to make the right judgment out of it. And that's where the automation can play a very important role. The second part, when you're making a marketing related calls, the historical data with regards to the data intelligence for the location, with regards to what has happened in the last 5 years, where the customers have come from. Now, these data are not usually being read. Even if they are being read, they're not being applied when these media mixes are being created. And that's where I see that, again, an automation in this space has a future. The companies operating in this space has an opportunity as well. The next thing, which is yet to take up very big in India, I believe it's going to be huge. It's the transaction management. A few startups, few companies have made their inroads and started, but with the digitization coming in India in the future, that's a great opportunity that lies ahead, where how the seamlessly a customer can actually make the property registration online, and all the contracts that are being submitted between the rent guys, between the homeowners and secondary market, they can be made online, and all the edits can happen together between the customer and the seller, and the possibility of engagement and possibility of easiness in terms of with the help of digitization in the transaction side. It's a huge market that's waiting to be explored. Similarly, on the operations side, the CRM and ERP somewhere have been a 20 years old phenomena. With technology evolving, the CRM is just not going to do the right job what it was meant for. So the developers have to scout for opportunities where the new technologies are being imbibed. How do you ensure the solution that is there in the visual site management gets to the dashboard, and the data that comes there, it's all makes sense together? Because today the data is lying in silos somewhere, and if they're going to be lying in silos, you will never be able to take any benefit of it. The idea is how all the data can come together from the ERP, from the CRM, sits at the data warehouse. And that's what this slide is trying to showcase to you, that the sales funnel, the marketing funnel, all these important data points, they come together, they get stitched against each and every customer. A customer who stopped at the site and then later on bought the home, and after buying the home 10 years down the line also, whatever that he's doing and engaging with the brand, can all these things can be mapped together? If it is going to happen, because as I said, that's where we will be in a position where we'll be able to bring down the acquisition cost, because at that point of time, with the help of technology, we are really mapping each and every parameter with regards to the customer, and ensuring that at no point of time we are losing touch with them, and the cost of reaching out to the same customer again and again is always avoided. So in the basic nutshell, the operations of the team, the transaction management, the sales and the marketing team, if all these data with regards to the customers can come together, sits as a data warehouse where with the help of AI and ML, we can do, write the right algorithms, which is ensuring that the lead management is happening at the optimum. The cloud telephony interfaces are helping us to understand the customers a little better. The media mapping and the media mix are, being optimized as well. With the help of that, we can create insights with the help of marketing mix modeling or multiple variable regression. We can create insights, which is going to always help us create more automation in workflow, more automation in our day-to-day operation, and ensure that we have a very reduced customer acquisition cost in the long run. So that's the huge market that we believe that is still out there to be explored. And PropTech on the sales and marketing side, there's so many opportunities that lies. The future is going to be with the one who can, build most of these things together, put it out at one place, and get all these data together at one point. It can happen with the help of partnering with companies in the PropTech domain, where we can have open API share access, where all these APIs can talk to each other, so that all this data comes to one place, and the system try to makes the best sense out of it. Prashant, if you could just help me with the next slide. So just give you an example that into the marketing mix domain, we have a product called Marketing Signal, which we recently launched, which was into a pilot in the last 1 year, where we have tried to track the digital spends of the brands like Hiranandani, Ki Raheja, and many more. We realized that eventually in a digital marketing campaign that we are running online, there are 22 variables which are really affecting a particular campaign, which could be the time of the campaign, which could be location, price, offer, visual, color, brand. It can be, the festive season. So there are 22 variables which are affecting this campaign. We ran all this data via the 100 crore campaign budgets that we were spending via different mediums for different brands that we are working with. And eventually we realized out of these 22 variables, there are 6 variables which are having the 80% impact in terms of the overall trend of overall campaign health, and how the costs were going up and down. And that's where we focused upon these 6 variables. And now we are able to bring down the customer acquisition cost by understanding these parameters, that how a communication or visual is working, how a campaign price, what should we float out, that is really going to help us brought down our cost per lead. With the help of these solutions, we are able to now, we have delivered in last 1 year, new acquisition costs. We have brought down from 2.3% average of the clients to almost 1.4%. And one of the most important thing why we call it Marketing Signal, all the historical data the system is able to read, and it's able to pull out the signals and nudges to the realtors, to the marketeers, to help them in an automated manner. Where should they put their 1 lakh? Where should they put the next 2 lakh that they're going to spend on digital or on outdoor? So that's one automation that we have tried to explore from our end, where we really believe that we are able to bring down the customer acquisition cost by optimizing the media mix. So with this, I guess that is what I wanted to conclude today and put out to all of you, that the possibilities that are going to be there from technology point of view, I believe it's a very exciting time that we are entering in. And I don't think I would have been born in a better time zone and working in a prop tech, in a real estate industry. So that's pretty much it from my end, guys. Sapna, I'm totally open if in case you have any Q&A. I hope I wrapped it up in time.
Yes, you did very much. And, one question that I would like to take is, we have not many, but, we'll just take one. Sure. What, according to you, will shape up prop tech in 2021 and beyond?
See, with regards to technologies, there are so many things, with regards to construction, with regards to the data, with regards to the automation, which I just covered in sales and automation. But one thing that would really shape up the Indian real estate prop tech industry, I believe, is the open mind, the behavioral patterns, the change in the behavioral patterns of the realtors. They have to become much, much, much open than what they are. And technology is a thing where, using a WhatsApp, you may feel that, okay, I understand it. Or, using some tool, you believe that you can understand it. But we got to be much more open, because the known, known is a drop, unknown is an ocean. And we have to keep that thing in our mind that, there's so much that's going to happen and it's so exciting. We just have to adapt to it and be open to the changes that is coming in time. So that's one thing that's going to shape us.
You summed it very accurately. What is known is just a drop and what is unknown is an ocean. So, we just need to open up our minds. Absolutely. And it's great that our next speaker is a developer. So we'll take that to him in our next session.
Absolutely.
But thank you so much for sharing those, your views and opinions, and sharing that, what is happening, where the problems lie, what's the solution, and how we can all, as stakeholders, whether it's developer or the tech company or the consumer, can do this journey together. Thank you so
Absolutely.
much.
Thanks a lot, Sapna. You guys are doing a fabulous job. These dialogues are very much needed because we are just making technologies, but till the time we do not have more and more people accepting it or trying it, maybe we fail, maybe we succeed, but we need to try things together. And thanks a lot for creating such forum.
Let's have the conversations going. So thank you so much, Govind, for being here with us today.
Thanks a lot, Sapna, for the opportunity. See you.
So friends, let's bring on stage, as I said, we while we just had prop tech company leaders talking about technology, let's bring on stage a very eminent and seasoned professional of Indian real estate, and he will be sharing his keynote address on prop tech ventures from hype to hyperdrive. So let's see what he has to say as a developer. I welcome Mr. Sanjay Dutt, Managing Director and CEO, Tata Realty and Infrastructure Limited, to please take the stage. Let me, before I hand it over to him, let me give a brief introduction of our speaker. Mr. Dutt has over 24 years of experience in the real estate sector with various international real estate developers and property consultants. He brings with him extensive experience in real estate strategic planning, development, redevelopment, leasing, new acquisitions, and asset management business across geographies of India. Mr. Dutt, thank you so much for being here with us. I hand it over to you now.
Thank you so much for giving me the opportunity. I was listening to the speaker earlier. I can assure him and all the audience that I think as we call it in Hindi, tir kaman se nikal chuka hai. Most companies have already adopted the technology and embraced technology. In fact, whoever was not thinking of doing so in last 2 years because of the pandemic have actually accepted even more. And I think if you were to look at the real estate development journey, from understanding market and dynamics, whether it's artificial intelligence, search engines, media companies, social media companies, a lot of intelligence, information, qualified lead generations is already commenced, and we have made the most of it. You can clearly see from the media spending that is happening, it's actually becoming more digital instead of print. Print will always be there and electronic will always be there to complement it, but it's the digital which is taking most of the space right now as we speak. So from gathering information and understanding consumer behavior, consumer preferences, liking, disliking, tech is being used to actually assess, and therefore you repurpose your business around it, because tech has disrupted most of the sectors and real estate is no different. So that's when it comes to understanding of it. Now, from there, if you were to really operate your business, which is the next big part of any business enterprise, we already using the best of the technology tools available to all of us. We are using design tools. We're using, BIM for management of the projects. We're using construction of 3D technologies to kind of make sure that we model right and being able to assess the quantities right, being able to actually project manage through the BIM. Also, once you complete the process of construction, beside the obvious precast technology and robotics that we increasingly going to use in the real estate sector and are being used, even the asset management, a lot of technology, Internet of Things and tools and new convergence of technology is taking place in the sector. So I would say the whole ecosystem of the real estate sector is actually now clearly has embraced technology and kind of progressing very well. In fact, increasingly, it's becoming apparent that why real estate sector is considered as a brick and mortar industry. It's actually more tech driven, and indeed technology and all the tools that we are using now is playing an increasingly very large role. I would say even when it comes to taking the investors angle, or indeed the government's angle, because all of this is part of the ecosystem that the real estate developed companies are part of. Even the government is digitizing. They're also using technology and tools to ensure that they actually participate. I know RERA, for example, has really continuously is upgrading their system to communicate with the real estate sector digitally. So all these advances are making the sector far more robust, disciplined, and we are moving from Excel-based to real-time information. A lot of augmented reality, Internet of Things, all your tools and technology platforms, you can actually converge and link all of them, and therefore leverage the benefits of all of this. So I think this is really, really taking place on a very large scale in our sector. I believe just the way the developer community has realized that the brand plays an extremely important role. And unless you have established your brand, the probability of your success actually rests on it. Your credibility depends on it. Just in the same way, I believe if you do not bring technology, digitization, and all these tools in the real estate development business, chances of whether you being able to understand the customer, being able to service the customer, being able to manage the environment, being able to run a disciplined, profitable business will get compromised. So I think it's an imperative for business and no longer just a standard. Let me just do some digital and technology. So its significance has really taken the top priority for the real estate sector. In case you have any questions.
Yes, we do have. There is one
yeah.
question just come in that you just mentioned that on large scale the developers are now incorporating technologies in various segments, from design to construction to asset management, financial transactions, consumer experience. So, but is the penetration still superficial? I mean, because the cost remains a big factor for probably a tier 2, tier 3 developer. So are we seeing only adoption by grade A developers, big organized developers? What is the scenario?
So let me answer this very clearly. One, you don't need to invest in all the systems and tools, actually. So you can actually outsource most of it. If you were to, for example, implement Salesforce, you'll be surprised if you were to develop your own system, customize it for your business, and implement it would be far more expensive. But at one time, we used to think, Salesforce will be very expensive. For decades, we have used SAP, SAP for our financial and accounting, platforms for our business. Real estate is no different. So there are some which I would say are imperative that you need to invest. And yes, it does cost money. And it also does cost to upgrade. And some tier 3 developers may actually may not be able to find the initial capital investment and also the trained workforce, skilled workforce to be able to manage. But the way the businesses have grown, the way the volumes have grown, the cost, in my opinion, is not as significant as what we think. So at one time, you would say it is high, not anymore. Also, through a license approach of various software technology and tools, you can actually amortize the cost. So you don't have to pay upfront. You can, rentalize the model or amortize the cost for a period of time. But if you were to compare, a situation where you had to invest nothing in technology and you would run like a mom and pop shop, and therefore those developers may find it difficult, then the point I was making is they will not be able to sustain the business because, the process of technology starts with understanding the customer, connecting with the customer. So if you eventually miss on each of these critical criterias, then you are destined for failure. So soon, over next 3 to 4 years' time, such players may not be in existence to begin with. So it's a very, very imperative. Like I said, it's no longer, good to have. It's must have, critical to have, in my opinion.
Okay, so you mentioned that this is technologies must have, if you need to survive, it is a must. What are those technologies which is right now, imperative? And some which probably, like you advise that developers cannot afford, they can go step by step. So which are the technologies which are right now must have?
So most important right now, critical are your finance and compliance. Real estate sector requires a lot of interaction with government bodies and all. These are imperatives. The third, at various stages of business, developers attach significance to each and every step. 3-4 years ago, we used to attach to environment permissions, construction period, approval from the government. Today, the developers are attaching a lot of weightage to generating sales, to generating qualified leads, so that they're able to sell faster, they're able to service their customers better, because the customers have become very brand conscious. Because of RERA implementation, the men have been separated from the boys, and the customers now are aware which developer they want to go for because of the brand presence, like I was saying earlier, and because of the image and credibility that they carry. So now I think the weightage imperative is customer intelligence, qualification of sales and leads, and then being able to build your technology platforms. So when the lead is generated, and by the way, the leads get generated from the Google search and any internet search engine. The moment you search that I'm looking for a 2-bedroom apartment in Mumbai, Mulund, the developer seeking in Mulund information from Google automatically gets the qualified leads in their system. And the moment their system, which is again tech-based, links to the CRM platform, and a call is ignited to the broker or the sales manager of the developer, and that person is able to speak and talk about the person's desire for a 2-bedroom BHK within the budget of 1 crore in Mulund, your probability of conversion of sale goes up. Imagine you are typing 2 BHK in the Google. You not even sip a cup of tea, okay? And a call comes to you that I understand, Sapna, that you're looking for 2 BHK. Your mind is already hunting for home. It's warm and it's vulnerable to a decision. And immediately that person capitalizes on your state of mind of impulsive decision. And you say, okay, it's Saturday. I am available between 2 and 3. Can I come and see that apartment? And the guy arranges for you, services you, and it wows you, and he converts a 1 crore sale in less than 30 seconds of you typing 2 BHK Mulund on your search engine. Now, that is the power of technology that we are talking about. Now, if a developer doesn't have it, and they generate database from some other source about you, that developer would be way back in the queue, because you would have received calls from 5 or 6 developers already, and somebody calling you, you may actually get irritated that how many calls can I really entertain, right? And you may disconnect. The developer has lost the opportunity. So it's an imperative, Satna, in my opinion. And like I said, some of the things you don't need to invest in. So AutoCAD designs and all being outsourced for decades now. Architects and design studios invest in those equipments. So I don't need to invest in it. I can simply outsource and get the best technical, high definition drawings and AutoCADs for my business. Like that, you can move on. For example, I'm using practically every stage of business. Tata Housing is using technology. So even my compliance, my company secretary compliance, my RERA compliance, my project compliance, some compliance, by the way, are required today. Sapna, if I need to get environment permission today, I need to activate environment permission today. But if I make some changes to my design and the development, when such designs get changed, I need to again go to the environment ministry for the approval. So I need to set a date in future. Likewise, I need an occupancy certificate of my building. I need to set the RERA date of possession to the customer. All these dates I can feed into the system, and the triggers will go to every individual in my company that, by the way, RERA date is approaching 6 months from now. Are you ready? This is system talking to and communicating with you. So you are basically ensuring there is no human intervention. You're actually ensuring even if there is a 0.1% probability factor of human error, you're eliminating that human error by making the prop tech communicate with you and to the people and ensuring that you actually deliver customer experience properly. Let's look at the virtual experience. During pandemic, none of us could bring customers to our sites. It's a very physical decision and you are vulnerable to pandemic. So obviously a virtual augmented reality to the customer of an apartment that he or she wants to buy enables an informed decision to you, Sapna. So all these things are actually extremely helpful. In my opinion, I would give weightage to all of these factors. So I know you can prioritize it, but if you prioritize and miss on any of these prop tech, you are that much vulnerable of not being relevant in the real estate development business, in my opinion. I mean, imagine you booking a hotel by physically going to the hotel. Can you ever imagine that? Imagine you going to a travel agency to book your travel ticket. Uh, Impossible. You can't even think of doing that. You will actually book online, whether it's the airline, whether it's the hotel. I think the real estate development industry has already reached that stage, in my opinion.
Okay, fantastic. So one question, like everyone is saying, pandemic has accelerated the adoption of technology. Overall, not only PropTech, but overall, what have been your learnings in past 15, 16 years? 15, 16 months of pandemic?
In Tata Housing and Tata Realty and Infrastructure Limited, very much like the Tata Group companies, we give lot of weightage to people. And I've said that before in many such forums. We do not differentiate between customer, between vendor, between our colleagues and employees in the organization. We think we need to keep our focus on the humane side of the business. And we have ensured that during pandemic, whatever insecurities and concerns, that let's address the issue at home. If you and me are not happy, how would you build a happy home for the customer, right? To begin with. So we ensured we pay up the bonuses, we do the appraisals, we reward and recognize our people so they are motivated. Then we needed to make sure that we provide counseling during this pandemic, emotional counseling, treatment, that we need to make sure that we provide them insurance cover, not just them, but their family members, whatever medical expenses, which they had not factored in their insurance policies earlier. And even we as an organization had not factored pandemic. We went ahead and secured that, Sapna, first. So once we, and then we had doctors online repeatedly at different intervals to basically coach them, guide them, because it wasn't new. Nobody knew the pandemic. Nobody knew this virus. There were all kinds of myths and beliefs and misleading information. So we needed to kind of sort that out and make sure that we provide correct information to people about it and what preventive measures they can take. Then a very interesting thing we did, Sapna, prior to the pandemic, we created a platform, a tech platform, where the entire organization can communicate with each other. It's like the equivalent of Facebook, but secure and only limited to the organization. So, somebody's daughter has painted a beautiful picture and he wants to share with his colleagues. He's doing it, he or she is doing it on the Facebook, but some of the colleagues are not on the Facebook page. Some of the colleagues have joined during the pandemic. Nobody even knows that they have joined the organization. So that platform, a social network, a private network that we created, we were able to create a sense of belonging and community without coming to office. And that was extremely heartening. And a lot of emotional concerns were addressed through that tech platform. Now, we actually implemented that to the people when it came to vendors, like employees of contractors and housekeeping companies, construction workers, etc. Same approach. They are, after all, people. The same thing was extended to the customers, Sapna. So I think that one takeaway for me during the pandemic is that you need to remove the labels of customers and contractors and workers and construction workers and put only one label, and that's they are people. And as an organization and as a professional, we need to go all out to make sure that their well-being is taken care of.
That's fantastic. In fact, for everyone, I think pandemic has been a period of self-realization and, internally looking. And as you gave an example, how technology, in fact, became an enabler for human experience. So that was, before we let you go, one last, we would like to get your views on what is your outlook for 2021 and beyond.
I believe very much like 2020, when we saw the second half bounce back, and we were, as an organization, were able to do 121% of our business plan and our target. I have same belief that despite a very disruptive and damaging wave 2, we will bounce back. We are better prepared. Already people are talking that while loss of life and disruption to life has been very severe in second wave, the loss to business has not been. In fact, how people are reacting when you look at stock markets, when you look at commodities like gold, silver, currency. Who would have thought that during pandemic, certain corporates will raise billions of dollars from foreign investors? Who would have thought $4 billion of capital will go in commercial real estate property? Who would have thought the third REIT will also happen during pandemic? Who would have thought that the biggest startups will list their listings on the Bombay Stock Exchange and National Stock Exchange during pandemic, right? And they are one of the biggest startups of the country. Is a great case study. So I believe there is a very clear, evident pattern that we have come to terms with this new normal. The new normal is disruptive, but I think the resilience of mankind, the human, and our ability to cope with it has abundantly demonstrated that we will come out stronger. Already you have case studies of how certain people during pandemic have done even better, right? So while there is no escape from certain setbacks and loss of life, but the businesses overall have only learned. And then the acceleration of the prop tech in the real estate industry wouldn't have happened at a pace that it did. And therefore, when we come out, which I'm assuming in about a year time or two from this pandemic overall, you will have a much stronger, resilient business. And mind you, the government, which may not have paid attention to real estate sector in the past, even they are listening because disruption causes everybody to sit up and take notice. And I think that has helped overall all of us.
Yes, one silver lining, real estate has come in limelight. And, as you mentioned, yes, resiliency of Indian businesses. And as our other speakers also mentioned, that the fundamentals are strong of Indian economy, Indian real estate. So it's just a matter of time and we'll be back to where we were and we have a bright future ahead. So thank you so much, Mr. Dutt, sharing your views, sharing your positive sentiments with our audience today. And thank you for being here with us.
Thank you so much.
Thank you, sir. So on that very positive note from Mr. Sanjay Dutt, let's move on to an equally interesting session of the day. To present the next masterclass, I welcome our eminent speaker, Mr. Vinod Rohira, CEO, Mindspace Business Parks REIT, to share his outlook on REITs in India, present and the future. Like our last speaker just mentioned, that who would have thought that a third REIT would be launched in the pandemic. So let's hear it from our next speaker. But before we go on to Mr. Vinod Rohira, let me give a brief introduction of our speaker. Mr. Rohira is a veteran in the real estate industry, and he has been instrumental in leading the development of premium commercial real estate for the company across India. Under his aegis, the company has pioneered the concepts of landmark business districts, premium residential and retail complexes, and he has established brand Mindspace, self-contained world-class business districts across India, uber luxury residential projects, including Vivaria and Artesia in South Mumbai. He has been an integral part of the organization's foray into retail development and in shaping one of the prominent retail destinations in orbit malls. So, Mr. Rohira, over to you now.
Thank you very much for inviting me to do this. I hope I can make it useful for you on a Saturday afternoon. REITs as a subject really emerges only from the fact that you have to build on a particular market dynamic, on the base of a market, as well as create a mature environment of compliance and a very strong governance framework to actually build and establish on a REIT. So what's really important for all of us to understand is a little bit of the history behind where India has been in the last couple of decades and how is the REIT come into play is the culmination of that, and it's just a beginning in my view. So let me just give you a heads up. Commercial real estate in India was predominantly driven by CBD demand 2.5 decades ago. So traditionally you would see the Mahatma Gandhi Road, which was MG Road, become the CBD street for most of the big cities. So you had MG Road Bangalore, you would have MG Road Chennai. All of these places had commercial buildings that were built and they were sold to strata title owners who wanted to buy smaller offices and build on their domestic businesses. There was no real large global companies who were looking at commercial real estate, leave alone buy commercial real estate. 95% of commercial real estate was sold. And then you came in with the technology need that India started to slowly cater to, which was really at the low end of the services market, which was call centers and low-end services. This was 25 years ago. At that point in time, slowly Indian technology companies and some of the larger global service providers of BPO, etc., and call centers started looking at India. That's the time when these companies actually shifted gear to say, we want to lease commercial real estate and we don't want to buy. And today, the way you see it is more than 500 million square feet of commercial real estate, which is grade A, is built across primarily 6 main markets. Between 85 and 90% of that is occupied by global companies. And 90% of that is really catering to the global technology services industry. All of these companies have leased the commercial real estate. So if I was to speak just of commercial real estate, in just a short span of 20 to 25 years, this is the staggering volume of commercial real estate that India has been able to deliver, primarily in Bombay, Pune, Hyderabad, Bangalore, Chennai, and NCR, taking away 90% of that contribution of supply. Another statistic you must know, that almost 300 million out of that is already institutionalized. When I say institutionalized, it's already acquired or owned by large institutional players or funds who have occupied and owned and are managing these assets. Globally, just to give you a heads up, REITs started getting listed in America way back in the early 60s. And you have more than 1.5 or 1.6 odd trillion dollars worth of REITs that are listed. And these REITs are not just commercial real estate, they're every kind of organized real estate, whether it is hotels, offices, residential, hospitals, schools, student housing, jails, etc., etc. So when you start looking at all of that and you say we have just 3 REITs listed in India, we must try and understand what it really means for us in India. Well, a REIT really is a real estate investment trust. From the title of it, you must get to realize that it is a trust that looks after the interests of the fragmented shareholding in order to participate in the large pool of organized commercial real estate space. Because otherwise, traditionally, real estate can be an illiquid asset if you individually want to buy it. And your appetite will be driven by the capacity or the ability to purchase. And you may not be able to participate in the grade A office market space because the price, the value, and the units, etc., will be far larger than average investors would like to participate in, with the fear of being illiquid in the short term, not being able to manage leasing or exit the asset quickly. So what a REIT does primarily, it cumulatively forms an asset management trust where all of these prime assets that are predominantly leased to top companies, these asset managers manage these assets and distribute the rent that they earn as yield to shareholders, unit holders in this case. And over and above that, they participate in growth, and growth can be of 3 parts. One is the normal escalation of rent that takes place every year and every 3 years with leases, which are between 9 and 15 years of contracts with these top companies. 2 is the growth of new assets that you energize into the REIT, either by self-development potential that's there in the REIT or by acquiring other assets and infusing them in the REIT. And 3 is every 10 years, you see a major jump in the rental cycle, because we must remember that India is a developing economy, will continue to be a developing economy. And all of these large gated communities, an image of that you can see in my background, are actually oases of ecosystems that we have to create, which actually look after a very high level of infrastructure and environment for the workplace that these clients are looking for. Mind you, in India, you don't get this kind of infrastructure everywhere. We are all aware of the struggle we have with water supply, with drainage systems, with electricity in most parts of India. But when you enter any of these parks, you are expected to provide all of those and more as the base starting point to ensure that these global companies can perform seamlessly for their global clients. And which is why these assets are far more resilient and far more robust in their infrastructure and their play in terms of their offerings. What has also happened is, as India progressed scientifically upwards by upping their game in terms of providing for technology services, no longer are those days where someone in New York ordered for a McDonald's burger and the call rang somewhere in Bombay or Pune servicing him for that burger delivery. India is actually at the forefront of cutting edge technology support services. And with digitization taking place at such a fast pace, India has actually been able to be at the forefront of that. And that is what India will continue to see far more amount of growth and resilience in that sector, purely because we have a massive intellectual capital pool of young graduates and students and workforce that has actually got groomed by these top companies. If you go back 10 to 12 years in the economic crisis, you see what happened globally. Companies melted down, and you thought that the global economic world, the way we saw it, would completely crash and wipe out. In fact, a few years from there, we saw the highest growth that commercial real estate actually saw in the form of large technology companies, no longer doing third-party outsourcing, actually wanting to put their own flags into India as GCCs and GICs, setting up their own centers in India to cater to a very, very, very sophisticated workforce with a far greater intellectual capital, expertise, and groom and training to build them as their global workforce. And if you saw SEZs, which came up at that point in time, in the 10 years, SEZs alone employed more than 18 lakh technology graduates to come and work in those parks. So you can imagine the scale at which these companies have grown. And exactly the reason why we are seeing even now, while all of us are working from home and trying to figure out the footprint and the amount of workforce that will come back to the office, etc., when we are watching it globally, you will actually see, if you start watching their revenues and you start watching their employment numbers, you will realize that they have seen crazy amounts of growth in the last 12 to 18 months. And that growth has got translated with huge numbers in terms of revenue and employment. And we know that these companies are working on three primary principles. One is a massive amount of protection towards data security. The other is doing cutting edge technology, front end work. You need to engage with the best talent and you need to provide them with the best infrastructure. And thirdly, your customer who's sitting in any corner of the world is far more anxious today and is waiting for the best level of supply that you can provide of services and infrastructure. When you start looking at all of that, you have to cater to a far different offering of the workplace. You must remember that 80% of the workforce in India is millennial in the technology footprint. And when you have the millennials come to work, they want a very different experience. They want excitement at the workplace. They want great open spaces. They want recreation spaces. They want all the fancy restaurants, food, the recreation, the sports, etc., etc. So these are more like large college campuses and great infrastructure campuses, not just office spaces. And when you combine all of these things together and you see all of the other employees who are actually migrating from tier 2 and tier 3 cities to make a life and enjoy the social infrastructure in these big cities, you realize that it's a matter of time that they will all get back to the workplace. Coming back to the REIT, we were the second REIT to get listed in India. And then we had Brookfield post that. I think we're still taking infancy steps in India on the REIT. And you will see many, many more REITs to come. The fundamental of a REIT really is three things. One is you have to be extremely compliant and extremely focused on your governance and compliance mechanism. Number two, you have to take care of your debt very, very carefully, because mind you, 95% plus of what you earn as net operating income, you distribute as dividend. And when you're distributing it as dividend, you have no free cash flow left. So you have to be very careful about the level of debt you take, which can give you opportunity to grow. And when you can earn and manage and build assets like these, you will see the growth, because you have seen supply shrink out dramatically now because nobody is building speculative supply anymore. With that, when you have grade A supply and you're managing your assets far more efficiently, the top customers will first come to you because they don't want to take a risk, especially in a COVID and a post-COVID world, where you want a lot of focus on governance, compliance, health and safety protocols, energizing the workplace, etc. So when you look at organized asset managers and you look at portfolios like ours or many others who are handling 20 and 30 and 40 million square feet and making sure they take care of that universe of top customers in the technology footprint, looking after their needs and engaging with their employees and making sure the workplaces are far more exciting than they ever imagined, you have a winner when it comes to listing of the REIT. So all of us as investors can now participate in the fractional ownership. We can now buy units and sell units. We can partake of the growth. At the same time, being a REIT, you have a unique advantage that if you're distributing your yield in the form of dividend, that entire dividend is tax-free in the hands of the unit holder. So what that does is, on an average, if we distributed 7% yield last year, in the worst year in many, many years that we may have all seen, we distributed a 7% yield. 93% of that was in the form of dividend. So 93% of what you earned as yield was completely tax-free. Now, these are game-changing things which are coming forward for investors who are looking at REITs as an investment class, where they are far more mature investors who want to partake in commercial real estate and real estate as a play, who want a yield and want growth. So that's really where a REIT is a perfect opportunity for investment. And that's what you will see more and more take place when you get resilient owners of commercial real estate who have a track record, governance track record, a very balanced debt book, and are able to distribute a large chunk of their revenues as tax-free dividend to their investors. You will see a huge amount of investor potential attention into the REIT. And we have seen that when we listed our REIT in August, a lot of people would have wondered why did they choose that timing and why would they want to go into a REIT at this point in time, and what was really the dynamic behind it. Well, there were three fundamentals again. One was that we had the best footprint of clients. We were able to collect upwards of 99% of rents, even in the worst phase, where physically the occupancy was less than 10%. And thirdly, global investors realized and knew that India is going to have a very different footprint of commercial real estate demand, and the profile of companies are actually catering to the globe. And when you're catering to the global markets, at that point in time, you're completely aware that these are customers who are going to continue to want to be within these spaces and grow. And we saw more than 15 times oversubscription. The heartening thing that we also saw was that there was a massive interest in the private high net worth individuals from domestic markets who were very excited to participate in the REIT, which we didn't see in the first REIT. We clearly saw it in the second and the third REIT, which is a very, very positive move going forward, because we are seeing an opportunity where the domestic investors getting excited about the instrument of REITs. With this, I'll come to a close and I'll open it up to question and answers. And please, in case I've missed out on anything that you specifically want us to cover, more than happy to take care of that.
Mr. Rohera, one question that has come to us again and again is, there is a new investment opportunity, which is fractional investments. And then there is REITs. So what is the difference between the two?
See, strata title ownership in commercial real estate is what you only had as an opportunity earlier. So you went and you, for example, if you had 50 lakhs or 1 crore or 5 crores or 10 crores, you accordingly chose to buy a fractional ownership of an asset, which was say 5,000 square feet in a building or 10,000 square feet in a building or a floor in a building, etc. What that does is 3-4 things are going on. You buy the asset thinking that you bought it and it's leased and the client's going to be there forever and he's going to keep paying rent and the asset is going to keep juicing out. What we forget very clearly is that the asset's aging, the profile of your customer is changing, the demographics around your real estate are changing, infrastructure is constantly changing. So you may be in an obsolete location 10 years from today if you've not got in the right side of infrastructure. So take a classic case of Nariman Point for Mumbai. It was the best place for CBD. It was fractional ownership, strata title offices. Today you see it primarily isolated and far cheaper in terms of rental than many other new localities that have got built because of the push of infrastructure and the profile of infrastructure and the quality of assets that have got built. So when you are a fractional owner, if a tenant walks away, you are in no control of upgrading the asset. You are in no control of what your customer is looking for, really, and he has changed and he has evolved. Simple things like health and safety protocols. Now, if you have 20 owners or 40 owners in a building, to get eye to eye, sit down together and say, okay, let's upgrade the building, let's upgrade the facade, let's upgrade the lobbies, let's create touchless elevators, let's create sanitization protocols. You just can't do it. The client walks away by the time you evolve. Now change that to a REIT investment. We as asset managers are looking after all of that because we're completely engaged with the customer. We own the asset. We are not dependent on approvals from anyone else to do what we feel is right for the asset. And that is what enhances value. And in this case, you can liquidify your asset overnight by exiting out from the stock exchanges while you still participated in the growth. So that's the real fundamental difference. And there are many more reasons. It's not that all strata real estate is bad. Yeah.
Is fractional investment regulated by certain agencies like REITs are by SEBI?
No, it's not. It's not. Very pertinent question that you raised. And the dividend that you earn also is not tax efficient. Mind you, if you bought it in an SPV, then you can't even distribute dividend because you'll pay 2 layers of massive amounts of tax. Your individual, you'll pay the individual levels of tax. So you're not able to control the quality of asset. You're not able to control your tenant. And at the same time, it's not tax efficient. and it's aging as an asset, and you're not able to individually upgrade your assets. So there are a lot of drawbacks in that, which is why REITs actually globally have been really successful. And that's exactly what you will see in India going forward.
Okay, fantastic. Another question that comes to us is, do you think there is adequate opportunity for REITs in other asset classes? Because till now we have seen only in commercial. What about industrial, warehousing, retail? Are we going to see REITs there anytime soon?
You will certainly see REITs in all of these classes. Of course, it's a matter of, see, that a REIT is a combination of two things. One is distributable dividend, and the other is the cumulative total return. So it starts with the distributable dividend. And for that, you must have adequate yields that can attract customers. Otherwise, you may not get the right value, which may not encourage you to go and list it. So it has to be a win-win for both parties. And as you reach that threshold in the marketplace, you'll certainly see more REITs in all of these aspects coming in.
Okay. Another one point one of our speakers earlier had raised was that, for REIT, the challenge could be the quality and execution of projects, which could lead to stocks later on, or something, challenging. What's your view on that?
In fact, there is minimal risk in a REIT, because as part of the legislative environment of the REIT, you must remember 80% have to be rent earning and completed assets within the REIT. You only have a 20% development play permitted, which means your risk is greatly marginalized. So you do not carry speculative risk at all that the project may not come, it will not get built, and it will get delayed, etc. Having said that, if I have to distribute between 90 and 100% of what I have as free cash flow, I don't have room for speculation and misplaying the marketplace. Let's assume I was not going to distribute the dividend. Then I could use the money and say, okay, let me buy land in Timbuktu, and then I'm going to build a building 2 years later. And if that mistake pans out badly for the REIT, then the investor suffers. In this case, the cash flow has to be distributed. So I have to be only debt efficient to ensure that I can buy a new asset without disturbing the distributable yield, or raise more equity. When I have to raise more equity, means I have to go back to the marketplace again and again. If I have to go back to the marketplace again and again, I will ensure that I'm making sure my investors are happy with me and I've delivered to promise. Otherwise, I'll never be able to raise equity again. So all of these kind of ring fence the safety of the investor in a REIT portfolio.
And what has been your experience in past 15, 16 months? Has pandemic been a challenge for investors while they were considering investing in real estate? Although we have seen, high level of PE investments, etc. But has it been a challenging environment for investors?
So investors are always vary, because obviously you have different categories of investors. So the large global institutional investors have a certain mindset around what they see will pan out. And you're seeing different things pan out across the world. And you're seeing in the Americas, etc., everyone's getting back to the workplace. And you will see with aggressive vaccinations in India, all of that will start to happen maybe a couple of quarters from today. But obviously the smaller investors or the fragmented investors are still wary of what's going on. They don't have adequate information or knowledge. And more of that knowledge database that's spreading into the marketplace is helping investors take an informed choice. And which is why you're seeing more and more interest now gaining towards the REITs. So I think once we've cleared a little bit of this fog, which is probably in the next few quarters, there will be a very different rhetoric on REITs in India.
Okay, so fantastic. Last question, what is your outlook for REITs? Because the situation is so fluid, so let's not go too far beyond, but maybe next year or two, how do you see for the REITs in India?
So we see a phenomenal opportunity for organized players. We see a huge amount of overhang of supply just evaporating. We've seen cost of capital come down, and we've seen our customers' revenue spiking up and employment numbers going up. When you add up all of these things, real estate consumption is not far away. Grade A real estate will have a lion's share of demand coming back to them. And when that happens, you will see a very limited supply of grade A in the marketplace compared to the macro supply. Customers will not go to grade B and grade C supply. So you will see a mismatch of rental numbers between grade A and other graded assets. And you will see a lot more activity the minute you've seen aggressive vaccinations in urban India, where the workforce is predominantly vaccinated. So we stand really bullish going forward, because we know technology companies are growing and their footprint is going to grow in India. We have to just wait and be prepared and get ready with the upgrades and with the parks that will attract these new talent to come into the workplace.
Okay, fantastic. So it's just a matter of time where, once we get back to our, normal or new normal, as everyone is saying, I think we will be back on track. So thank you so much. I think it was a very informative session, answered a lot of queries from our audience and viewers that we received. And thank you, Mr. Vinod Rohira, for being here, sharing your time, sharing your views on that, and giving us a brief on what we can expect in this new asset class of REITs. Thank you so much.
Thank you.
Thank you, Mr. Vinod Rohira. So friends, from that one informative session, let's go on to another informative session, which is, again, we are talking about commercial realty investing, fundraising and deal restructuring. So REIT was just one part of commercial realty. Let's, now elaborate on that. And we have a very phenomenal set of speakers talking about it. Let me introduce our panel members. Our moderator of the session is Mr. Neeraj Bansal, partner and CEO, India Global, KPMG in India. Our panel members, let me introduce Ambar Maheshwari, CEO, India Bulls Asset Management Company Limited. Ambar looks after the private equity business with focus on real estate. He's a chartered accountant with more than 20 years of experience in the sector. Our next eminent speaker is Arshdeep Singh Sethi, Managing Director, Executive Board, RMC Corp. Arshdeep plays a pivotal role in defining, shaping, and implementing the strategic vision of the organization. And with 25 years of extensive experience, he currently spearheads the mergers and acquisitions and has been the driving force for all joint ventures and strategic alliance of RMZ Corp. Our next panel member, I introduce Khairul-Nisa Sheikh, Executive Director, WTC Services, Board Member of WTCA. Khairul-Nisa is an Executive Director of WTC Services for 13 World Trade Centers in India. She is also Joint President, Customer Engagement and Distribution, and heads Tenant Services and Operations, owned and operated by Viridian Red. Here engages business leaders, government, professionals from around the world to promote India for business, trade, and investment. Our next eminent speaker is Mr. Vinamra Srivastava, CEO, Business Parks India, Capital Land, and Vinamra oversees investments, development, operations, asset management, and strategic planning for Capital Land Group, Business Parks in India, and he leads the expansion and enhancement of the group's portfolio of assets in the country. Our next and final panel member, let me introduce Mr. Yash Gupta, founder and managing partner, YGR. Yash has global work experience across Asia, US, and Europe, and before founding YG Real Estate and Blue Sky Ventures, he established and led Hines as its country head. He is South Asia Chair, YPO Real Estate Network, and member RE committees of FICCI and CII. So this is our eminent panel, which will be discussing the topic of commercial realty. Mr. Neeraj Bansal, I hand it over to you now.
Thank you, Sapna. Good afternoon, everyone. A warm welcome to all our viewers and my distinguished fellow panelists. It's a pleasure to be here with you today this afternoon. And I must thank everyone for choosing to spend this Saturday afternoon with us. Also, I would thank the organizers Realty Plus and BW BusinessWorld for organizing this Global Real Estate Investment Summit. Dr. Batra, Sapna and team have done a fabulous job in bringing together the important stakeholders of the industry. In the current session, we have an outstanding panel, as has been already illustrated and explained as well, of industry veterans and experts to share their experiences and advice with all of us on commercial realty investing. Let me take quick 2-3 minutes to set out the context for our discussion. We all know commercial realty as a whole, and more specifically, commercial offices and warehouses were booming as of March 2020, before the pandemic struck all of us. Commercial realty was a shining star of Indian realty industry, breaking earlier records of demand, leasing, and also supply year on year, and was witnessing highest participation by the international private equity and also sovereign wealth funds around it. Pandemic-induced lockdowns have meant that all touchpoint industries, whether it was malls, travel, hospitality, and non-essential goods category businesses, suffered. This forced both knee-jerk reactions of cut down on office spaces in retail stores and also planned recalibration of existing and new space requirements. Given the impact on business growth, reduced cash flows, pressure on margins, evolving acceptance of remote, hybrid working, and also a continuing uncertainty on permanent resolution of COVID-19, this is where we saw a lot of the occupiers thinking and rethinking their space requirements aspect of it. But despite these disruptions, the confidence of global investors is not shaken up. As you would see that foreign investors have pumped almost double, which is like $6 billion in FY21 compared to $3 billion in FY20. Q1 of 2021 witnessed like 19 private equity deals versus 21 deals that were done in the entire year of 2020. Also, there's been a substantial skew towards the platform deals versus project-specific deals, which was the norm in the earlier years, which certainly reflects the maturity and the depth of the market as well, and the understanding with the funds and the players have got, of the Indian industry there. If you look at the industry is also responding in terms of rapidly and effectively reconfiguring, redesigning intelligent and contactless workspaces. Also, the demand for such spaces is getting driven as well, by technology companies. There's a lot of demand by global captive centers and BPOs. In the earlier session, Vinod spoke about, how the global in-house centers or global captive centers are driving a lot more demand, as well. And also by the healthcare industry and numerous startups, they're also fueling the demand for commercial reality at the current point in time. And what's a consultant without more data points? So let me share quick data points from analysis of KPMG and also some of our industry friends. So net office leasing across 7 major cities is likely to remain flat or may grow slightly from 26 million square feet achieved in 2020, as corporates have not given up their expansion plan amid the second wave that we are dealing through right now. India's inventory of flexible office space is also expected to grow 10 to 15% annually over the next 3 years, at a time when pandemic leads more and more companies to adopt the hybrid workspace model. As per an estimate, almost 28% of old A-grade office buildings spread across Mumbai, Delhi, NCR, and Bangalore present an opportunity worth 5,500 crores plus if these are upgraded with modern amenities, designs, and building technology. We'll touch upon this as we speak in the panel. Also, commercial reality, if you look at from a warehousing perspective, the annual warehousing transactions in the top 18 Indian cities will more than double to 76 million square feet by March 2026 from the current footprint of 32 million square feet in 2021. Lastly, data center market is presenting a strong investment opportunity of more than $5 billion by 2025, with data centers in non-metro cities to play a fundamental role in its growth. With this quick context, let me go across to our guest speakers for today to get their views. Yash and Vinamra, if I may come to you first. Yash, starting with you. Given that pandemic has accelerated investments in built up and income generating assets, how do you see investments spanning across different commercial reality segments? And which sectors do you see the demand coming from, especially in the new reality?
Thank you, Neeraj, and thank you, Reality Plus, Sapna, and Dr. Batra for having me here. I'm humbled to both be in such an august panel and have so many dear friends on the panel with me. So I will reserve my comments because my friends probably will make much better ones. Starting with what you've said, Neeraj, I think the commercial real estate is often seen as one kind of category for everyone. But I do think there is a diversification or bifurcation that's happening in the industry, where people like Vinamra, people like Arshdeep, and to some extent Amber as well, are really going out and owning these very large established IT parks, 1 million plus kind of stock, creating some tremendous places, campuses, as Vinod talked about earlier. And that is really where a bulk of the grade A tenants go. But that's only 30% of the market as we've seen it in India. 70% of the market continues to be the market which is with MSMEs, which is less than 500,000 square foot assets, which are smaller assets, which are frankly not really sexy for the RMZs and for the capital lands of the world necessarily. And that's what we are focused on. A bit about the sexier part of commercial real estate. I'll talk about the unsexy part. The unsexy part is truly unsexy. It's been hit badly by the pandemic. The small and medium scale enterprises are hurting. They are a lot more value conscious, and therefore they kind of dial back much faster than a large tenant. And that's what we find exciting. What we find exciting is that there is more dislocation happening in that sector than there would be in the larger sector. And that dislocation allows us to do three things. One is acquire these assets at interesting values or locations that we don't think we would have seen pre-pandemic. Second, it gives us the opportunity to upgrade. And as you yourself said, that the office is being redesigned, office is being reimagined, both because of flexibility as well as health and social concerns, and upgradation of these assets. Often these developers don't have either the capability or the capital to upgrade them. And we focus a lot on upgrading that, and we think that's an interesting opportunity. And the last part of what we do is we're hoping that Vinamra and Arshdeep both will have their very large reach soon. So we want to consolidate some of these assets, make a portfolio which is large enough and interesting enough for people like them to say, listen, I'm glad that you guys have done the hard work. Now that it's a 3-5 million square feet portfolio, why don't we and it's stabilized, why don't we kind of take it off your hands? So in that part of office, it is not easy. You have to look at many assets before you find the right one to buy. But there is the opportunity have become better post-pandemic.
Thanks, Yash, for that. Vinamra, if I come to you, let's focus on the 30%, which Yash nicely put out, that is in the domain which you will be focusing on.
Yash is always very kind and generous, and I can tell him that it's most often the unsexy part that get to the most value. He knows that very well. So maybe he's smarter than all of us. I'm pretty sure of that. I think both segments have a role to play as the industry is maturing. Also, especially because, as Yash mentioned, that as the focus on grade A and grade A plus has become as important as it ever was in the past, what that is doing is helping the players to gain scale. And it's also pushing the grade Bs and grade B plus owners and operators of the world to really push the boundaries and ultimately look at a mechanism for exit. And it could be either a REIT or so on and so forth. So I think that what COVID has probably done is, with the focus on probably three things, I would say, especially for the institutional players, the 30% as Yash refers to, is one, pushing harder on sustainability. Second, ensuring that from a prop tech perspective, a lot of technology initiatives which were probably going slower or in terms of adaptation is now accelerated. And thirdly, the focus on health and well-being and safety. And all of that geared towards achieving two things for the parks. One, of course, is operational efficiencies, but second is also customer experience. So with the focus on all these aspects, I think for the institutional players, it's about taking that next leap and looking for the right investment opportunities. And a lot of them are presenting themselves in a post-pandemic scenario. Having said that, I must admit that the investment opportunities in commercial segment for the institutional players are in two areas, right? One is greenfield development and one is acquiring ready assets. And both continue to have challenges. And as Yash was mentioning, I would say you probably look at, 20, 30 deals before you even sign 2 term sheets, right? The challenge on the development part is, of course, the top micro markets in the top 6 cities are a given, right? That's not a rocket science. And every big institutional players worth their salt would want to get access to the right land. And somehow the pricing impact of the pandemic has been very selective, and for land parcels that are in prime locations haven't really seen that much of an impact. So there is an incredible challenge in that. And even on the ready assets, while there could be quite a few portfolios with discounted values, what you got to ensure as an incoming investor is you price in the necessary asset enhancement you will need to do, because especially they are going to be grade B, and then assign the right value for it. So I think with so much capital chasing the segment for obvious reasons and the right demand drivers, deploying capital is going to remain challenging. So I think while the market will remain very exciting, and I do see a lot of opportunities for further investment and consolidations for investors, but squeezing value is probably as challenging as it was before.
Sure. Thanks, Vinam, for that. And Arshdeep and Amber, if I come to you, So your first quick views on the segment that we spoke about, the A-grade office segment, and then and that currently focusing more on, let's say, Bangalore, Hyderabad, Mumbai, Delhi, Pune aspect of it. But if I just extend that to there's a lot more demand which is coming in, we understand, from tier 2, tier 3 cities as well, for flex office spaces and for the fact that people are wanting to work remotely as well. So if you could throw some light on Arshdeep, starting with you first on your views, on the main cities, as well as what role, in your opinion, let's say, would be from tier 2, tier 3 cities, in the medium term. Is it like a short-term phenomenon, or is it like a medium-term phenomenon, long-term phenomenon there?
Good afternoon, everyone. Thank you, Neeraj. Thank you, Realty Plus. Perhaps this is probably the right medium to now start to interact, but I'm missing catching up over coffee with Yash, and that used to be an often play. But I guess in our assessment, the segmentation for tier 1, tier 2, and I think we are biased to that. In our mind, the tier 1 is the only market which exists in an office, and that's trend we've seen it for last 15, 20 years. I remember we all jump into SEZs in tier 2 when the government was allotting SEZs in Mangalore and Mysore and so on and so forth. But I think in our assessment, the city limits are expanding. Be Bangalore, be Hyderabad, be Mumbai and NCR, or whichever city that you look at, there's so much phenomenal growth happening. So we don't look at only from a standpoint to tier 2 growth. The tier 1 cities are also growing phenomenally. And as much as we complain on infrastructure, but I think there is an effort being done by the government. So clearly, if you see, earlier used to be a micro market which is established. Today, I can clearly say in a Bangalore, there are at least 4 or 5 micro markets which exist, and everyone has a clear demographic in terms of what kind of rentals, what kind of products, and the client who would like to house in there. So clearly, in our mind, that the growth for the tier 1 city, which is currently been embedded, I think will continue to grow. I mean, I don't see any reason that this has a spillover effect to tier 2 city. I mean, in certain locations in a tier 1 city, which are probably, I would call it, just for a demonstration perspective, is like a C-grade location, which is not very high potential. And I could name, let's say, in a Bangalore, let's say Electronic City, I mean, we've seen it for last 20 years. The rentals haven't gone beyond 50 cents per square feet or maybe 60 cents per square feet. It hasn't gone, Versus if you look at a micro market, which is where Vinamra and all of us are there in which is a wide field, outer ring road, the rental growth has been phenomenal. I mean, I remember, I can clearly cite a case study. We actually acquired one project, which average rental was around 28, $30. Today, similar asset, much better quality is producing 130 rupees per square feet. So look at it's a fourfold growth in the rentals. And therefore, clearly, if rental increments are like this, investor would make money, we will make money, and then there's an entire recycling of capital to take place. And don't forget, having done and achieved that, there is still a large potential where likes of the large funds that you've seen have transacted buying today at an existing market rental, because they also feel that the mark-to-market rental still exists in those assets. So clearly, tier 1 city, we are completely biased to that, and I don't think so. We have, I personally, that's my view, and again, I respect other views on this side. But I think tier 1 is one which will have largest absorption of office. Tier 2, sure. I mean, there will be some market. I mean, in our context, I would probably rate, and again, not being biased to that, Kolkata as a tier 2 city. I mean, if you see, Kolkata actually had a head start during Buddha Dev time, but really nothing has really taken place, beside likes of TCS and, IBM and Wipro, which probably had an early advantage, not much client has really gone in there, you could attribute to a dissonance in the whole state politics, or you could, look at any attribution on that. But the growth in Bangalore, Hyderabad, Chennai, and now Mumbai has been added, because earlier Mumbai was always only a central BKC and Worli, and you don't go really beyond Navi Mumbai side, But now you see Navi Mumbai is phenomenally exploring, Look at NCR, be Gurgaon and bit of it Noida, which is obviously has a different segment of office. But I think these cities offer large potential for client to house in there, and have their expansion plan. And today, given this whole disruption, clients are not willing to take any strategy which is very disrupting and moving to a tier 2 city. When I'm in an office and in a tier 1, I can have a range of 40 rupees per square feet to 100 rupees per square feet. In a tier 2, if I can get a 35 rupees, it really doesn't make a sense to me. Because I have most employees house in tier 1 city, and people like to come into urban space.
Sure, Arshdeep. There, Amber, if I bring you in with your views on the commercial reality from an office space perspective, and also extending the point which Arshdeep mentioned. So there's clearly a skew that is towards the tier 1 city there. Your views on that?
Sure. Hi. Good afternoon, everybody. I think two things that we're seeing. If you look at the overall vacancy in the commercial real estate space, CBDs have been vacated far more than the secondary and tertiary business districts. And I think one of the key reasons for that is the arbitrage between the rental and the fit out space. A 12-month of vacancy in a CBD location like a BKC or a Lower Parel would be enough to amortize your fit outs entirely. And therefore, even if the tenant has fitted it out, they are very happy to move out of the CBD office space, even if it is for a short term. But they haven't done that in the secondary or tertiary spaces, because the amortization of that fit out space that you've taken will take longer than 24, 36 months, and therefore it doesn't make any difference whether you're vacating it now or later on, right? And if I take that logic to tier 2, tier 3 as well, I think just the fact that a secondary business district or a tertiary business district tenant is far more sticky because of lower rentals. And, while the last 12, 18 months, we've seen margins expand for the IT sector. But I think, going forward, that margin or the margin expansion that we've seen doesn't look sustainable. And I think, Infosys came out with these numbers this quarter, even TCS, the margins have sort of shrunk a little bit, right? And I think that's pretty much par for course. And most of these large IT tenants would look for cheaper and cheaper and cheaper, rentals. And therefore, tier 2, tier 3 will develop. The pace of that development, Arshdeep is right. Both the scale as well as the pace have been tremendously slow. I mean, for the last 15, 20 years, we've always been saying that tier 2, tier 3 will come about, and every little, sort of a speed breaker that we get in this growth, everybody starts talking about tier 2, tier 3 all over again. Right? But I believe that pace and that scale will be driven by the GDP growth rate, the growth rate in the economy. How quickly does the economy grow, and therefore investment in infrastructure, social infrastructure, and all of that, will really drive that pace of tier 2, tier 3. But tier 2, tier 3 is something which is unavoidable. Every other industry has done that. Real estate is just, a little late because there is, as Arshdeep says, there is a lot of scope in tier 1 cities as yet. But if you look at any consumer industry, everybody has gone to tier 2, tier 3, and the growth really is driven by there, by those. So whether it's telecom, whether it's, consumer, all of these have gone to tier 2, tier 3. There is no reason why real estate will not go to tier 2, tier 3 as well.
Sure. Thanks, Amber, for that. Khair, if I come to you, in case you want to comment on, this aspect of it, there's anything addition to that, surely do that. And I also have a question for you in terms of, that the fact that the office assets currently, like in the quarter 2 of 2021, so almost 40% investments from private equity had gone to the office assets only. How do you see the deals and investments shaping up in the future? Especially if you can get a little bit of a flavor of, the co-working, managed and flexible office spaces as well. And lastly, if you could layer it, and when I'll request you also to come after that, to layer it with, the opportunities that are there in India versus South Asia, there, because I think India is trying to attract a lot of investments in the manufacturing space, from different countries at the current time, and we are competing with some of the countries in South Asia as well. So from a real estate perspective, how do you see this panning out as well?
Thanks, Neeraj, for this opportunity, and thank you everyone at Business Reality and Mr. Batra. I agree partially what Mr. Arshdeep said, and also partially agree with Mr. Amber. But at the same time, I also differ from what they have said. See, at World Trade Center, considering that I am present in both Tier 1 and Tier 2 and Tier 3 cities, I've seen the dynamics at play for all these different cities, a different thing, when we are talking about real estate. We know for one that real estate in today's time, and especially in the current scenario, it is more organized. The economy is recovering. There's a recalibration of the office space. There's a resilience which we have seen in different asset classes, especially industrial and logistics. We're seeing retail, which is regaining. Alternate investments is becoming more relevant. There's a rebalance of capital markets, which is happening, and there's a revival of the residential. So as far as real estate is concerned, we are seeing that, yes, it is a very, very important sector which is contributing to the economy. At the same time, when we are talking about the commercial real estate, I believe it is more contributing and has more investor confidence, largely because of the yield in investment that it offers, the kind of security that it offers. And yes, definitely, there is a difference in grade A and grade B buildings, and irrespective of what markets we are in. We are assuming that Tier 1 cities would have more of grade A, and Tier 2 cities would have less of grade A buildings. But I believe in today's time, the government policies, the government initiatives for each and every state is actually driving the real estate aspect in the respective cities. I'll give you an example that we have World Trade Center Gift City. It is 1.5 million square feet as on date, but with expected 6 million square feet in times to come. And with the government policy wherein for the financial brokers, the stamp duty would be reduced or would not be charged for any transaction which is done from the registered office of Gujarat or from Gift City. We did see a lot of influx of companies from Mumbai coming to Gift City, especially World Trade Center Gift City. So that did increase the demand for real estate in Gujarat. Fortunately, we did have a grade A building to offer in Gujarat. Similarly, when I look at Uttar Pradesh and when I look at Noida especially, or Greater Noida especially, we have World Trade Center Noida, which is 4.2 million square feet as on date, and is a part of a MOX, which is the industrial initiative, which is going to be contributing to the electronic system design manufacturing, especially mobile industry, with 5,000 acres allocated by the government. We saw a huge influx of mobile companies coming and setting up their assembly and related industries in and around Greater Noida. So it was driven by the policy. It was also driven by the infrastructure that the city had to offer. The third was the real estate aspect, that where would these companies get housed, and the services that a particular developer would be able to offer. So all of these put together actually created a great combination for the real estate or for the World Trade Center to actually transform the city in the respective cities. I'm just naming 2 cities, but I've got many examples in other cities like Chandigarh and other places. Similarly goes for the World Trade Center Bangalore, if I talk about the World Trade Center fraternity. But largely we have seen that these were being driven by these 3 elements. So I think your second question was, Neeraj, could you...
Second question was regarding the investment trends which are shaping up, with respect to co-working, managed and flexible office spaces, and the fact that that there are some opportunities that are come. I mean, like as an investment for private equity or foreign funds, there are investment opportunities in India and also in the South Asia aspect of it. So how do we compare, with that?
See, there are many parts to your question. So let me first answer, like when we are talking about the commercial real estate, there are various assets that we are talking about. And these various assets have different yields, which they are offering. If you're looking at office, we're looking at a yield being offered anything between 6 to 8%. And when we are looking at flexible offices, we've even seen, pre-COVID times, we did see that the yield that this asset class was offering up to 12%. And now when we're looking at data centers, we're looking at a yield going up to 14%. So accordingly, depending upon the, where the, so we've seen investors accordingly, invest in these classes as compared to the residential, because where the yield has been ranging from 1 to 3%. So commercial real estate and private equity and venture capitalists, we do see in largely see in, we've seen in office space, we've seen in flexible office spaces, and we do see them in data centers and warehousing as well. I mean, largely now we're seeing a lot of interest of investors and global funds in data centers and warehousing, along with the office spaces. And with REIT and a lot of policies, especially the policies of REIT, the Benami Prohibition Act, that is also adding, towards the investment towards commercial real estate. And when I look at the industrial parks, see, we have to understand that when it comes to manufacturing, and we have World Trade Center Noida, which is a combination of an industrial park office, it's like a township. And now with World Trade Center Faridabad also, which is somewhere around 350 acres and in collaboration with the HSIIDC. So we are seeing a combination of industrial, we're seeing a combination of office spaces and multiple commercial assets there. With the economy, with the vaccination, especially with mobility now going to be coming up, we see that two important economies, India and China, which are going to really, really lead the way. And in India, we see that post-COVID, that India would remain a very preferred global outsourcing destination, largely because we have a low-cost knowledge talent, and we have a systematic growth of the, the global capability centers. We have the startups, we have a very robust MSME sector, which these global companies are actually looking at. So I see a lot of, and it's also with the incentive schemes and the government policies, I see a huge outflow or inflow rather of these companies from Southeast Asia especially. And the reason why I'm saying Southeast Asia, because the ESDM, and we, of the $5 trillion economy, 1 trillion is actually from the electronic system design management industry. So IT is already there. We've got a very, very strong IT industry already existing. We are actually building upon a very strong electronic system design manufacturing. We have an economy, or we have a consumption of very large domestic consumption of mobile or electronic white goods. So those companies are actually investing here, plus the government policy of the PLI scheme. So these are all adding to the factor that there is going to be an inflow of these companies into India.
Sure. So, Vinam, if I come to you, and I'll kind of move to investment trends, there. So, if you look at the net office absorption in the second quarter of 2021, has fallen to 16% quarter on quarter, and also the vacancy levels amongst the top 7 markets, has increased to nearly 16%, which is breaching the comfort zone of 13 to 14%, as it understood for the first time since 2017. So when you look at the remainder of the year, how do you see this impact on deals and investments?
I think, Neeraj, when we look at vacancy levels and absorption levels, it is unfair to generalize and talk about the city as a whole. Because really, as Arpit was mentioning earlier as well, the city is really made up of the micro markets, and within the micro markets is a type of properties. So if you cull out the top, let's say, 3 micro markets in each of the top 6 cities in India, And within that, also, if you look at all the grade A spaces, the numbers will be very, very different. And I'm quite sure it will be in low single digits. At least that's what we are seeing in all the capital land parks, and I'm sure with few of the other investors parks as well. So we must be very careful when we are looking at vacancy levels and broad brushing at a city level. I think that data is a bit meaningless because it's really down to which macro markets we are talking about. To the question of what's going to happen over the next 2 quarters, the trend that we are seeing, and after a lot of conversations with some of our largest customers as well, is that with the vaccination now really entering a stage where, let's say in the next 2 months or so, the second doses should be completed for a majority of the population. The impact post the second wave is a very different story than when we were up to post first wave, which was, let's say, October, November, December last year, right? And what that is resulting in is a lot of conversations already about starting to return to office September, October onwards, and depending on the companies stretching out to the Q1 of next year. What we are seeing really is also conversations starting to happen a lot on new RFPs and new leases. If I just see the number of site visits and the number of RFP responses in the last 3 to 4 weeks has been much more than what we had seen in the last 3 months or so. And we are also not really seeing any relinquishing of space in any significant quantities from any of the existing customers at this stage. Whatever rationalization had to be done probably happened to a certain extent over the last year or so. So I would say I don't know where the net absorption numbers would really land, but I honestly don't think most of the large owners of parks are really too keenly watching that number, because they really know pretty much the next 6 months, their lease profiles, their expiry profiles, which customer is going to stay and which is not. The question really be about how is the slope of the pickup curve early next year. And I think if hopefully COVID remains fairly under control, even if there is a third wave, but the amount of medical tragedies are not so much because of vaccination, then I think the pickup early next year will be very strong. And that's really what most of the investors, I guess, will be focusing on, because this year, half of it is gone. The second half of the year, maybe, slightly more than double of what we, slightly similar to what we saw in the first 6 months or maybe even more. But the real focus will be the recovery next year. And for all the reasons mentioned by some of my other panelists earlier, we are quite bullish. And Vinod was mentioning in the earlier session as well on the drivers of why this pickup will be very, very strong. So I guess that's where we all are really looking forward to now.
Sure. And Ashdeep Bambar, if I may request you as well, for your views on the investment trend that you see in the next 6 to 18 months, if we just increase that by another 12 months as well. So how do you see the investment and trends in terms of the deal side of it in the office space? Ashdeep, starting with you.
Yeah, thank you, Neeraj. And I think I agree with Vinod on the client side and the vacancy and occupancy, because if you look at the data driven, which is given by IPC, and those are not wrong, but I think one has to really validate on a ground how much is under planning in terms of development and how much is established and who all have a financial closure. Having said that, come back to your question. I think if I call, today conversations are all about curves, So I think this is like a surge shaped curve that I see it, where the demand really is going to come very vehemently. And that's where Vinamr also mentioned that the kind of RFP we've seen, the kind of deals that we've closed during pandemic, although it's slowed down, and it's fair to say it's slowed down, business have been obviously is pulled back. But I think there is nothing that the clients will say, look, because of this pandemic, I've shelved my plan for expansion, or I've reduced my plan. They probably have deferred because of inability to travel or have an effective communication, site visits were prohibited and so on and so forth. But no one actually has said that, look, we are shedding our plan and taking a U-turn back to any other part of the world. So clearly, the kind of RFP which is floating, is very high potential. And that's what I call a surge-based, a surge-shaped curve, which is really coming back. And we've seen in not in the office, but on the resi. Not the subject is today is on the resi side, but we've seen, it is a very large, sharp curve which has come back, and people really start to buy residential, and obviously office continues to remain an attractive position. Having said that, it's an old saying by Warren Buffett, buy when people are fearful, So, you've seen these likes of big giants of Brookfield, Blackstone, GIC, CPPIP. I mean, these are large $1 trillion, institution, and they're all buying, and I can assure you that they're not fools, they're probably the most intelligent people in this world on the real estate side, So when they buy, they obviously see, similar to us, that there is a significant growth which is embedded, The significant growth is in existence, but also it will have a triple effect in terms of how business really will fall in, Secondly, earlier we used to focus on BFSI and in IT and ITS, the new segment, which is the whole marketplace, e-commerce, the kind of space requirement these guys are looking at, it's just phenomenal. And I don't name the client, it's prevalent in the market, They have a 3 RP floating in cities, Bangalore, Hyderabad, and Mumbai, over 3 million square feet each, I mean, this is the size of a market, guys, and then we're talking a single client scouting for a 3 million square feet, So I think these are clearly indication that they have a full belief in the Indian economy, and as Khair as well mentioned that China, India, but I think I probably would score India a little bit more because we've seen how Alibaba and Didi has been impacted because of whatever reason in China. We're a little more friendly as a democratic country, and therefore, we love to have inbound investment. And we've seen there is a clear surge of North American institution cutting large $1 billion check, And, I have my all friends like Amber and Yash, they all hail from, including yourself, Neeraj, and Vinamra as well. We've seen 2-3 cycle, $50, $100 was like a wow, we've raised capital $100. Today, we're all talking $1 billion, $2 billion, and we don't have shame, and we really don't feel fumble, and when we talk $1 billion, and that clearly demonstrates that there is something right happening in our country. And I can assure you that there is no dearth of capital for a right partner, for a right location, right micro market. And I think now, given the experience which is on this panel and the other, as earlier mentioned, we clearly could identify which micro market to go, what kind of yield it can produce. There will be a variation, but the variation is 5-10%. We can't be dramatically wrong now on a location or on a real estate side. So I think having this kind of a maturity and a bit of a wisdom around, there is no dearth of a quality of a capital. There's huge capital which is dying to get deployed either directly or indirectly.
Great. With that positive note, Merry Christmas, Amber, your views as well on the investment trends in the office space?
Yeah, no, I very, very vocally agree with Arshdeep. I think he's pretty much summarized the whole thing. I think the investment community has sort of come to a conclusion that the slowdown in leasing that we are seeing in commercial office space is very temporary. It is a pandemic thing, and the moment that goes away, when people are out and about, people are going to go back to offices and going to start working from offices. We've seen the kind of demand, and the kind of growth that IT companies and some of the other sectors that Arshdeep was mentioning have seen already. So if you delink the temporary, sort of a speed bump that we've seen from a tenant occupation side, from the investment, if you delink the two, investment, typically institutional investment in real estate in any case is from a longer term horizon. People look at a much larger time frame and so forth, and all of this demand, will become a latent demand the moment the economy opens up. And the kind of growth that we're going to see is going to be pretty phenomenal. A sort of a knee-jerk reaction to the opening up. So I have no doubt in my mind that commercial real estate, not only from a demand perspective from investors, but at the same time demonstration of now successfully exiting some of these investments and people have made IRRs which are north of 20%. At a scale which, like again Arshdeep said, that $50, $100 we used to be really thrilled about 10-15 years ago. but now people have made that, a north of 20% IRR on billions of dollars. And I think that is proof of concept right there. So, it's quite well demonstrated that investment demand for commercial real estate is not going anywhere. It's just a matter of time. The moment things change a little bit, we'll see money coming in all over again.
Thanks, Amber. Yash, if I come to you, we just discussed around the office investment trend. I mean, there's another space which is kind of catching up a lot in terms of, the fact that the startup space, from a prop tech startups has really mushroomed and increased, the traction, whether it is in terms of construction-focused technologies or in terms of 3D printing and, various aspects which have come around that. So with these developments, that as an investment space, how do you look at that in terms of the real tech and prop tech investment landscape?
I think, let's define it in two different ways, Neeraj. One is, what do we think of the business models and the adoption of these companies? And second is whether they're good investments or not. On the first part, what we've realized is that, picking on what Arshdeep and Amber were talking about, there is a paradigm shift that has happened in the office. And office is no more a asset business, it's now an operating business. It's all about how well do I run the office space, which is where people want to, which will actually motivate people to come in or not. We call it it is the feels good paradigm is what we call it. And where the feels is F is for flexibility, E is for efficiency, the next E is for engagement, and the last two are L for location and S for sustainability. If you cannot focus on all these 5 factors of flexibility, engagement, efficiency, location, and sustainability, you probably cannot run a office portfolio. And to manage all these 5, technology will play a very, very pivotal role going forward. That said, a lot of technologies still are not yet established as to what can they do for our revenues, what can they do for our costs, what can they do for a better customer experience. Some are getting there, but most are in nascent stages. And thereby the adoption has also been very slow within the industry because there isn't enough proof of concept for this. So am I long-term positive? Absolutely. Am I medium-term conservative? Absolutely. Which also will belie the investment trend. Be very careful of investing just because you think the TAM, as they call it, which is the total addressable market, is high. Yes, there is a great TAM, but not every one of those prop techs which are there can address that TAM. And you have to be, it is better in this situation to be a follower than to be a leader. Arshdeep and I and Anuj had looked at prop tech very, very carefully a couple of years ago, thinking through the space, thinking of the opportunity. And our realization, it's a great place to be at, but it's a very long tail business still. So good to have, but be careful as an investor.
Sure. Vinam, if I come to you,
may I add to what Yash said? What we are actually looking at, how we at World Trade Center are looking at is, we're seeing that the times, especially the coming times, we're seeing that, there's going to be an evolution. There is already an evolution from traditional to a hybrid workforce, like work from anywhere to ensure the business continuity process happening. But we're also seeing the hub and spoke models which are coming into play, though selectively, but they are coming into play. And we're also seeing a trend wherein we call it the hotelization of the office space, through via amenities and services, creating a digitalization experiences, which are tech enhanced spaces, which are going to be actually a differentiator of quality. In addition, what we are also observing is, as far as companies and RFPs, which we are actually looking at, we are seeing that there's a lot of stress on, with where the environmental, social, corporate, health and wellness aspects or design and strategies are actually the companies are actually looking at. So that is something that we are seeing that is probably going to be the trend for the new office space which is coming up.
Sure. Thanks, Claire. Moving to the last segment, the data center and warehouses, just wanted to quickly touch upon, both these aspects as well in terms of, for real estate demand for data centers is expected to increase significantly in the coming 3 to 4 years around it. And also warehousing, we've seen that a lot more space coming in, consolidation also happening with the larger player on that. So Vinamra, if I come to you, what are the two things, let's say, you would like to stress on from our investment trends that you see in these two spaces, data center and warehouses, and then I'll request Amber or Steve your views as well on this.
Very interesting, Neeraj. I'll keep it short in the interest of time. Just last week, we made 2 huge announcements in both these sectors, where we closed our second logistics fund and made our first acquisition in data center in Mumbai as well. I think logistics boom had already started probably 3 years ago for all the right reasons, and the pandemic has already pushed it with e-commerce really taking the lead, right? So I would continue to expect more and more investment being poured into the warehousing sector. The penetration of grade A warehousing in India is nowhere close to what's in China and the US. So if you just purely look at the numbers of grade A warehousing per capita, we are probably 1% and 0.1% of these two geographies. So there is a huge potential, and that's the reason we, along with many of the other institutional investors, will continue to pour a lot of money. I would reiterate that that investors would need to be optimistically cautious, because the rents haven't moved as fast as they have continued to move in office over the last few years. So while right now it is a volume scale game, whoever gets hold of the right land parcels and builds up the huge portfolio, because there aren't many players doing that. So it is that race right now with many coming in. I do foresee in the long run, probably the top 3 to 4 will really hold key of the market. But the most critical part for me for logistics will be entering the land at the right value, because the whole model is super sensitive to land price, because the rentals are very low as against an office where you're talking $1 per square feet. Warehousing is 20-25 rupees per square feet, right? So I think that will remain very critical. And data centers, again, for all the policy changes, data localization, and the entire digital transformation being pushed through globally, and India getting aligned shares of that, I think, again, huge potential on data center. I won't delve into how big the market is going to be. I think that's for all to see, and we can see the amount of investments. The one thing that I would highlight, just like I did on the land price side on logistics, on the data center side, I think the key thing to watch out will be how much of that investment and operations can be sourced from green power, because data centers are huge energy guzzlers. For us, Capital Land, while data center is a huge investment opportunity globally, we're very cognizant that our objective is to run as many of them as possible purely on green power, because only then it matches with our sustainability targets, which are also very ambitious. But if you're not thinking about green power right from now when you're investing in data centers, I think if you want to be a firm focused on ESG, as Khair mentioned, then you're going to run into trouble. But I think if we can take care of that, then huge potential for both the sectors. Yeah.
Vinamra, we have actually right now the policy when it comes to green power right now in India is still limited. It's still limited, especially when it comes to data centers. We still are using the energy guzzlers, as you say.
Yeah, I think I have a slightly different view. I think I think this leads from the fact that India is a little bit more entrepreneurial, probably compared to a whole bunch of other geographies, both on the data centers as well as on the warehousing side. There are already far too many players in the country with deep pockets, and have plans for investments and so on and so forth. So I think just like what we witnessed in the office space in 2009, 10, 11, 12, and a little bit later on after that as well, where there was a glut sort of a situation, I see, at least in the data center side, in a 3-year time frame, I see a bit of a glut situation, and that is when the consolidation will happen. So all the investments, new investments in data centers today will be tough. Everybody has already announced plans, and if all of those plans actually fructify, then we are looking at a oversupply situation in a 3-year time frame. Warehousing, I agree with Vinamr entirely that it is the land price which will decide. And again, because of such a large number of players and such a large amount of capital chasing some of these deals, that people are, investors are being forced to buy land which is far more expensive, and rentals are not looking to go up. So Vinamr, again, while I agree that in India, the per capita consumption of warehousing space is very, very low compared to other countries. But I think we also need to be mindful of the per capita GDP, the per capita income that this country has. And even if you had all that space available today, built out, would that really be occupied? Would the kind of consumption levels that we have in India, would that justify that kind of warehousing space as well? So I think, as Yash mentioned, the TAM is appearing to be very high, the addressable market. But when you drill a little deeper into it, I think the consumption in India also needs to be looked at before you make a plan of how much warehousing space does this country really need.
But Amber, what I've also observed is I could, with few such companies, I've observed that they're actually looking, their location of, where they want to set up their warehouses also like tier 1 city, like Gurgaon or Dwarka Expressway, so which are tier 1 cities. So obviously the cost of land is going to be high. So there needs to be some kind of structuring by these companies also about the locations where they're going to be setting it up. And we've seen in developed countries that they're not generally in the CBDs or the PBD locations. But in India, we're seeing that their requirements are largely coming for these locations. So that is also a point to consider.
You're right, I believe that a lot of trends will drive this in a manner which we've not seen that before. I mean, in e-commerce, the new trend is the quickest delivery. I mean, people are talking about half-an-hour delivery, 1-hour delivery, and so on and so forth. I think those are things which nobody in the world has seen before.
Yeah, because it's still at a nascent stage in India. So it's like, it's not, it needs to get evolved. So probably that is the reason why they're probably looking at tier 1 or tier 2 city, whereas they need to actually be looking at somewhere outskirts and then build up some service centers in these cities for them to actually be able to serve them. It's like a race battle, the last mile and the first mile strategy, which they need to be incorporating. But we are seeing that in India that needs to get evolved.
So, with that, we are almost towards the end of the time. So, Arshdeep and Yash, if I may request your 60-second view on these areas. Yash, starting with
Just
you.
A quick.
Or
yeah. Sorry. Yash, you want to go ahead?
I'll follow Arshdeep. I always like to follow Arshdeep.
No, I think that's the modesty of a leadership. But my quick view, one is that a UPI transaction happened last year has actually risen from a $25 billion to $40 billion, and that to me is a very insignificant number, and you'll see large transactions go through. So I think we are believer of warehousing, logistic, and data center as a business. But I think I'm exceptionally wary, and I think I cite what Amber said, that it may not be for us to really jump in at this stage, because one, people have to create a differentiation, Secondly, in logistic, you need to have a CBD logistic, you need to have a SBD logistic, you need to have in the city outside logistic, and customer needs to be given a different experience by likes of Amazon, Flipkart, That's one. Secondly, on a data center, you will find that there'll be some bias to cities like Mumbai and Chennai because of the undersea cable, which has been terminating there, So therefore, it again boils down to the cost effectiveness beside the real estate cost, but also this has some impact on that. And again, data center business as we speak now also, as Vinamr mentioned, is a guzzler on the power side. One has to have a right cost to it, right system to back it up. Otherwise, it may not be viable. Third, unlike in an office market, we know what kind of yield that we need to work on that. We really have an idea on this. This market is a little hazy at this stage because we don't have a great data. People like CapitaLand and others who really perform in other countries, obviously have a bunch of experience on their side. But in terms of how it shapes up in India, how it gets competitive, how it's priced, what kind of yield it throws up, I think it's something to watch out for, and I think I'll probably follow what Amber said. Let this people play a game and we'll jump in. It's like, when the tide is out, we know who was swimming naked. So I think that's the way I look at it.
My quick 3 bits on this, Neeraj. One is in India, people people are thinking about this very strategically, or rather very tactically. We like to think about it strategically. We think both data center and warehouse businesses have huge network economies of scale. So if you don't have the network, if you don't have the volume, then you should be careful about whether you want to enter the business or not, and whether you will be able to compete or not. The second part to this is, very often, again, in India, we get very seduced by the demand and the potential demand. You have to be very, very cognizant and conversant with the supply side, how much supply is coming, as Amber said, what the cost of supply is, Vinamra said, and are you really better at managing the supply side challenges versus the competition? Everyone knows the demand. It's the supply that matters in India. And the last part to this is, we continue to follow the strategy of let the big boys do the big stuff. That's a high volume, mid margins game. What we are thinking about in data centers as well as warehousing is, where are the margins and where is the niche opportunities? Is it a tier 4 center versus a tier 3 center in data centers? Is it last mile in warehousing? A lot of question marks, but very, very exciting times ahead.
Wonderful. So with that, I'll wrap up the session. There, I think as we discussed during the this last 1 hour, the offices, especially in the tier 1, they get a big thumbs up, from all our panelists there, with the support coming in for the specific micro markets around it. Tier 2, tier 3 also, we heard that there are some mixed views in terms of where the potential would lie, and I think some bit of uncautious investment in that area does seem to be appropriate, by seasoned investors on that. I think clearly on the office market side of it, the REIT space is, clearly started to kind of expand, and we'll see more REITs coming in as well in 2021 and beyond there. I think the data centers and warehouses, we heard that there was some mixed views on that. Clearly, in terms of the opportunity is there on the requirements aspect of it. Again, the depth of the market and the approach towards it varies on that. And lastly, in terms of, I think the government efforts also, in terms of how the government does really move up in terms of the vaccination program, and also how the economy picks up, with respect to the how the policy landscape really comes through as well, including some of the policies that we will see on the data centers and e-commerce, and implementation of those policies, I think would also drive how the future investment will come up over there. So with that, I thank you so much to all my fellow panelists, and it's amongst industry experts and veterans and friends. So very nice to be with all of you today, and thank you to the viewers also again. Thank you very much.
Thank you,
Neeraj.
Thank you very much.
Thank you,
Thank you
Neeraj,
very
for
much.
that wonderful moderation of conducting of the panel and getting the best out of our speakers. In fact, they have covered most of the questions from hub and spoke. We had questions about that. We had questions about how the commercial realty investments are going to, and our speakers have said short term be cautious, but long term the prospects are really bright for commercial real estate. We have also touched upon the alternate asset classes, so that was again an addition for our viewers. So thank you so much all our viewers, speakers here, for sharing your views. Mr. Arpit, thank you for being here. Vinamra, thank you for sharing your views. And yes, sustainability, green power is the way to go forward if you want to this is the only planet we have. So, and Amber, thank you for sharing your views. Khairul Nisa, thank you again for being here with us. Neeraj, thanks again. And everyone, we had a great session. Thank you so much.
Thank you.
Thank you, Sapna.
Thank you so much once again.
Thank you, everyone. Bye-bye.
Thank you. Bye.
So that was one fantastic session where we talk about one of the asset classes, which is the commercial real estate. So let us move on to our next very informative session that we are going to have, which is on investors betting big on warehousing. So our last panel members did mention about this segment, but let's know in detail from the people who are into this segment. So let me introduce our session, the panel members for this session. The session is moderated by Piyush Gupta, Managing Director, Capital Markets and Investment Services India for Colliers. Piyush is leading the client acquisition, developing institutional relationships with Indian and global funds, sovereign funds, banks, NBFCs, AIFs for capital markets businesses, and he has close to 19 years of experience. He's an industry veteran with proven expertise in real estate investments, asset management, and exit strategy, deployment, and business development. Let me introduce our expert panel in an alphabetical order. I welcome Ms. Rajni Sinha, Chief Economist and National Director Research, Knight Frank India Private Limited. Rajni is an industry expert and has served in the senior management in large organizations such as Kotak Mahindra Bank, JM Morgan Stanley, Dun & Bradstreet, as well as Aditya Birla Management Corporation Limited. And she has a career spanning over close to 2 decades in the segment. Our next panel member, let me introduce Mr. Rajat Garg, Head of Investment, ESR India. Rajat is a real estate private equity investment specialist and has 15 plus years of experience with world's leading fund managers in logistics, industrial, data centers, and commercial office space in India and South Asia. Our next eminent speaker, Mr. R.K. Narayan, Chief Operating Officer, All Cargo Logistics and Industrial Parks. R.K. Narayan leads All Cargo Logistics and Industrial Parks business, which has a significant pan-India presence, and he has overall 25 years of experience in real estate investment and asset management and investment banking. Let me welcome our final speaker of this session, Mr. Yash Ravel, Executive Director, Fund Management and Corporate Strategy, Wells Fund One. Yash has 15 years of overall experience with 13 years in real estate investing and asset management, during which he worked on transactions of over USD 600 million. So this is our eminent panel, and let me now hand it over to our moderator, Mr. Piyush Gupta.
Thank you, Sapna. Thanks, Sapna. Good afternoon, all. Thank you, Realty Plus, for organizing this. A very warm welcome to all speakers and the audience. I think Hi. It's an interesting discussion for us on warehousing. I think there is no doubt Indian warehousing industry, has become very relevant in the overall real estate space in India, and possibly, on the way to become not only number one or the biggest, but also the smartest in the world. So I think along with government policies to nurture India as a global manufacturing hub, or a COVID-19 pandemic induced e-commerce boom, and the rise of tier 2 and tier 3 cities increase the demand for overall quality warehousing spaces, especially grade A, with the latest technology innovations. So the investment in warehousing has constantly, gained momentum, and more importantly, bounced back very quicker, once the COVID, kind of, stabilized. I think it will be interesting to discuss all these points, what is driving warehousing business in next few years, newer markets, technology, sustainability of assets, returns, exit consideration. I think we can have the discussion very free flowing. We may agree to disagree on various discussions points. To start with, maybe Rajat, I can get you in and to start with the key drivers. What is driving the warehousing business for next 3 to 5 years time? Today we have seen consumption, e-commerce related, driven demand. But another thrust which is now coming is on the manufacturing side, and looking away from China, and manufacturing will, for a long term will remain the backbone, of warehousing from a long term sustainability perspective. So, what your thoughts, on the manufacturing, and specifically, with the thrust on self-reliance, make in India, and countries looking beyond China for manufacturing?
Right. So we at ESR always think that a business is clearly divided into 2 pillars. There is everything which is driven by consumption. You mentioned e-commerce, you mentioned online retail, offline retail, and then there is industrial, which is largely manufacturing, light assembly. These are just 2 completely separate pillars. At times, even the products we offer to these 2, let's say tenant categories is separate, and both of them need to sustain, in the long run at a large scale for India warehousing business to kind of, really be successful in the next 5-7 years. There's been a lot of hype about investment outflow from China and being redirected into India. Have you actually seen that in the last 12-18 months? I think my personal experience suggests not so much. I think it's been more hype and less truth. Some of the benefits China has with respect to governance, with respect to scale, with respect to policies, let's say, even something as simple as ability to hire and fire labor isn't as easily replicatable in India. So we'd see a long time before we see, let's say, an en masse movement of Chinese manufacturers moving into India. Although I think we've seen some green shoots, and hopefully they should pick up very soon. In limited states, I'd say we've seen a lot of activity pick up on the manufacturing side in Tamil Nadu, for example. I mean, kudos to the Tamil Nadu government for being so proactive in welcoming, manufacturers. We've seen a lot of activity in Maharashtra, some in Telangana, some in, I'd say even Karnataka. So a lot of, I'd say, activity in the southern belt, not so much in north and west right now. And even within manufacturing, I think limited sectors are, let's say, driving up new demand. Renewable energy, for example, is one where we see a massive thrust. There are tons and tons of, let's say, large scale wind and solar manufacturing entities who want to start operations in India. These entities want to take up space as much as, in a single shot, they take up anywhere between 500,000 square feet to 2-3 million square feet space, because they set up these, really large scale industries on these sites. And a lot of, government incentives available in India, are incentivizing these guys, I think, more in terms of, I'd say, expansion than relocation from China to come in here and, set up new facilities. So renewable energy also, I see a lot of activity on the telecom side, electronics, engineering. I think these are the sectors that will drive new demand from a manufacturing side. Traditionally, it used to be a lot more of oil and gas, automobile, auto ancillary. That has, I think, definitely slowed down in the last couple of years.
Yeah. Thanks, Rajat. And yes, to your point that in last 12 to 18 months time, a lot has been spoken about relocation or expansion, but we haven't seen, but we talk about renewables or even some specific government, state governments like Maharashtra and Tamil Nadu, you mentioned specifically. Yes. If there's a good, calibration and collaboration between central and state governments to, attract more investments, possibly it can definitely go to a, next level from that perspective. With that one, Mr. Narayan, if you can get in and, from your perspective, how are you, seeing this from a global perspective and relating that to an Indian on a manufacturing thrust, more demand from China and maybe other countries also coming to India? Mr. Narayan, you're on mute, sorry.
Yeah, can't hear you, sir.
Sorry, I didn't realize. Yeah, so I do see that there would be an increased, manufacturing side of demand coming in. Not so much as Rajat also mentioned, so much on the traditional automobile, auto parts, and things like that. Maybe they will come back later, but immediately, at least for the next few years, what we are looking at is also substantially, what is being the focus of the government also because of the scheme that the government has, PLI scheme that the government has. And if you see people, international companies who have tied up, who have come under that scheme, are your traditional ICT side of it, telecom components, IT components, hardwares, renewables, as also Rajat pointed out, and EV manufacturing. So these are the ones which we are seeing from a demand perspective. The traditional ones, which is another specialty steel or something, those all will come later. But that also, from a manufacturing perspective, yes, they will attract investment. But from our domain, our area perspective, where you could find a demand in the logistics and the industrial park, we're not talking of those large, heavy-scale industries. We are mainly talking about assemblies and light engineering, etc., etc. So they will come, but to expect a huge amount of demand coming in because of people moving away from China, I think that the effect to India will come, but it will be not so much as some other countries might get, which have a better manufacturing setup like Vietnam, Indonesia, etc., etc. So it will come, but particularly some countries have announced, like Japan or Singapore or South Korea, where they have announced maybe they will completely move away over a period of time, or they will have China +1. So we might get benefit of some of that China +1. Whether we will be a major beneficiary, I do not think so.
I just sorry for interjecting. I just say I actually think it's a little bit of an opportunity lost for all of us by the Indian government. I don't think we did enough in the last couple of years to incentivize manufacturers to move in. Otherwise, why would you see such a large scale movement into Vietnam and not in India? But that's what's happened.
So, Rajat, I would actually not blame it to just the last 2 years, what the government has not done proactively. There are many things, the base itself from many perspectives, whether you call it the whole delay which happens in the permits or the land acquisition or, the labor laws. There are many. So as a base which those countries have developed over a, more investor friendly kind of a setup, that happens over ages. So government is trying that, mere tax incentive or, export incentive or capital subsidy or something like that. They've been there in the past, but, not so much beneficial. At least the government has moved the shift away from, capital investment linked to production linked, output linked, from an input link to output link. So that is something which is driving. We will see that, things coming down. What might also be a greater driver of manufacturing would be, our own internal demand. And some of the inputs that we were perhaps importing, maybe, you start creating domestically itself. The various international companies like Apple through its, multiple companies, manufacturing tablets here, of manufacturing, mobiles, etc., of assembly, that is probably significantly because of domestic demand, not necessarily for, exporting purposes. So domestic demand, some effect of the China plus one or reshoring, or some areas in like electronic, pharmaceutical is one another, which will, or a revival of textile. So these are the areas which will actually drive the manufacturing aspects in India.
Yes, Mr. Narayan, thanks for this. Yash, coming to you, and before I go to Rajni, so I think so one aspect, Yash, we covered about the manufacturing shift, whether, we talk about our pharma prowess or, government policies or renewables. If we go beyond manufacturing, right, and purely from the driver for logistics and warehousing business, something like, cold chains, right? So it has a different dynamics. Or we were, in the previous panel, we were discussing about a half an hour or a 1 hour delivery. So which gives rise to, in city or a very close knit, in fashion centers. So any thoughts, around that, new evolving model and how this going to drive the, overall demand?
Sure. Yeah, absolutely. So Piyush, maybe I'll spend a minute just going back to the last point and then come back to this one, right? So, first of all, I completely echo Rajat and RK's points, right, on manufacturing demand and, potentially the growth of that in India. So I think, when you look at, transferring some of that demand from China, so it's a very structural change on both sides, right? Both for companies who are looking to either migrate manufacturing bases from China, or whether they are looking to implement sort of a China plus one kind of a formula. So while, we've obviously heard, a lot of talk around that, I don't think we've seen much of that really happening on the ground, right? And I won't expect that to happen anytime soon, because these are structural changes which take time. And, if, we've learned anything for India over sort of our investing careers, it's that stuff takes time, right? So, I don't think this is something which is going to change from a short to mid-term perspective for sure. Both on the China side, where people are evaluating moving their investments into India or other countries, or from an India perspective, where, some of the points which Rajat and RK mentioned, where honestly, I think we do need to sort of clean up our act and provide a better enabling infrastructure, whether it is on land acquisition, approvals, labor laws, etc., right? So, I do believe that over the short to mid-term for sure, the sector demand will really come more from consumption-linked demand, right? Where you see 3PL and e-commerce being sort of the lion's share of demand at probably 50 to 60% or even more, right? And manufacturing and everything else being slightly lesser. But that said, hopefully over the longer term, hopefully India is able to sort of get its act together, in terms of all of these things, land acquisition, approvals, labor, so that we are able to attract a larger part of that demand going forward, right? But so I'm personally hopeful that at least longer term, we should see a meaningful part of that manufacturing demand coming into India as well.
Yeah.
moving to your question on sort of cold chain and other sort of avenues for growth, right? So I think cold chain particularly, my view is that there is definitely a lot of demand, right, across cold chain in general. But again, you have to sort of break it up into a couple of different buckets, right? So when you talk about cold chain, one bucket is sort of temperature controlled warehousing, and the other is really your, zero, sub-zero kind of chilled warehousing. Now, the latter is something which is probably very high value, where margins currently look great. But the problem with that is that you're really not able to achieve a lot of scale, right? So the target segment, which is really able to utilize that, primarily is made up of, meat, fish, pharma, a couple of, higher end frozen food items, etc., is not a very large base. While it pays very well, I think it's really difficult to see scale there, and I don't think that's going to change for some time. The other end of the market, which is your temperature controlled, is now becoming a large market, right? So earlier, I mean, that was primarily unorganized with, very few or, no organized players really into that space at all. Now that's obviously changing with the, corporatization of food chain, grocery, etc. Plus you have a lot of these, online or tech-enabled players getting into that space as well. So again, I think, what we will really see short to mid-term is we will see the temperature controlled warehousing demand increasing meaningfully, and probably less so for the zero or sub-zero kind of cold chain warehousing.
Interesting, Yash. Rajni, coming to you, your maybe incremental thoughts, on both the newer emerging trends, for warehousing, and also the shift which we spoke about, from China or elsewhere to India.
Thank you, Piyush, for the question, and a very good afternoon to everyone. So I agree with what my fellow panelists said just now. If we look at this move of manufacturing from China that we've been talking about, let's first get China's position on this clear. Like, China contributes around 28% to global industrial production. That's huge. India's share is something around 3%. So there's a reason why all these manufacturing units are in China, be it economies of scale that China offers, infrastructure, availability of skilled labor. So it's not going to be all that easy to move manufacturing from China to India. And then what we have discussed, if there are businesses talking about reducing the exposure to China, but then there India is competing with many smaller countries like Vietnam, Bangladesh, Thailand. And here it's interesting to note, like, Rajat was talking about why is it that a lot of manufacturing is moving to Vietnam and not India. So I think one place where India is losing out to these smaller countries is integration in the global supply chain. So that is where Vietnam has an edge. Vietnam has just got into all the correct trade agreements. So if you see, Vietnam has trade agreements with all the major consuming big developed countries. That is where India has been kind of, trailing. But then India also has to be very careful about getting into trade agreements because we ourselves have a huge consumption market. So, that's the reason why India pulled out of RCEP, because we can't risk exposing our market because many other global players would be interested in our market. Having said that, it's not that nothing has been happening in India. I would say this production-linked incentive scheme that the government has come out with is a step in the right direction, and we are seeing a lot of interest in that. Infrastructure also, things are happening. If we look at ease of doing business, which is a big concern with global players, that also in the last 1 year, we have moved up some 16 in the terms of ranking, but we are still ranked at some 68, 69 level. So there's a lot that needs to be done on both ease of doing business front as well as infrastructure front before we start seeing a meaningful move in manufacturing sector to India. So yes, some last 1 year or so, there has been some movement, but like we've been discussing, nothing very significant. So that's my view on manufacturing shift. talking about what trends in warehousing and what's going to drive the growth here, I would say that technology adoption is one thing which will become very critical going forward. Because right now, if we look at the warehousing segment, the adoption of technology is still very low compared to developed countries. And now when we are talking about institutionalization of this segment happening, we are talking about moving from grade B to grade A, penetration of e-commerce increasing. I think, and this whole conversation about same-day delivery and all that, that would require a much faster adoption of technology than what we've seen so far. And I think that's where a lot is going to happen going forward.
Thanks, Rajni. I think it's an interesting point which you brought out on technology, and which leads to doing a value add from an operations perspective. Now, whether we talk about robots or augmented reality technology, so this is clearly enabling business to regulate warehouses even in remote locations. So which gives rise to more absolute efficiency and have a much penetrated reach into the hinterland, whether we talk about tier 2, tier 3, or even tier 4 cities. So from that perspective, maybe Rajat, your views is twofold. One is technology one among the key value add which the operator is now bringing in to the table, and which also relates to the point of having a deeper penetration because of the strong technology network.
Right. So I think developers, I like to call ourselves more as developers and fund managers and operators. I think developers and operators, whether they like it or not, I think they need to focus on technology. Warehouse as such is a fairly standardized product as compared to, let's say, shopping centers or hotels, which are very design heavy. How do you differentiate? As ESR, when we enter the market, we come up with, let's say, certain overheads, we make a certain standardized product which needs to be marketed at a certain price. And for us, one of the big differentiators is technology. We actually have something called an ESR India Smart App, which, just to give you little examples, it monitors movements of every truck that enters the facility. It tells the chauffeur where to park, small things, right? Where should the goods be unloaded? Where should the goods be loaded into? It gives them, if it's a larger park of, let's say, a couple of 100 acres, it tells the driver exactly where that particular warehouse is. That's one example of what the Smart App does. So a lot of, let's say, features that independently sound tiny, but together add up to drive up, I'd say, operational efficiencies for all tenants, whether it's manufacturing or e-commerce or retail who operate from our facilities, is very important. I think these are some of the things that increasingly we'd see everyone expecting. I think for now the market's pretty small. 20% of tenants expected, 70-80% are fairly ambivalent about it. But I see in the next 2-3 years, you'd see at least 50% of tenants differentiating between locating A warehouse as compared to B, depending on the amount of technological support they get in these facilities.
Thanks, Rajat. So Yash, coming to you, so technology may be one of the more important drivers for moving to more micro locations. But do you think the more demand, either because of availability of land, demand, and technology is more we are seeing now in not even tier 2, but tier 3, tier 4, even tier 5 cities?
Yeah, so Piyush, I think my view is that we really won't see a lot of the tech rollout with respect to tier 3, tier 2, tier 3, tier 4, right? And like Rajat mentioned, I think tech is definitely important where, all of us want to be able to use that as a differentiating factor where we are, trying to use sort of cutting edge technology to that extent for park management, where we are able to offer a much more seamless experience and better efficiency, better throughput for our tenants, right? So, that's definitely a big part of what we do as well. And I would think a lot of the other serious players in the market would also be looking at implementing similar solutions. But that said, when most of us think about warehousing technology, we're thinking about, robots moving about inside the warehouse, picking, sorting, that sort of stuff. So I think, when you look at that end of technology, the investments and initiatives on that side are primarily still being done by tenants, right? So for instance, someone like an Amazon obviously brings in a lot of technology into its warehouses. I think technology becomes even more important, when you start looking at in-city warehousing, right? And there it is just not something which is nice to have, but it is a necessity, right? Because that's the only way to sort of deal with the higher price of real estate in city is to sort of increase density, right? And having these sort of automatic, stacking systems, sorting systems, retrieval systems, etc., for goods and products is one way to improve density, improve throughput, which becomes an absolute necessity when you're talking about city center real estate, where you need to deliver maximum bang for the buck, right? So I think increasingly, I mean, if you look at sort of other examples regionally or globally, you have a lot of these prop tech startups which are really focusing on this segment, where they're basically implementing technology solutions for in-city warehousing, right? Where you can really ramp up the density of a in-city warehouse by like 5-10x compared to what you'd otherwise be able to do operating it as a traditional warehouse.
Yeah, I just like to add to that. Overall, we think in-city is going to be massive. I think India is a place where in-city warehousing hasn't yet picked up at all. I mean, I don't know of a single modern, large-scale institutional developed in-city facility in India. We're very, very actively looking into that segment. We've had very successful experiences in APAC outside of India, China, Singapore, Japan. We built in-city warehousing, created, let's say, almost like a new product asset class in the market and being good at it. So we're trying to do that in India right now. I think the real challenge remains land. Getting land in city, you're basically competing with office, you're competing with retail, you're competing with residential. Can you get the same price, same capital values as those asset classes? That's tough, right? So that's the key challenge. But from a demand perspective, if you speak to, I'd say, everyone from the morning guy who delivers grocery to your place to the Amazons or Flipkarts of the world, there is massive demand for in city. It's on us now. I think the ball's really in our court as developers on how do we think we can serve that with the right product, right technology, right size. And I'm pretty hopeful in the next 24 to 48 months, let's say 2 to 4 years, you'd see in-city warehouses practically in all tier 1 cities in India. Tier 2, as Yash also indicated, I think in-city will take a little bit of time. Tier 2 for us is, I think, largely right now just a pure play on consumption. Fact is that, any adolescent kid sitting in any, let's say, far east, far northeastern town or the hinterland in the central India is still very keen to buy fashion, is still very keen to buy goods that aren't easily available in those places, and online is their only option with or without COVID. I mean, to me, COVID is still short term. I'm an optimistic guy. I keep telling myself COVID is another 6-month story. But the overall change in customer behavior is not going to change.
Yeah.
They do want goods sitting in their homes within a day. And hence we see massive demand for large scale, fulfillment centers, sort centers, warehouses in tier 2 cities.
Yeah. And you mentioned about in-city, warehouses. So possibly we might even see a vertical, warehouses because
needs to be vertical. Yeah, absolutely. We're looking at, let's say, anywhere between 4 to 8 story warehouses. That's the only way you can, make it efficient.
Yeah. Yeah. On this one, Mr. Narayan, from your perspective, any further thoughts on, getting more operating, efficiencies? We spoke about technology and, other things. Anything which you want to add on from your experience?
No, I think Rajat pretty much said it that most, and Yash also referred to it. Most of the technology inside a logistic park is more as part of the warehouse management system of the tenants, of what they do inside, and bring in their own efficiency, better utilization on a cubic feet basis, better utilization on a throughput basis. When it comes to express logistics, there is no cubic feet, but there is increasing throughput in and out, how quickly they can do the turnaround. So it's more on them, but as developer, to the extent that we can support, we do that, which party Rajat also mentioned too, and trying to reduce their operating cost by bringing in solar energy, by bringing in, whatever other system, and also trying to give them a continuous power. I mean, that continuous power is a big time requirement of theirs. At some places we incur high cost, at some places we incur, manageable cost. So that's what one would tend to do as a developer. So from how to reduce their operating costs, that's the key goal, and how we use technology for that. Also our maintenance cost, our preventive maintenance cost, proactive maintenance, those are the aspects. So to the extent we can put in smart devices in some of the, the major component of any commercial asset cost is the AHU cost, is the energy cost. The entire AHU, the entire elevator system is all missing in the warehouse. So it is the most sophisticated element that we have is, you can say it's a solar, but that's also once established, it's a 25-year asset with very minimum maintenance. Then you've got that, STP, which is what, which is also not a sophisticated item as such, it's just a regular maintenance item. So not much from that perspective, but whatever smart devices one could put for, water usage, for electricity usage, monitoring, for the traffic movement, for people movement, those are the kind of things that we do to try and reduce our own operating costs and the CAM cost. And yes, on the development side, yes, of course, now more and more remote project management, monitoring, which is happening thanks to, new technologies coming in. So, you have people at the site and you can do monitoring offshore, away also. So we try to bring in efficiencies in the development also.
Right. Thanks, Mr. Narayan. Rajini, Yash and Rajat both mentioned this point that, now the habits of people have changed, right? Whether we talk about tier 1, tier 2, tier 3 cities, people want to consume the way they have been consuming and, shopping in last 12 to 18 months time. So the demand pattern is possibly what we were seeing only in tier 1 and tier 2 is clearly going in tier 3, tier 4, or even, lower cities in the, similar trajectory. So yes, there are some, infra challenges, which is anyways getting addressed, in separate form, but technology penetration has definitely happened. So from a penetration perspective, in the hinterland, your thoughts, what kind of trends you see, emerging, maybe on a more geographical perspective, east, west, or otherwise, and also how fast do you think the penetration actually will happen, in cities beyond tier 2?
Piyush, if we look at the population, large chunk of India's population is in these tier 2, tier 3, tier 4 cities. And people there have aspirations. They are looking at what is being consumed in tier 1 cities and they want the same products. And this technology penetration has made that possible. And I would say, while if you look at e-commerce penetration, before the pandemic, the penetration was around 5% in India. It was anyways increasing, but I feel this pandemic has given a further strong boost to e-commerce penetration. Because a lot of people who were on the fences and now they've made that move to online shopping, they will stay because they have seen the comfort of that. So I think technology, this e-commerce penetration is going to be very sharp in India. We do not have the data of, I do not have the data of what happened to e-commerce penetration in this pandemic year. But say for a developed market like UK, I was looking at the data and I saw that e-commerce penetration jumped up from some 20% to 30-35%, which is a huge jump. So I think in India also this whole possibility is there. And as I said, the aspirations are there. So, and in fact, if you look at what has been happening, if we look at the data so far, even in terms of warehousing demand, the last 2 years, as per the data that we have, the warehousing transactions in FY21 for the top 8 cities, we saw the transactions contracting by some 20-21%. In FY20 also, we saw for the top 8 cities, the warehousing transactions contracting. But the basket of these smaller cities, 12, 13 cities that we track, we saw that last 2 years, they have been recording good positive growth of above 20%. I agree, this is on a low base. But what I'm trying to reiterate that there is huge potential of growth in these segments because the aspirations are there. India is a consumption-driven economy. And once they have access to these products, there is no stopping the consumption.
Yeah. Yeah, Rajni, absolutely, and hence the investment trajectory. We are seeing it in last 4 years, the way it's on a upscale. So if at all we shift our discussion more to capital investments and how our international investors and platforms looking at this. And I think so one point which we need to discuss is the long-term sustainability of returns. So say if at all we compare this with office, now the industry is at least more than 15-year-old. In a large section, possibly we have seen some sustainability of returns and the assets. From warehousing perspective, maybe it's a relatively newer. So if at all, maybe Rajat, your thoughts that a specific yield and the quality of assets, how are the investors looking at the investors to continue giving the assets, continue to give those returns from a long-term perspective?
Right. So I'd say there are two sets of investors right now in the market. I'm limiting my sample set to institutional investors, keeping domestic HNI money aside. There are institutional investors who look at this as a 3 to 5 year reallocation of capital. People who think they're overweight right now, underweight right now on logistics. They want to allocate a lot more capital from office, from retail, from student housing into logistics, and think that this is the right time to enter. We do a 5 year play, let's say enter at a 9% yield, exit at a 7% yield, get some capital back. And then there are real long-term patient investors who I'd say are more appreciative and understanding of the India story. I mean, Yash very aptly said things take time in India, but things do happen. And that's what we've seen in equity markets and office market in the last decade and a half. So our view is both the investors stand to make money here. It is a very competitive market. Land acquisition is, as difficult as doing anything else. I don't think buying land in India is, let's say any less difficult than perhaps creating rockets. We've just seen a lot of news last week, and I'm just getting inspired by that. So land acquisition remains extremely difficult. Tier 1, tier 2, in city, outside city, it remains a challenge day in and day out. I mean, I'm sure Arki and Yash understand where I'm coming from. And keeping that in mind, I think what we've been essentially communicating to investors over the last couple of years is it's almost a little, I'd say unfair, or perhaps let's say inept to compare forecast returns from logistics to office and retail. To us, office and retail are a lot more cyclical. To us, logistics is a very high volume, integrated network creation, relatively lower risk, medium return play, right? So you need patient capital who understands that story. Can you frankly, hand on heart, make 25% returns in logistics today in India over a 5 year period? I don't think so. I think you can see Excel spreadsheets floating around promising 25% returns, but I'd be super surprised if, someone can spin that magic. I think this is really a mid-teens, return on equity sort of a play. Yields right now are anywhere between 8 to 10%, depending on markets you operate in, the efficiencies you have, as individual developers. And I don't think those are going to change. I think the band is going to remain at 8.5 to 10% perhaps. You need to figure out, which end of that band do you want to play in as a market participant. And possible return on equity is essentially the yield plus growth, right? So I think growth would be very, very similar to how I see long-term inflation in India. Right now, inflation is high. We've seen periods of low inflation, but over a longer term, I think 3 to 5% CAGR is what we are looking at. So you enter at 8-10%, you play a 3 to 5% CAGR play, you benefit a little from leverage. Fortunately for us, leverage costs have come down in the last year and a half. All in all, it becomes, as I said, it's like a 14-15% return on equity sort of a play, give or take 100-200 basis points. And we need patient capital who understands that. I think us at ESR are fortunate. We've had, let's say, proof of concept in other countries, and hence we have capital backers who understand that if you're patient enough for 7 to 10 years in India, and given logistics is a lot more stable as compared to some of the other competing real estate asset classes, we can make that mid-teens return with the right discipline.
Yeah. Thanks, Rajat. Yash, your perspective, and given the fact that you all have, raised capital, and both from, institutional as well as even retail, right? So how are you seeing the investors, on both the sides looking at this play?
Sure.
Yeah, so Piyush, I think look, whether you're raising capital from institutions or even local HNI family office money, as we've done, I think the expectation of returns from real estate development continues to be sort of in the vicinity of 20%, right? Like Rajat said, I think that's getting harder to achieve. Uh, and I think the main reason for that is really, I mean, we've always seen in India, land prices sort of tend to run ahead of themselves, right? So while, yes, we're still able to, probably underwrite entry yields at, between, let's say, 9 and 10%, so that by the time we're exiting the asset, we've, baked in a couple of escalations and we're in the vicinity of 10. And we're looking at, hopefully exit cap rates, which are, in the vicinity of 8, right? And if you're able to do all of that within sort of a 3-ish year time frame, you will pencil into that 20% sort of return, at least on Excel, right? Now, I think there are a couple of aspects to this. Like I said, yes, those returns are getting harder to underwrite. 2 reasons. I mean, land prices are sort of running ahead of themselves. So really, I mean, we're finding it difficult to acquire land in the locations tenant want at the kind of pricing which would make sense for these yields, right? The second thing is also that, if you look at the specification of the warehouse box, that's actually undergone a lot of change over the last couple of years, right? So, I mean, a couple of years ago, you would probably build these boxes at, 12, 13, 1400 bucks. But now, if you look at the spec which, any of these grade A tenants want, you're looking at easily, north of 18, 1900. If you look at some of the e-com players, you'll be north of 2000, right? So I think that certainly, makes it that much harder to sort of then meet those underwritten returns. That said, I think a good thing for this sector is that, if you look at it now, probably if I had to guesstimate a number, 80% of the capital which is chasing this sector is now institutional, right? So beyond the point, all of the LPs for, most of the developers or managers in this segment are, foreign institutional capital or, institutional capital of some sort, where they are looking at, when they're again looking at development in India, they are looking at that sort of, 20% or at least 18 to 20% type of IRRs on your underwriting, right? So I think the fact that most players are utilizing a similar flavor of capital, and this is one of the requirements of that flavor of capital where you need to be underwriting to these returns. Hopefully that might keep the market in check, where, beyond a point, people will just not be able to do deals which don't match up to these returns, right? So I think, and then long term, we will see yields probably moving down over time, right? But then also we will see sort of risk moving down over time, right? Where over the next couple of years, this will become a much more mature sector, which has been able to deliver, in terms of returns and in terms of this thesis, where people are then comfortable sort of attaching a lower weightage to that development risk or India risk, or whichever way you want to look at it, right? Where we are then able to, underwrite to somewhat lower returns than what we are targeting today.
Yeah. So
just to budge in, sorry, if you just to budge in the last couple of years, yes, rents haven't gone up like everyone expected. I think the growth, let's just say the growth from 2017 to 19 hasn't yet happened again between 2019 to 21. But we're again, I think you need to keep looking at the long-term picture, right? I mean, that's how our thesis at ESR is. If you look at developed market, okay, we can take examples of Australia, we can take examples of the United States, we can take examples of UK, and you just simply compare CBD office rents to industrial rents outside cities, and you do a ratio analysis. I think it's typically about 1:4, 1:5. If you see, let's say, rents for warehouses on outskirts of Delhi and Bombay and Bangalore, the 3 largest cities in India, to office CBD rents, I think that ratio is really on an average 1:10. So there's a lot of, let's say, potential for rents to increase. What needs to happen though is, I think, why is it that these ratios are worse off in India? It's just infrastructure. The difference in quality of infrastructure between a CBD location, you look at a BKC in Bombay vis-a-vis a Bhiwandi in Bombay, is right now massive. right? If governments and private participants can together figure out ways to bridge that infrastructure gap, there is no reason why that ratio cannot crunch from 1:10 to 1:5, 1:7.
Yeah. Yeah, but the Rajat, only the other point is the return expectations between a office and a warehousing. It kind of move in the same direction, like a 20% development risk. On an operating yield perspective, maybe 8.5 to 9.5%, and maybe return on equity maybe around 13-14%. So they tend to flock together. But here the challenge is the scalability and the options to invest today. If an investor wants to partner and put about $100 million, you have very limited options, or I would say none.
That's right.
Right. Yeah. So from that perspective, maybe
I would just like to add to that.
Sure.
What you said. So maybe return expectation. I mean, as you mentioned, maybe the same. But remember that we're talking of different risk elements in both, right? In terms of
so important,
etc., is very different in office, particularly what you have seen in the last 2 years, right? Versus in the industrial. So industrial is more stabilized assets, I would say, and therefore the return expectation also accordingly moves in tandem with the risk elements of it. Point number 2, I may want a much higher development yield on office asset than on a warehousing asset, for the simple reason that the development risk per se is not so much. It's a very short cycle development, that you have to do, and there's no uncertainty of 3 years, 4 years kind of a development risk that you have there. Also, in terms of scalability, opportunity, etc., I would say still is there long time. I won't be, the previous discussion was very much on a cautious note. The last 10 minutes of the previous panel discussion which happened, they were pretty much cautious, but I think we will remain significantly, optimistic at this point of time. Just a simple data point. I was reading a CBRE report of what is the scale and size and absorption that's happening in the US market. Fine, we may be far away from the US market, but even at current mature situation of those markets, in the December quarter and in the March quarter, they have done in the December quarter, they have done 130 million square feet of absorption. And in the March quarter, they have done 116 million square feet. We are still talking of 30 to 40 million on an annual basis, right? For the entire country on a grade A office, grade A industrial. So
logistics,
and there also significantly the driving, the driving factor has been e-commerce. You would tend to expect that penetration there, etc., would be higher, but driving factor was still e-commerce largely, and some manufacturing which is coming back. So we still have a lot of penetration to achieve on the e-commerce side. So I think this demand aspect will remain. It is more for us as to how we can execute, and which is primarily boiling down to the point of where to find land. In terms of growth, it will still be greenfield as opposed to acquisition. Maybe 5 years down the line, growth of any single player would be a combination of acquisition and development. But right now, it's largely development still.
Yes, and since you mentioned about scalability, I think we'll just add one more point is on the exit, and the clear transition comes to REIT. So in office that is well established now, right? Maybe on the industrial side, we are yet to see in India. So if at all, maybe we have a good example of an industrial REIT or any of the warehousing assets moving to an existing REIT, possibly that could demonstrate a better exit and also some kind of a cap rate compression being exhibited. So on that one, maybe Rajini, you have any thoughts on the possibility of industrial REIT coming to India soon?
Piyush, I feel that warehousing in India is still at a very nascent stage. So I would see right now it would take another, I would say, 3 to 5 years before we reach the stage where the PE players are able to reach that scale where a REIT would be possible. And once they have seen that one full cycle of rent escalation with completed projects, it's only then the market would be ready for REIT. I think right now it's not at that stage. It would take another 3 to 5 years before we see industrial REIT coming into the market.
Rajat and Yash, maybe your words on that. What kind of exit would these investors look at? Is it?
I'd say I'm a little more bullish than what Rajni just said. I actually think both sort of exits. A lot of developers, a lot of investors want these 20%, or as you know, I'd like to believe more 16 to 18% post-tax returns. And then there are developers who are super scared of land acquisition and development risk in India. They want to focus their capital, let's say pension funds, insurance funds, on long-term core asset ownership. So we've got both these pools of capital, and you'd see a lot of shift from development pool to core in the next 3-4 years, which is one form of exit. But the larger play, I'm very, fundamentally, let's say, confident is going to be REITs. I think we've got three office REITs right now trading anywhere between 6.5% to 8% yields. If there were to be hypothetically industrial listed REIT today, and given we're in the middle of the pandemic, given there are different driving forces, it's a relatively a lower risk market. I think an industrial REIT can trade at anywhere between 75 to as much as about 125 basis point premium to an office. I mean, when I say premium, 8% effectively means, industrial should be 7%. Keeping that, thesis in mind, I think next 3 to 4 years, you will see, in my belief is, you will see at least 2 large real estate investment trusts, or I think as infrastructure players, I'd like to call myself an InvIT rather than REIT. Technically speaking, we see 2 large industrial InvITs in the next 3 to 4 years. I think the challenge is that REITs and InvITs need to have a certain minimum volume. And industrial rents are obviously lower. For an industrial REIT to make sense, you need to have a lease portfolio of what my calculation suggests a minimum of 25-30 million square feet.
Yes.
I think, and none of the organized players in India, none of the players in India right now are close to that, sort of scale. I think the largest player is perhaps, I'd say about 50% of that scale. Of all of us, others are trying to catch up. But in the next 3-4 years, I think whether it's ESR ourselves or some of our competition, I think you will see REITs. REITs is a very, very tax efficient exit mechanism in our view. Given the current incentives offered by the Indian government, gives you an opportunity to retain ownership over the longer run. And I'd not be surprised if everyone who's looking to scale up their portfolios to, let's say, at least a minimum of 10-15 million square feet starts, planning REITs, way in advance. I mean, we'd see, I think some of the larger developers should start planning in REITs as we, let's say, as soon as what, next 12-18 months, we should see, more activity in that space.
Yeah. Thanks, Rajat. Yash, your word, since you have recently raised capital, and what kind of exit investors have looked at?
Yeah, no, so I think I agree with Rajat, right? That we will see, and sort of what Rajni said as well, except that I'd be sort of at the shorter end of that 3 to 5 year tenure, right? So, I mean, one, industrial REITs or logistics REITs are already, fairly common when you look at, broader Asian markets or global markets, right? So, I mean, as a product, it's not like we're trying to do something new or pioneering, right? So this already exists as a product regionally and globally. The benefit, when we look at, and, when some of us sort of started investing into real estate, I started my career in real estate investing in 2007. We were sort of thinking about, office or any other commercial real estate asset class, which are yielding in the same way, where we were thinking that, over the next 4 or 5 years, we may potentially look at REITs as an exit, right? Now that obviously took longer than what we imagined. We've only seen REITs sort of coming into the mainstay fairly recently compared to that. But when we look at industrial now, we have 2 large advantages. That one, as a market, we are significantly much more matured than what we were back then, right? So compared to office or other asset classes, warehousing or logistics as an asset class has the benefit of, coming into being into a more matured market, right? So to that extent, it can sort of evolve to that level faster. And then also when you think about the development cycle for logistics, it's much shorter than, what you would have for commercial office, retail, or any other, commercial real estate asset class, right? So I do think we will get there sooner than later. In my mind, 3 to 4 years, we should certainly have, like Rajat said, industrial and logistics focus InvITs in India. And in the meantime, I think there will be ample liquidity for anyone who wants to sell assets in the market, where you will have, other fund managers looking to buy these assets, or other private equity managers looking to consolidate assets, with the eventual play that, they would ultimately create a portfolio, which then, they would subsequently read.
Sure. Thanks, Yash. I think so. We have completely, overshot time. I think thanks to all the co-speakers. I just, pen down a few points, which we discussed. I think that we are clearly seeing a thrust coming, from international manufacturers to India, but it's a slow process, as possibly happens in any kind of, economic and political wars from China to India. The warehousing demand is there, is more consumption linked. We might definitely see newer concepts of in-city, warehouses, vertical warehouses, temperature controlled, cold storages. Capital is available. There are big checks available for warehousing, and definitely we are seeing a penetration going in tier 2, tier 3, and tier 4 cities, because the consumption pattern, which has now struck in from the COVID time, is likely to continue. And REITs will soon be a reality. Yes, we will need scale, and the way platforms are being built, we will soon see that happening in maybe 3 to 5 years' time. With that, thanks so much. Sapna, to you, please.
Well, that was one very interesting conversation on the most popular asset classes of today's times, and for investors, who are now looking at, one of our speakers said, industrial and warehousing segment is where commercial segment was 10 years back. So, I think we covered all of the aspects of this segment. So thank you to all our wonderful speakers for sharing their views and sharing what's happening in this segment and what we can look forward to. Thank you so much.
Thank you, Sapna. I think just to add, to leave everyone with a positive note, I don't mind putting my neck on the line. 4 years down the line, we'll see at least 2 REITs, 50 million square feet successfully listed. Very, very confident of that.
Fantastic. That's a very positive sentiment.
Thank you.
Thank you so much.
Thank you.
So on that very bullish note, everyone is very optimistic about real estate and all segments of real estate. So on that, let's now welcome two thought leaders of our industry, and let's ask them what's their opinion on real estate in $5 trillion dollar economy of India. So let me welcome Mr. Khushru Jijina, Executive Director, Financial Services, Piramal Enterprises Limited, and Managing Director, Piramal Capital and Housing Finance Limited. And also I welcome Dr. Annurag Batra, Editor-in-Chief and Chairman, Exchange for Media Group and BusinessWorld. Both these leaders, they do not need any introduction, but still, as is the formality, let me give a small brief of both our speakers. Mr. Khushru Jijina is a chartered accountant with an illustrious career spanning well over 3 decades in the field of real estate, corporate finance, and treasury management. Mr. Jijina has been with the Piramal Group for about more than 18 years now, and he spearheads the financial services arm of Piramal Enterprises, the flagship company of the Piramal Group. And Dr. Batra, as we all know, is a serial entrepreneur, media mogul, a journalist, and an eternal optimist rolled into one. He's a first-generation entrepreneur, and after acquiring the iconic business media and magazine brand BusinessWorld, Mr. Batra has expanded BW BusinessWorld into digital events and BW communities. So that was a brief introduction of both our speakers. Mr. Batra, I hand it over to you.
Thank you, Sapna. Really, the focus is on Mr. Khushru Jijina. We're here to benefit from his experience, and he's, let's say, a playing batsman. He's still on the crease. He's still hitting sixes and scoring double centuries. I must mention that Mr. Jijina was instrumental in the recent acquisition of DHFL by Piramal. So congratulations, Mr. Jijina. Clearly, he believes in the future. That's why the acquisition. Let me start by asking you, Mr. Jijina. You've been a veteran of both investing and real estate. What has changed in the last 17 months in both real estate and the economy?
So, first of all, thank you for inviting me for this chat. To take your answer forward, I think on a macro scale, before I go into the detailed answer, I think pre-COVID, if I may just look at it, everyone was talking about commercial and residential was struggling. Actually, it has turned 360 degrees. The residential is now looked at much more favorably. The new, I was just hearing the other speakers chat, it's whether the warehousing, the logistics, the data centers have suddenly become the flavor of the season. Now, going down a little granular into the real estate or especially residential, while there are many stakeholders in the residential space, I would answer it under 4 heads as the major stakeholders. One obviously is the customer, the second is the developer, the third is the government, and fourth obviously the financer. So let me start. So the first is the customer. What was happening pre-COVID with the customer? I think the customers were so focused on the ticket size. It was just ticket size, and ticket size. Post-COVID, that has changed, majorly changed. While affordable keeps on selling, but what has really changed is that thanks to work from home and COVID, and which can happen again and again, the importance of home is now recognized. I'm sure many speakers would have spoken about it in the morning. And that's why this requirement for an additional room, whether it's a study or an office. Today, joint families, are preferring to stay in the same building, but with different flats. That's again a big change in India. Balconies. I remember in the good old days when I was running Piramal Realty, we used to redesign it because after the rules got changed, and FSI, as you know, is a very important element for a developer. And nobody pays for a balcony. We used to actually not give balconies. Today, everybody wants a balcony. So that's again a big change. Let's look at the change in the millennials. The millennials pre-COVID always believed that buying a home was very stupid. Many of the youngsters used to tell me that why should I buy a home when I can just rent a home, a good lifestyle. Again, that has changed. Today, you see millennials are preferring to buy against rent. The other very important thing which I want to bring about in the change in the customer mindset was including the investor. Pre-COVID, to my surprise, many of the investors thought that investing in stock market and investing in real estate is the same. Is actually not the same, because real estate is an asset class where you not only get returns in the long term, you actually get happiness from that investment. Whereas buying a car will only depreciate. It's not appreciating. It gives you happiness, but it depreciates. While a stock market doesn't really give you mental peace, if you understand what I mean. Again, the other change is the sharp rise in second homes, which are languishing. In fact, I would not want to name some of the developers, but their products were not selling pre-COVID. Today, there is a waiting list to buy those villas or the plots. So how things have changed. So to summarize, Dr. Batra, if I may just say that as far as the stakeholder, the customer is concerned, I think the pandemic has made the customers realize that owning a good home is not only benefiting their physical health, but also their mental state. Dr. Batra, in the good old days, we are from the vintage. We used to call roti, kapra, makan. I think we have gone back to that. Coming to the developers, what has changed post-COVID? I think one of the first points which comes to my mind, and I think I would include myself in that, if somebody would have told me pre-COVID that, you guys can sell flats, apartments, or bungalows or whatever on digital platform, I would have laughed. I would have said not possible. And today, look what has happened. Today, digital sales, marketing on social media has become the norm. And today it's a major, and I'm happy that actually developers learned the art very fast in the first pandemic, because look at what has happened in the second wave. Thanks to the learning which has happened, the developers are able to continue to sell on the digital platform. The other thing which comes to my mind of the change in the developer is that the developer post-COVID has also learned innovative ways to complete the project, rather than in the typical way of coming to a lender and saying, give me more debt. So examples would be the most common. People have started doing barter. Some developers, rather than taking more debt, gave discounts for advances, which at least were given at the end when the product was there. So there's no cash flow mismatch for the developer. So that was the other thing which the developers learned. I think the post-COVID developers have also learned one thing very important, which was the basic anyways, that the faster you complete the project, the faster your sales are there and faster the collections. I think such a basic thing was being missed before, which has also happened actually. And of course, the most important thing post-COVID, something which we have been telling, and I'm sure you had also heard about it. 4 years continuously, we have been saying that there will be consolidation, there will be consolidation. And COVID has only fast-tracked this consolidation today. And you are seeing that the stronger are becoming stronger and the weaker are dying, and the stronger are actually taking them over. So because the demand for the apartments and in residential is there. It's just that people now, whether it is the customer, whether it's the investor, whether it's the lender, they all want to deal with somebody who has got good corporate governance and professionalism. Then I come to the government. What has changed in the government? Pre-COVID, in fact, I was one of them. And many speeches, we all keep on hearing that, we as an industry in real estate provide employment to more than 350 industries. You would have heard this umpteen times. And still, in spite of that, we are not getting the due share of importance from the government. That we used to keep on hearing. What has happened post-COVID? Post-COVID, look at the way the government has rolled out so many schemes and come in to the help of the real estate. Number one, I would put it the Swami Fund, which is run by SBI Caps. I think it's so important in real estate to complete the project and at a reasonable cost. I think the government did a brilliant job in bringing that fund in at the right time. The other thing was recently the guaranteed credit from the government, then the one-time restructuring and whatnot. I think really government stepped in. I must compliment the government to ensure that a lot of things and projects get completed. I would also like to compliment the banks who also stepped in to do their bit by bringing down the home loan rates. And when they did that and bringing it down below 7%, look at the state government in Maharashtra. They brought down the stamp duty. All this combined helped revive the real estate in a major way. Lastly, the investors. When I say investors, it could be the banks, it could be NBFCs like us, or it could be the private equity players. All of them post-COVID have become extremely selective and are ready to back developers who have professionalism, who have a track record, and who have the track record of completing the project and actually working like an industry or like an FMCG. So this is what I would say has really changed post-COVID in the last 17 months. To your short question, a long answer.
No, beautiful answer because it encapsulated all the aspects that I was looking at. And let me say three things that I took away from it. One is, these are very basic, but somewhere in the rush of the last decade, the basics were not being followed by some players. The players that followed it grew and are now consolidating. So the first was very simple is there are more first-time home buyers than before. And they're actually putting in all the money, not just blocking by paying 10, 15, 20%. So clearly that's the first. Second is the fact you said that back to basics. In almost every area, you're saying developers in the whole ecosystem has gone to back to basics, which we were not following. And third, you're talking of the fact that possibly you've been talking about consolidation for at least the last 8-9 years. I think finally consolidation has started to happen. And you said that the stronger are getting stronger, bigger are getting bigger, and the not so professional are getting wiped out. I would like to be direct about it. But let me ask you another question. It is such a time. Traditionally, when the stock market does well, the real estate doesn't do well. When the real estate sector does well, the stock market doesn't do well. Right now, if you look at 3 asset classes, stock market, real estate, and gold, all are doing well. Of course, real estate, it's relatively doing well with a peak of last 6-7 years back. But what is the fundamental that is driving all these three?
So again, I think it's a brilliant question, Doctor. I think, as I mentioned in my first answer, people used to confuse investing in real estate and investing in stock market. According to me, a good investor should be having investment in debt, investment in gold. In fact, this is again the basics. You would have also heard this. Our parents taught us that you must keep money in debt, you must keep money in gold, you must keep money in real estate and in stock market. And somehow people mistook real estate and stock market as one. Both definitely need long-term capital. And today, if you see what is happening to the stock prices of our real estate also. Again, people think that the real estate, the prices of our real estate are going up. It's not really so. I'm actually not answering your question directly, but I'll come to your question also. which I actually answered in the first answer. But again, if you even see what is happening to the stock prices of the real estate companies, it's not really real estate. It's the housing stock which is going up. Again, to do what I just now said, that now people believe that, hey, this is a real estate sector which is finally moving like an FMCG, like an industry. It is more professionalization. I can see stability. See, ultimately, a long-term investor needs to see stability and needs to see consistency, which was not there before, because there were too many players and too many things happening. Now, with this industry moving into that sphere and coupled with a great demand which is coming, with no new launches and consolidation, it's a great time right now to invest in real estate directly or through the stock market. And that is why you will find that if the stock market is going up, that's also because of the economy going up. India will do well, and there's a lot of liquidity. Let's not forget that there's enough liquidity in the system. So this is the first time, you are absolutely right. You will see for the next few years, real estate going up and the stock market also going up. It's not going to be mutually exclusive anymore. I can't hear you.
On mute, sorry. I said, you know this better than me, but you know that the Realty Index, it is 2 days back, hit the 10-year high, 7. And this is in spite of the fact that out of the top 10 real estate scripts, 7 stocks are still trading 10 to 80% lower than record highs. So possibly it indicates a time to buy them. It's a confidence in their basics, right? And, you know, so clearly what you're saying is happening, both in terms of the real estate and economy, whether it's India Bulls, whether DLF, Shobha, Mahindra, Suntech, Prestige, Phoenix, Godrej, Oberoi, Brigade, which are the 10 scripts in the Realty Index, all did well. And
yeah.
7 out of those are still between 10 to 80% lower than their previous highs. So clearly there is hope there, and there will be growth there. Now let me come back to real estate sector. Our topic is, how can the real estate sector contribute to creating a 5 trillion economy? Because they're linked. And at this stage, let me ask you, the word that is used a lot is hybrids. I keep saying we're in a 3C economy: compassionate, collaborative, and contactless. Now, in that context, you started by saying that the commercial housing, commercial real estate was on a high, but now residential is on a high because of all the reasons you mentioned. Do you see that the office spaces will reimagine themselves? Do you see the office spaces coming back and the commercial real estate? Because the future of work is very different than what it was 17, 18 months back. We've all got used to working from home. And you yourself said housing is doing well because everyone needs bigger houses, second homes, first-time buyers. We talked about all the factors, right? If that husband, wife, both are working, if the 2 children who are studying or are professionals or are working, they need at least 4 bedrooms, at least, if not 5 or 6. So clearly you outlined those. So give us a sense of how does the virtual working or contactless working or work from anywhere change the dynamics of the commercial real estate, and what are your predictions for future?
So you asked me a very difficult question on commercial, actually, because I really think time will tell on commercial. But having said that, I don't think we can write off commercial, because let's look at ourselves, what is happening. We started 17 months back and we said, hey, work from home is great, digital technology is great, Zoom calls are great. But now in the last few months, everyone wants to go back to office, and we ourselves are doing that. But having said that, I think work from home will be there for a long, long time. So there will be a hybrid model. I'm pretty sure of that. How fast the commercial will come back, I'm not sure. It will come back, but my prediction would be, it's a little too early to say. I don't think for some time we will see that 60 to 70 million absorption per year coming in commercial. That's my take. I may stand corrected, but I don't think that's going to happen. Having said that, I think the offshoots of commercial in some way is when you talk about, say, co-working for a minute. If you look at what's happening to co-working, to my surprise, I think co-working, when the pandemic hit, also went down. But to my surprise, is actually coming back much faster than the normal traditional commercial space. Why? Because as they call it, the hotelization of the real estate right now. Or you can, the same old, and you and I would have in the good old days said a hub and spoke model. Again, to do with this work from home, Dr. Batra, as you rightly said, that rather than having one large office today, why not have smaller office around in each, for example, in a suburb of Mumbai, and have one hub. And that is what is driving co-working spaces right now. And it has surprised many that how co-working has come back in spite of commercial lagging behind. So I think we will need to see and watch about the commercial space. But if I may just take 2 more minutes, since you asked me about commercial, a difficult one, what according to me will also happen to the other sectors. If you don't mind, I'll just spend 2 minutes on that also. And and in a lighter vein, because I'm sure you guys have had a heavy day today. Our real estate developers all like to go to London. Everyone, kisi ko bhi pucho bolta hai, London, I'm in London. So let me use the example of Wimbledon. So if I look the example of Wimbledon today, where are we in all these segments? If we look, I was hearing the previous speakers, and they're absolutely right. I think in Wimbledon, the warehousing, the data center, the logistics, they are, according to me, in quarterfinal. Lot of work to be done in the next 4-5 years. If they do good work, lots of money is available to be poured into the country for this business. Similarly, like the commercial, what commercial was, 5 to 6 years ago, this is exactly where data centers and logistics are. So in fact, I agree with the previous speaker when they were saying that the REITs and InvITs will come in, whichever word you want to use. Somebody wanted to use InvIT, somebody wanted to use REIT, but I agree with them. Residential, I think, is in the first phase of a new tournament in Wimbledon. Again, to the same point, that according to me, in the future, whether it is 50 or 100, I don't want to put a number, it will be these players who are now playing a new game, trying to come up the pecking order. Some will have to, hit some aces, as we see in good players. But that's what is going to happen in the residential place. I think the traditional malls, if you ask me, are the real danger. I think unless they innovate, I think if you ask me, I think I would be worried about the traditional mall. However, high street shops continue to do well. So this is something which I would put it, and compare it to Wimbledon. But yes, to your question, I do not know what you would have had a panel on commercial, but my take is that is definitely not coming back to the 60 to 70 million absorption. It will come back for sure. Especially, let's also look at one more point, if I may end it. If we must hope, and I'm coming to the 5 trillion economy, I do believe that we have a lot on our plate, Dr. Batra. And even if we do 70% of it, we should be fine. Our economy should be fine. Look at what is happening in the US today and the European countries. The economies are booming. And that will help our outsourcing industry and create jobs. And that will also help office space. That is also my take. I do believe that if we can take care sensibly as a country with all these waves which keep on coming, and we don't drop the ball as we did in the second wave, I still think that we will be able to achieve, we can achieve the 5 trillion dream of our Prime Minister in the next 5 years. And that's my answer to your question.
Thank you so much. You went into retail and you talked about what will happen to retail. You said you're worried about, large format malls, but you believe neighborhood shops or neighborhood retail or high street retail would survive. Now, give us a sense of, again, in retail, I have a contrarian viewpoint. The fact is, if you look at lots of online companies that have been absorbed by large players like Reliance or Tata's, let me stick to these two because they're both very large, they're now going for a physical retail. I'll give you specifics. For example, 1mg has been acquired by Tata. Now they're appointing physical medical stores. So clearly there is a need for last mile, as you say, and right. So the word is hybrid. The word is digital. So while you rightly said that people have started to buy houses through online, at least search all online, purchase offline, and be able to complete the complete process through using never having met the broker, never having interacted, right? A lot of time virtual walkthrough. But tell me, what changes do you foresee in the retail domain in terms of how malls operate? What will happen to existing capacity? As you know, Mr. Jijna, that about 1,75,000 crore loans are, to be paid in the retail sector, which are dependent on the rentals. So the rental discounted has happened. What happens to that?
So again, a very difficult question you asked me. I'm not an expert on retail, but that's exactly what I was alluding to. That while you are right in saying, the new terminology, the hybrid model, etc., and Reliance actually has a very different model, by the way, which they are rolling out. I was talking about the traditional malls, and I was actually alluding to the rentals, what you rightly said, because the cost of making that mall and the rental which people are charging, something has to. I'm not an expert on malls, so let me first say that, but as a common sense tells me that something has to change there for the shops to really able to pay those rentals, and then, as you rightly said, on the rental discounting. Otherwise, I definitely see some stress in malls for some time. That was my point.
Thank you for being so direct. Thank you for being so direct. Now, let me ask you another question that is on everyone's mind. Now, you talked about consolidation, about smaller and mid-sized players either reworking their balance sheets, reworking their cap structures, reworking the way they work, or they'll be non-existent or gobbled up by larger players. Now, what do you think needs to happen to developers and their mindset for them to survive? And what you already see in action. When you would talk to developers, say 2 years back, when you talk to developers today, and you're a fund plus you're also a developer. So you're like I would say, you have a kind of a hybrid model where you're an holdco and you're also a operator. You're an investment company and you're also an operator. Correct me if I'm wrong. You have a unique model, right? So what do you think will happen to developers going forward? And give us some hidden gems that you see in developers that have not yet kind of been identified as big players, but you see them coming up very well.
I think the most important thing which I would say to the developers is right now, clean up your balance sheet. I think you also said that. And that's exactly what we have been talking to all our developers. When we in fact say that we will support the grade A developers, we never mean the top 5 or the top 6. We mean a guy who is really managing his balance sheet well. He may be just a small guy in a micro market, say in Batra, doing well. So just let me define that. So I think the most important number one is because oxygen is basically capital. So you need to manage your balance sheet. You just can't just keep on over leveraging and thinking that sales will happen. You have to, in fact, let's look at what has happened with, and it's a learning not only for them. In this point, I would say it's a learning for even the funders. When you are looking at a project now, you cannot assume that this will always happen, because something is also going to go wrong. And today, how are we looking at it? Today, when somebody comes to you and says that, I need 100 crores because my cost of construction is 200.
I clearly tell him wrong number.
Yeah, exactly. Today, you have to have financial closure for the entire thing. If the sales happen, is good, it's great, you don't draw down. I think that's one big change. I don't know how many people have realized it's a big change in that. And that's why today, like the Swami Fund or even us, when we do the last mile funding, we ignore the sold receivables. We believe that sold receivables, whether they come or not, it's okay. But right now, if you have to give financial closure, then we have to go the end. We do not have to stop again in the middle. I think that's one big thing which is to be learned by the developers. I think the other thing is be open to change and be always on the nimble feet. I always call it related to the FMCG, because FMCG is so quick. Everything moves so quickly. Today's flavor is tomorrow's, absolutely something else. And that's what you are seeing, which is happening. Look at technology, which is getting permeated into the real estate. Just see the way it is moving, whether it is digital, I spoke about, the drone technology. I think the 3D printing, the other day I read that the Chinese have completed a building based on 3D printing. I think even in India, we did something like that. So you have to be open to change. You have to adapt very fast. And something which is very basic, which I'm sure now the good developers adapted. is that be customer centric. You know, it's so funny that we are connected with the customer for the next 5 to 6 years, and we don't really bother about the customer. And that's why I keep on coming back to the FMCG, because the customer is the king there. So I think the simple basic things, the shifts, adaptability, change, manage your balance sheet, customer centricity, I think we'll definitely see the new developers play this out. And I'm seeing this. I don't want to name players, but I'm actually seeing this, whether they're small, whether they're big, I'm actually seeing them coming. So I don't want to name those jewels. You asked for it, but I will not. I have identified a few. In fact, I would call them the second generation of that same developers who are actually looking at things very differently. Recently, I interacted with somebody in the north, totally different from what his father looks at real estate. And that's the fresh thinking which they are bringing to the table.
Thank you so much. I think times like this ask for, one, going back to basics, and second is looking at the future and trying to create something that works in the future, rather sticking to something that works in the past in terms of the product. I'm not talking in terms of philosophy.
Absolutely.
And now let me come to you specifically, which is Pyramid Enterprises Limited and Pyramid Capital and Housing Finance Limited. Now, tell us over the next 12 to 15 months, without getting into the specifics, in some way by saying that you met someone from the north who's doing the kind of things you outlined, you're clearly saying that that's the kind of developers we'll back. You said if there's somebody in the Batra micro market whose balance sheet is good and who follows the principles that you just espoused, you'll back players like that. In some way, you've given that philosophy. But if you had to bring it all together, what would be your philosophy over the next 12, 15 months, both in terms of investments and in terms of development?
I think I'll talk in terms of the investment because that is important. I think I do believe that we are one of the serious and important players of stakeholders of this industry. Having said that, what have been our focus in the last few months and what will be continued in the next 1 year? Our main focus will be to handhold the developers who are existing with us, our partners, to ensure completion of the projects. Because if they don't complete the projects, everyone loses money in real estate. So that is our main focus. And day on day, month on month, we keep on pumping money with our developer partners to ensure that there is no stoppage of work. That's definitely our core. Having said that, yes, I can definitely say that we have started looking at new projects, though they are few and far between. The reason also, if you, Dr. Batra, you must understand that today in real estate, the developers themselves are not taking new positions. They are basically concentrating, either they are completing their own projects or they are becoming stronger by taking over somebody else's projects, a brownfield project, which we back. But when all this gets over, obviously we will go back to our fresh lending, which is the reason why we are there. Besides residential, I think I would say the exciting spaces for us are warehousing, logistics, and data centers for sure. And that's something which we will look at in the next few months. But having said that, I'm again repeating, our focus will be to handhold the developers who want to complete the project, rather than just shifting gears immediately.
Fantastic. And additionally, as you said, you'll be looking at data centers, you'll be looking at warehousing. Clearly, they are very lucrative and they could do with good capital. My last question before I end this. If you had to look at, these days we don't tend to look very long term. The last 17 months have told us to live by at least the month, if not by the week. But we have to be optimistic about the future. You clearly are, and we clearly are. If you had to look at the future, 36 to 48 months, 3 years to 4 years, what are the seismic shifts that you see at the end of those 3-4 years? What would have we achieved as an industry, as a country?
I think real estate plays a very important role. I think I don't need to repeat that. But the big shift I see compared to what has happened in the last 4 to 5 years, if I have to fast forward to 4 to 5 years, number one, I think consolidation would have played out. And you would really see this as an industry, some being listed, some being non-listed. Something like US, Dr. Batra, where, this type of, I would say excitement, if I may use the word, in real estate, suddenly things are doubling every day or suddenly things are going down every day. That's not going to happen. The consistency will be there. What is happening in US? Typically, if you study the US market, you will see that there are set number of developers in each region. They are localized as always. And they supply 85 to 90% of the stock required on a yearly basis, the demand. So there is this consistency of demand supply, which is there in all industries. Somehow in real estate, it was never there. I do see that happening. I see consistent rise in prices. I definitely see today, again, prices have no correlation. The cost of cement and steel, if you know, Dr. Batra, has gone up 30% recently. But many developers are not able to raise it because of the fear that there will be, again, problem on demand. All these things have to go away because real estate is an industry which is required, and especially in a demand-driven economy like India. So I definitely see stability in residential. I see stability in absorption of commercial. I think I mentioned it. And this new age, I think this specialization of service, I think I would like to use the word service. What do I mean by that? See, today, typically a resi or a commercial is a brick and mortar. You understand what I mean? A developer. When we move to co-working, co-living, all these other new age things which are coming into India, those are service. It's not only development, it's service. How well are you going to serve the customer for that segment? So it's going to move beyond your development capabilities to service. Are you best in class? So I am very optimistic. I really believe that thanks to COVID, whatever had to happen has happened. And 4 to 5 years down the line, Dr. Batra, when we hopefully speak, we will be very proud looking back that we were part of an industry which is really now playing an extremely important role. Like anywhere in the world, China, you take US, you take Europe. In UK, you see how they play an important role. I think we will be part of that. This is what I do believe will happen.
Thank you, Mr. Jijna, for talking to us. This has been a session that has encapsulated the entirety of the industry, the past of the industry, the present of the industry, and the future in the industry, coming from you, Mr. Jijna, who really has a vantage point in the industry, plus a large play and your own personal experience. I think it lends gravitas, and clearly what you shared in terms of the Indian real estate sector becoming mature, if I may use the word, more professional, more organized, more stable, less yo-yo as in oscillation in terms of price or in terms of where the industry is. Clearly more throughout the conversation talking about FMCG, because FMCG is very, you ought to first focus on the customer. I think that's the biggest thing, sales. And that once you align that in terms of what the product is, you can differentiate and charge a premium also. So clearly consolidation will be the order of the day. And you rightly said prices will go up. So clearly there'll be, because there'll be genuine buyers and there'll be players who actually deliver. There will be a premium on differentiation, which sometimes in a market is missing. So I think maturity may bring that to the market. Also, as you rightly said, capital is the real game changer. And capital will flow to all those who have the kind of characteristics you mentioned. Clearly, it is exciting time for Indian real estate. A lot of people who've been writing an obituary of the Indian real estate will have to eat their words. Real estate is a very integral part of an economy, and there may have been temporary disruptions and some permanent changes over the last 17 months, but in some way they've come to make the industry even better and structurally make it more sound. So I would say that that's the gist of what Mr. Jijna has said. Thank you, Mr. Jijna, for talking to us at the BWVC World and Realty Plus conference, the first inaugural conference on investments in real estate. Your presence today and your comments have been deeply appreciated, and we're grateful to you for your time and your input. Thank you so much. We wish you luck, and you've done a big acquisition in DHFL. I'm sure when we talk to you in some months, that will also play out well.
Thank you. Thank you, Dr. Batra. Thank you.
Thank you so much. Back to you, Sapna.
Thank you, Mr. Jijna. Thank you so much. And thank you, Dr. Batra. It was indeed a very interesting and an informative conversation. Thanks, Mr. Jijna, for sharing your views. Our audience were very keenly listening to what you had to say and what your predictions are. So they will be closely watching that. So thank you so much for sharing your time with us today.
No, thank you everyone for listening to me. Thank you.
Thank you. So after that very interesting and an informative, opinions and views that we had from our industry leaders, Mr. Khushru Jijina and Dr. Batra, let's now talk about technology in real estate. And that brings to our next topic of the session, investor ready tech areas that will attract funding. And let me introduce our panel who will be talking on this very interesting topic. The moderator of the session is Mr. Sandeep Sethi. He's the Managing Director, JLL Work Dynamics, West Asia JLL. Our speakers in an alphabetical order, let me introduce Mr. Amit Ramani, Founder and CEO, Office Space Solutions Private Limited. I also introduce our next speaker, Ariman Veer, Founder and CEO, Nair Capital. Our next very eminent panel member is Mr. John Kuruvela. He's the Chief Mentor, Brigade Group. And our final panel member, let me introduce Renuka Rajagopal, Senior Director, Workplace, VMware, and also VM Inclusion India co-lead, and Varun Mohan, who is the founder and CEO of Definite. So, Mr. Sandeep Sethi, I hand it over to you now to carry on the conversation, and this is our eminent panel.
Thank you, Sapna, and thank you, BW, for hosting this and for the opportunity to be part of this. And congratulations for having the inaugural conference in investments in real estate. This was a topic that was always interesting, but I'm so happy that you've actually pulled together so many different eminent personalities from the real estate industry to talk about this. And it's a day-long conference. And I'm sure end of the day, of course, everyone's going to be a bit tired, but everyone's going to go back with a lot of information, knowledge, and probably with an appetite to discuss more and more. So hopefully we'll have more of these coming in the years to come or months to come, maybe. It's absolutely a pleasure and delight for me to moderate this panel. It is a topic that's very relevant. PropTech is a topic that has been popular for many years, and India has been at the forefront of this discussion. They said that globally, India was in the top 3 when it came to PropTech investments. That was pre-COVID. I don't have the statistics in terms of how it's faring now, but we'll surely get a flavor of that in the next 45 minutes or so. But if you look at what really drove PropTech funding, it was really a bunch of people trying to solve real world problems in real estate. And they were addressing the entire life cycle of real estate, all the way from site selection to construction to, let's say, seat booking systems in offices, to touchless technologies. And of course, with the pandemic, there are new use cases that have become so relevant, and they'll hopefully keep driving this topic and driving investments in PropTech. But what's interesting, and this is something that we're going to discuss about, is how has the current pandemic or the current situation impacted all this? Has it impacted the appetite of the investors? Do we need a different skill set for the ecosystem in the new world because we might be trying to solve different challenges? Are there new stakeholders that have come in that are expecting different problems to be solved? Will there be new contracting models or new delivery models that will be required in the new world? And many more. So I have, as I said earlier, the privilege of moderating this panel. The panelists have already been introduced, so I won't go through the names again. But it's very interesting that we have a mix of occupiers, developers, landlords, and of course, we've got 2 who actually run PropTech platforms. And they're solving problems that are so relevant, but these kind of platforms didn't exist in the past. So with that, I'm going to go straight into the discussions, and maybe I'll start with Varun, yourself. My first question would be related to the pandemic. In your opinion, Varun, has the current situation dampened the whole mood around PropTech in India, or has it accelerated the need for investments in PropTech?
Thanks, Mr. Sethi, for giving me the opportunity. So when we're talking about the pandemic and its effects on PropTech platform, I believe that it is a blessing in disguise, I would say, because people have got more inquisitive, more curious that how they can go for different type of category or assets or investments which otherwise was not available, or which people did not look otherwise, right? They were never looking for such PropTech platforms. They were simply practicing orthodox investment opportunities. And as we all know, I'll just relate it to one more thing in here when we're talking about pandemic. Just similarly, what happened in the time of in 2006, when payment gateways become a huge frenzy, right? Everybody who have not used his mobile phone ever was transacting even for buying and selling groceries, right? So the customer we're talking about, which is a very important part of a PropTech platform, the user behavior has been developed. The most difficult part of any industry of any product is user behavior. You cannot create a user behavior very easily. But lately, what we have seen due to pandemic and due to ongoing technology and digital platforms available, people have already been performing digital transactions. They were in other categories, e-commerce, like people were even buying their appliances, everything for their home. Now, when they have got the opportunity where they can participate or where they can invest into or make a whole transaction digitally, sitting at the comfort of their home or office, now that user behavior is actually transforming how the whole PropTech industry can work out. So pandemic, I would say it has its drawbacks, but for digital or PropTech platforms, I would just completely mention here that it has just accelerated the number of people coming on the platform, the number of people making digital transaction on the platform, and more innovation are coming up. So people are looking in this segment in terms of as an innovative product, not just orthodox real estate product.
And that's a very good point, Varun. And probably what you said applies to most sectors, right? Everyone says across different industries that because of pandemic, the adoption of technology has accelerated, and hence the use case becomes even easier to justify. So very valid point. Amit, I'm looking at you on my screen. Do you have a different perspective, or would you agree with what Varun said?
So I think, Sandeep, I think clearly what the pandemic did was, I think all of the ideas were already there, right? So it's not that anything, the technology-wise is new. But what it has done is it has brought all of it to the forefront, as you said. It has happened in all the sectors. I think what's really exciting now is that things in PropTech, the technologies that were on the fringes are now at the center. So for example, this whole concept of hot desking, ability to book a seat on the fly, rostering, etc., it has existed for the last 20 years. Nobody used to use it, right? But today, if I look at it, every company wants to have this whole hub and spoke distributed model. And the reason it's possible is because of two parts. One, technology allows us to be connected from anywhere, right? It's thanks to Zoom and similar technologies, and also cloud, right? Because if there was no cloud, I couldn't be functional from anywhere. Second, the ability for people to be able to be operational, work from home, work near home, or work from their town. All of this is happening because companies have realized that technology allows them to do it. Second, if we look at real estate in general, I think it was only a lot of action happened about 6-7 years ago when a lot of these listing platforms got a lot of interest from investors. Reality is they were all discovery platforms. And that's the reason that, after a while, people lost a bit of interest in it. They might all still be doing okay. But today, that discovery is now turning into transaction, right? So through blockchain and some of the newer technologies, you could actually just sit at home and do the transaction, right? And some of that fast tracking is going to happen and will allow real estate to actually become at the forefront. The third piece, which is very, very interesting and related to blockchain again, is this whole ability of having fractional ownership. We see REITs as the first starting step. But the reality of the REIT ultimately is the ability for a person to put in a very small amount and own a large asset, right? Which is not possible till probably a few years back, even pre-pandemic, right? Today, everybody is forced because of funding issues, because of large assets, no monetization, liquidity available. Fractional ownership is something that is going to be real and is going to come to the forefront. So I think all of these areas are going to see a lot of action. And then obviously health, safety, hygiene, smart buildings, all of those I think were already there. It's just they are getting a bit more fast track due to the pandemic.
Thanks, Amit. You brought up some very good themes that truly have fast track after the pandemic or during the pandemic. And at the same time, they built compelling propositions for applications as well. So thanks for that. Renuka, I'm going to ask you the next question. You represent the occupier side of the business. What are you seeing from your lens?
Yeah, thanks, Sandeep, for inviting me to this esteemed panel and being part of this discussion. I would go with what Arun and Amit was talking about in terms of many things accelerated during the pandemic. Like as if there is no tomorrow, like everything was on a totally accelerated motion that we all went through. I would also add on to one thing in terms of as we, if you look at years back, like we spoke about technology did exist for, like seating reservation and a lot of things, applications existed. But I think the key differentiator right now is as we look at coming out from being in, like working remotely to a flexible model or to a hybrid model, efficiencies do matter. Because it's going to be quite clear that everyone is not going to come to office every day, or most of the corporates or companies would be looking at a flexible model. So how do we take this further in our journey? I think that would have a lot more attention. For example, if you had a lot of standalone apps on which that we were working on, we would have been working on, we had a seating application or a space navigator, we have a help desk, we have engineering systems running at the back end. But more important, as we look ahead and we look into the future, would be seeing that how do we integrate all of this? Because if we have to bring in efficiencies, if we have to bring in to see that, how do we get the optimal utilization of everything? Like there could be some of these business may be coming 3 days a week to the office. How do we integrate that flexibility with the back-end operations, and how do we bring in efficiencies? That would have a completely different focus or a more accelerated focus as we look at bringing in flexibility, talking about future of work, and talking about what will be the need of tomorrow. I think this is what it is. This is one. And the second part I would add on to this is like, this has to run into operations. This has to run into people who are running the operations. This has to go its complete cycle. So the investment is not only in building the applications or not only in building the platforms. The investment should also, it is a continuous journey. It's going to be an ongoing journey, and the investment has to happen in all its complete form. That means on reskilling as well, because there is no status quo to this. This is going to evolve. This is going to continue. And maybe if we had transformation, any transformation is complete when the last person in the chain can do it with utmost simplicity. And that means that the reskilling, the upskilling needs to happen through the chain. So I guess this would be the areas of focus as we look at future of work, as we look at building flexibility. We ourselves will be going through that journey.
And you bring up a very nice perspective, because we all agree that technology is important in real estate. We've been screaming out loud for the last many years. It's accelerated. But what you're saying is so important that there'll be a lot of piecemeal solutions. We've got to bring it together. We've got to address the operational efficiency. We've got to address the skill sets. Otherwise, you're not going to be able to utilize or leverage the investments to gain efficiencies, right? For me, the classic example that comes to my head right now is Microsoft Excel. It's a great tool, but I personally just use it for plus minus functions, probably using 1% of its capabilities. And what you're saying, extrapolate that across a wider ecosystem of technology solutions addressing the entire life cycle of real estate. If you don't bring it all together with the right skill set, with the right analytics, with the right reports, etc., it'll just be to use that same analogy, as glorified Microsoft Excel as being underutilized. Thank you.
Yeah.
John, you run the incubator program at Brigade. What are you seeing? Are you seeing different type of pitches coming to you? Are you seeing more pitches? Just give us some context there, please.
In 2016, when we started the real estate accelerator program, everybody said, we are going to do something crazy because this category doesn't exist. Investors won't come in. Real estate developers have this, head in the sand kind of approach to technology. They don't trust startups. The big boys, the large established players, charge a hell of a lot of money for this. But we actually took a punt and said, nobody wears shoes here. What a great opportunity. And when we got in, you won't believe it, Sandeep, we had only 15 PropTech startups. The word PropTech was not coined in 2016. We were the first accelerator in Asia. There was only one other in New York. There were only 15 out of 180 applications. Only 15 applications came from the PropTech category. Today, in 5 years, we complete 5 years of existence on June 30th, 2021. We have in our database 2,500 startups solving all kinds of problems. And the pandemic has done a fantastic thing. It's put PropTech on steroids. I know today we are seeing, Forbes did an article in 2017 which categorized PropTech as collaborative economy, cusp of fintech and real tech, construction tech, and one. Today we know that legal tech, water management, sustainability, wellness, all this encapsulates PropTech. Somebody spoke of fractional ownership. We're seeing over and above REITs, we're seeing companies which are allowing end consumers to actually fractionally own 10 square feet in a large real estate space. So we're seeing a lot of development in this space. We're seeing a lot of young entrepreneurs give up cushy jobs and get into a segment which nobody wants to touch because real estate as a segment, people didn't want to get technology in because they know that real estate does not pay. Even if they pay, they don't pay well. Getting to decision makers, because this is actually a very nascent industry, PropTech. And if you don't get to the decision maker in the industry, it's just going to go into its cycle into a black hole. So we're seeing robotics come into play. We're seeing fintech, some very interesting companies come into play. And Sandeep, you'd be shocked. I mean, the whole world today talks of co-working and co-living. In our current cohort, we've selected 2 startups which do co-partying and co-renting on high street. And there are such brilliant young founders who are bringing in such diverse and very disruptive experience. I mean, imagine today with the pandemic, you've had hundreds of MSMEs, homeowners get into startups, delivering food. There's a company in Bangalore which just focuses on delivery of food for dogs. Now, she cannot have a place on high street. This startup actually gives you on MG Road, 1,000 square feet for just 2 days. And this startup is actually addressing the pain point of the commercial renter, but also the need of the end consumer. So there is a lot of disruption. We're seeing a lot in nanotechnology, alternate materials. So there is, I mean, it's a vast, unexplored, like I said, it's such a nascent industry. There is so much, there's a young kid from Delhi who's actually created a huge platform taking agri-waste, which is creating pollution in the north of India, and actually created agri-biopanels, which are cheaper than plywood, cheaper than MDF, cheaper than gypsum. And many companies today, the ICICI boardroom is using that material, and they're reducing carbon dioxide emissions. So there is, I mean, we are seeing, because we're in the grassroots, we're seeing a hell of a lot of disruption in this space.
John, very good points, new use cases. But what I liked, what stuck in my head is this point you made on young entrepreneurs. We had a hackathon a year and a half, or maybe 2 years back, and I saw exactly what you just said, that the folks who had just graduated from college and they were getting into PropTech solutions, they knew nothing about real estate. And you would never see folks not coming from a real estate background, getting into real estate, to start companies. It was never a startup channel of choice. That is a good indication of the excitement that is sort of happening in our industry, that's attracting people who don't know anything about real estate, but they want to get their get the nails and get the dirt under the nails and get into the group.
And so that's the interesting intersection we are in, because we bring in the domain knowledge. So we got brilliant engineers solving great problems, but the challenge is they're creating solutions and then go to find problems in real estate. We are on the other hand, take those solutions and actually fit it into a market need. So that intersection of brilliance in technology and domain is what we bring.
Yeah. Ariman, I'm going to ask you the same question. You run a platform that serves a need that's been existing for a long time, but wasn't served by PropTech. Do you think the current situation is going to help, or is it going to create some headwinds?
Yeah, thank you, Mr. Seri, for the question. So what is interesting is that usually, in times such as now, when there's an economic slowdown, uncertainty, or increasing inflationary pressures, what usually happens is that, investors gravitate towards hard assets. In fact, they prefer real estate, gold. So these commodities are usually a good hedge against inflation. Today's market scenario differs a little bit from a traditional sort of economic slowdown because of the work from home aspect. So that's a additional aspect that we haven't previously dealt with. So what is important is actually to understand, or at least communicate to the investors how this whole work from home situation is panning out. So work from home worked really well. In fact, it was quite tempting for the first few months. It was quite enjoyable working from home. But over time, what at least we've observed is that the work from home fatigue and the monotony has been catching up. So in fact, our entire team, when we did a survey, all of them wanted to come back to work. A lot of our tenants are also coming back to office. So this whole back to office movement, is something that is holding the fundamentals, in place. The ones which have been essential and in fact the core of the entire CRE growth story of the country. So real estate is a long-term asset. It's not an asset which you should invest into with a 1 or 2 year horizon. And like we see in other countries which have overcome the unfortunate pandemic and in fact have become mask-free, India in time will get there. So overall, I mean, PropTech has disrupted the sector and has been put in a spotlight because of the pandemic, because of the digital first approach. But more importantly, rather than just providing a technological change, what it has also done, it has provided investors, essentially transparency. It's provided them an avenue to access this asset class, which platforms such as ourselves are focusing, on rebuilding trust, on rebuilding the transparency between the investor and the landlords. So overall, I do believe that the fundamentals of why CRE has done well is still intact and will continue to do well. It's just a matter of patience and waiting it out.
Very well articulated, Ariman. So real estate was always appealing as an asset class, but investors usually got spooked because there was lack of transparency. It was very hard to participate in that whole investment process. But with REITs and fractional ownership, with technology platforms especially, that whole transparency comes in and becomes a big driver in that journey. So totally agree with you. Thank you. I'm going to ask you a slightly different question. And Amit, I'm going to start with you again. Well, not again. I started with Varun the last time. If you look through our, let's say our crystal balls 5 years ago, we would have made bets on certain technologies. Maybe some of them launched, did well, some of them maybe didn't survive. But let's look forward. What would be some of the technologies or applications that you think would be really relevant and hot in the new world?
So, Sandeep, I think clearly this whole idea of augmented reality and virtual reality has existed, right? If you ask any gamer, they would tell you how it completely has an immersive experience. But unfortunately, till a few years back or even pre-COVID, there was very marginal use of it, right? Today, almost every developer, commercial, residential, retail, is using that as a mechanism to drive sales, right? Now sales are happening of apartments without people even going into it. I think that technology is just waiting to zoom and completely have a immersive kind of an experience. I still believe that there is physicality that's going to be involved for sure. People are not going to make decisions on crores of investments just through a VR or a AR kind of a platform, but it will help down select to the one or two that finally people end up selecting. So I think there is going to be tremendous amount of growth in that area, and I'm extremely excited. We use some of it in our obviously sales mechanism. Second, I think this big data in real estate existed, but the use of that big data was limited to some sidelines, right? So clearly, from a big data standpoint, again, my point around blockchain, etc., they all existed, but they were not being really used at the core of it. And I think now that big data brings transparency, one, which has been there in the developed markets, obviously has been somewhat limited in the Indian market. Now, every developer understands that transparency is important. And a lot of companies in India and PropTech have done a tremendous job, without naming anybody here, in that space, right? So I think clearly that big data blockchain is going to completely transform how we transact, how we look at real estate, and how we look at the transparency aspect coming back into real estate. Third aspect, which I think is very, very exciting, is the whole element of artificial intelligence and machine learning when it comes to planning, analysis, and delivery of the product, right? Today, I think a lot of the work that happens, every segment of that process, right, from the point when you envision a project to when you deliver it to a client, I think is extremely inefficient. And I think that's where I think a lot of this, the new technologies are going to have a tremendous impact that will fast track. So I think